Welcome everyone. So I'm Johnny, the founder of Linkpool. Been in the Chainlink network since it first went live on mainnet in 2019. And if you want to go around, if you want to do an intro and tell us about yourself in the Web3 space.
Sure. Matthew, I'm CEO of Simply Staking. We've been in the Chainlink node operator set since 2019 as well. I did get a bit after mainnet. That's my journey.
Yeah, I'm Kubilay. I'm the co-founder and CEO of Matrix Link. We joined a bit later than these guys. We joined in 2022. I think it was February. We started out as community node ops in 21 and then transitioned into a verified node operator.
I'm Peter van Maurik, the most unpronounceable last name, I think. From Chainlayer also since 2019. Remember those days? And yeah, co-founder of Chainlayer.
I'm Zale. I'm the founder of Northwest Nodes. We came in same time as you guys. We won a competition called the Oracle Olympics. And yeah, we started out as community node operators as well. And shout out to Chainlink for giving us the opportunity. And I know it's been great because I think we've all here proved ourselves. So
Well deserved.
yeah.
Cool. Where's the... Oh, it's okay. So I suppose, can you talk to us about how you found, I'd say over the, since being on board to Chainlink and all of the expansion around different services and chains from, CCIP to data streams, from an infrastructure and a node operator point of view, how have you had to change and how have you found that growth from being able to support all of the different products and services?
Yeah, I think so. We run everything on our, from our data center in Malta. This is weird.
Yeah, it's weird.
I did hear yourself speak. So that requires a lot of hardware that you expand over the years. We started out with just Ethereum, which was a lot of work in the early days because, for example, in, let's say, March of 2020, there was this massive market crash and volatility. And you had to make sure that you're always up, always early, making sure transactions make it on chain, even when gas was super expensive and it all goes a bit crazy. Since then, everything kind of mellowed down on the gas side, but then you expand to so many networks. So today we end up running, 1,000 nodes across many chains. Not obviously not for Chainlink, but the bulk of that is for Chainlink. It's interesting to grow the team. In the beginning, you had a lot less expertise in how these are going to work. You have a few people. It was very hard to onboard new people in the team because you just didn't know how you're going to scale. It was just no idea. And then you grow over many networks, becomes a little bit easier. But the point is that you're always on, 24/7. You have to be operationally excellent. 2 minutes, if something is down, within 2 minutes you have to respond, maybe less. So everyone's on call. It was harder in the beginning until you get the team all set up to address that. Today, as you expand to CCIP and the data streams and all the other dawns that we run, I think it's settled down from an infrastructure kind of point of view. You can train people better, but the operational excellency has to be there. So that's just non-negotiable. It's been an interesting experience.
Yep. Yeah. I mean, it's actually great, how we've seen the network evolve from a handful of chains where you had just Ethereum, Polygon, Arbiter, and Binance chain, and a few others, 5-6 chains, to now having close to 50, 60 chains on CCIP, 20, 30 chains on data feeds, and now you have the new CRE, Chainlink Runtime environment popping up. So it's back in 21, 22, we had a few chains, which we have to take into account for maintenance, resource management, dev time management. And now it's every week a new network pops up that has to be integrated. And the technical overhead is just like every day something breaks and we have to fix it, do band-aid solutions and whatnot. That's like the shift in like a few years, and I expect that to continue when we go to like hundreds and thousands of chains.
Yeah, it's been a crazy ride in that sense. I think what I find interesting is if you look at the past 5 years, 6 years since inception, we haven't had any downtime. Chainlink has been up for 6 years, period. There's no downtime anywhere.
Yeah.
And I think that's well, you think so too. It's amazing, right? Networks have gone down. We've had hacks that made, well, just yesterday, I think on Barachain, they just turned it off. But that's unthinkable for Chainlink. We don't turn it off. We just keep on going. And that's an amazing thing to be a part of. And that's amazing to make possible. And I think it's us that do that. And it's something I'm very proud of, especially the team that makes it happen. And
yeah. And I think that, decentralization on something like an Oracle network, there's so many levels to it where you need to decentralize your data that's coming in. You need to decentralize not only the node operator set, but where they're operating, so some people are on bare metal, some people are on cloud, but not everyone's on the same cloud. Some people are, on hybrid cloud environments, and you need that because, as we saw with the AWS outage, it's
down.
If everyone's on AWS, you're actually not decentralized, right? And so you need to have so many very carefully thought out things, and it requires an immense level of coordination. And kudos to Chainlink and to all of us for being able to do that, because it requires that level of thoughtfulness that some people until it breaks, you don't really realize how important it really was. And it's been incredible, and we're very proud of being able to keep everything online. I made a post, a little tongue in cheek after that. And I said, well, was AWS down? Well, you didn't notice. Yeah. No big deal, right?
No biggie.
Yeah. Cool. So, based on that, I feel like one of the, common misconceptions is like Chainlink's not like a proof of stake chain in like running a normal validator, right? Like, I feel like, people sort of misunderstand a lot of the moving parts and how big like an orchestration sort of is to be able to operate Chainlink at scale, especially across like all of the different products and services. So based on Chainlink actually not seeing downtime, like, can you talk to us about more of the sort of like the scale of like how you monitor infrastructure, the observability, and sort of even from an operational point of view, like how would you manage that to the point where you are online essentially 24/7? Matthew?
Yeah, you have, as I said before, you have to have a team that is always on. So everyone needs to have the same kind of level of expertise, and you train people towards that, so that someone needs to be there all the time. So calls come in, you have like 24/7 teams that are managing all these networks. They're all different, so they all break in different ways. If you're running ETH, you can't run. If you're running Ethereum, you need different. You need GET, and you need other types of what's it called?
Execution
and the consensus.
So it's very tricky, but over time, I think it always gets better.
When you look at it, like there's so much that can break foreign Chainlink Oracle to like do its job. So we have to take into account like we have to monitor data providers, we have to monitor incoming data, outgoing data. We have to monitor like on 50, 60 chains. If you're on CCIP and all of the new like Chainlink services, there's so many gas balances that you just have to monitor to like publish data on chain. So the things we have to take into account and monitor and set alerting up is just growing in scope as time goes on, and Chainlink becomes more and more the base layer of like putting things on chain. So that's like it's an ever growing wheel of essentially infrastructure.
Yeah, I think what I'd like to call out a thank you to Chainlink in a sense for making it the way they made it, because even if we do all our monitoring perfect, if something breaks on our end, then I know that the way things work make that the whole system won't break. If we do miss something left or right, which doesn't happen often, thank God. And I think it's that synergy between Chainlink and the node operators and the way the architecture around all the products work make that if we just all do our best and we do our thing, we keep our monitoring good, then Chainlink keeps the product good. And that combination makes at least failure across the whole network almost impossible.
It's like the layers of redundancy are huge across.
And that's
so if you're looking at the data feeds that we get, you have every team is on different data feeds for each data price that you're putting in. Like every single one of the node operators will have a different set of where they're getting that price. Yeah. If the prices don't match, you'll still ensure you're removing outliers between 5 or 6 that are making that price feed. They're all getting different price feeds from different places. If one goes down, we get alerted both from our internal systems, but also from Chainlink. So the amount of monitoring that goes on and resilience in that is just insane. And it's not something that you see in any other network. Yeah. And it's due to the complexity of it all. Because if I'm running just an ETH validator, I'm just running some nodes.
Yeah,
a
up
few.
or down.
Yeah, it's either up or down.
Yeah.
But if you're running data streams across all of the EVMs, that's a lot of networks. And each of them needs to be orchestrated in sometimes its own special way, right? And kudos really to Chainlink for really building, if you see the state of where we started in 2019 to today is just unrecognizable how it works.
Yeah. I mean, at the end of it all, it's like a team effort, right? We all work together. Whenever we have issues, we help each other. We share scripts with each other. We troubleshoot. Chainlink helps us out with a lot of best practices, and they're there to help us be as successful as possible, so the whole network is as healthy as possible. And that's all there is to it. It's just a good collaboration between node operators and Chainlink.
Yeah. And they've built some really good software. I mean, the metrics are all solid. The logging's great. So if you take the time and you have the passion to dig through everything and find out exactly how things work, what you need to monitor and why and when, then you have great monitoring and you know exactly what's going on your nodes. And so I think, especially all the collaboration between node operators, we've all built slightly different systems, but we all know exactly what's going on. And so, the redundancy and the responsiveness is, second to none.
No, it's good because even though between node operators, everyone does things in a different way. I mean, that is decentralization by aspect, right? Because we're all looking at the same problem and coming up with different solutions for how we want to manage it at scale. As teams that have been working day to day with Chainlink for, many, many years at this point, I think, for me and a lot of people and people in this audience, seeing the scale of Chainlink over time has been, unrecognizable, at scale, right? I mean, from the early days of running Chainlink nodes where it was just on Ethereum mainnet and a handful of chains and you'd just be managing gas on Ethereum mainnet and some of the big incidents back then versus what it is now, is, night and day difference. So, we've been at SmartCon and seeing everything that's going on and a lot of the, push for TradFi and actually, institutions using crypto. From your point of view, what is some of the things that you're most excited for seeing as a node operator just in the future of Chainlink and even outside of Chainlink, what that will enable, within this industry?
For me, it's privacy. Yep. I was super excited yesterday, looking at Sergey's talk on the privacy work that is happening, because without privacy it's impossible to have proper financial markets. Mm-hmm. I would say even social interaction, it's on chain. You have to have privacy because otherwise why would you operate in that system? I think that's the most important aspect that is coming up. The CRE makes it all super simple. to do extremely complex stuff. So sometimes it's like you'll see, oh, they're simplifying everything. Underneath, it's extremely complex.
Yeah.
So if you look at what the other networks have to go through to reach the same level, I don't think they do reach the same level of efficiency with the CRE that has been built.
Okay. Yeah. I mean, like, if you look at it, Chainlink has a set of services that each have proven themselves. So you have like automation, data feed, CCIP, everything has a clean track record in production. And now the most exciting things is essentially the Chainlink runtime environment that like brings everything together. And then you have like that one gateway to do anything you want, to get any data you want or publish any data on chain that you want to. So how that environment brings everything together from all of the legacy services we have is something like I personally am really looking forward to.
Yeah, I couldn't agree more. I think the biggest challenge for going forward now that this is all done is getting the degens and the TradFi people to actually talk to each other. Because I think that's maybe the most difficult thing to achieve. But yeah, CRE is opening up so many opportunities that I don't really think people really realize what is possible right now. Because I think there are no limits anymore. You know, we've successfully bridged the gap between on-chain and off-chain. So it's up to you and to everyone to see what we can do with it.
Yeah. And I think one of the most underrated things right now too is I know for a lot of these institutions, like they didn't want to pick a chain, right? Exactly. And they didn't want to try and pick winners and losers in that space. You know, a lot of them are running these private permission chains for their own uses, but they do want to be in the permissionless world as well. And so now they don't have to choose. Nope. They can just, we'll run everything on CRE. Now we're on every chain. We're not picking winners and losers. We're not tying ourselves to a particular environment or ecosystem. And, you know, and then you add the privacy in and, you know, here's something they can actually work with. And it's been sorely needed. So I think even, you know, us being right at the forefront of that, you know, I think we even underestimate what is going to be possible in the next 5 years. Like it's going to be very busy, very interesting. So I really look forward to that. But I think people are still, even the people all here who are all very excited about it, I think we're all probably underestimate what can be accomplished.
Yep. I mean, I definitely agree regarding the CRE. It's one of them things for me where I saw the technical documentation and was looking at it, and it's really seems more of an end goal state for Chainlink and sort of lays the foundation for how like off-chain computation, a lot of sort of oracles and services will be built upon in the future. You know, giving developers access to be able to essentially write anything that they want to do in familiar programming languages and being able to use that and to essentially run anything they want. So for the people, you know, potentially watching online and in this audience, if you was to give any advice for people wanting to, you know, like join this industry and run validators and sort of become part of more networks, you know, how would you encourage more people and sort of advice that you could give? Matthew?
I think bring passion to it, because it's going to take you passion when things go wrong. It's think of the worst cases, scenarios. It's hard to do that beforehand, but like and stick to like what you're good at, because if you do too many things, it's just impossible.
Yeah, makes sense. Like I talk with a lot of the community people on Discord and like Telegram. Over time, like what I've seen happening in the community is that people see joining the validator business or like the node operator business as a side job where like they do it part-time, and that just like doesn't work. If you want to be like successful in Web3 and the broader ecosystem, you got to go at it full-time. You got to specialize in one subject matter, and then you have to find like-minded people that you can collaborate with, and then you essentially make an elite team of people that each specialize in their own sector, and they all add on to each other, and then you have like a whole team. And that way, if you all like focus on it, you can just like grow yourself, connect with other people, go to like events, and then steadily while like learning from other people, you could grow yourself.
Yeah, I agree. I think trying to think of something new, but I think what
I think, if I may, I'd like to give an example of what like level of excellency means. So back to the March 2020 example, right? We were a bunch of node operators, and you need to make sure that the price feeds get on chain. You put transactions on chain, the gas spikes, and this transaction is not going through. So you're there in 2 a.m., 3 a.m., whatever time it is. You have to revert transactions, try to figure out, can I add, what amount of gas should I add for this transaction to actually go through? And what transpired, I think, in that week was that something kind of interesting, that the node operators for Chainlink at the time on Ethereum were amongst the top gas guzzlers in the world.
Oh, yeah.
So we were spending a $250,000 a day on gas fees just to put like transactions through. That's the level of dedication that is required. And the level of excellency that the Chainlink set and company showed from the beginning. Yep. And I think that's why we have the Chainlink that is today, because that like level of excellency is just ingrained within the ecosystem, within the team.
Yeah, and it's provide value, right? Yeah, it's easy to spin up a piece of software and then not pay attention to it. But if you go in and you're digging through debug logs and you're really understanding it on a totally fundamental level, just as well as the people who built the thing, then you can actually be valuable to them. And if you're trying to spin up validators, you're trying to join networks, that is definitely required. And you can demonstrate that you're a cut above the average node runner, quite easily. I mean, simply, I should say, not easily, because it requires a ton of work. But if you have that passion for it and you like hunting, bug hunting and troubleshooting, then you can actually provide a ton of value, and that builds your reputation, that gets you invited into new networks, and it all snowballs. And I think generally as infrastructure providers, we've seen the cream really rise to the top, where some people just, them or their teams, they're not passionate, they're just not cut out for it. And if you're not willing to do the 24/7 thing, then maybe think about something else.
It's worth stating, right? Like, to think of the 2020 example and even the more recent incident. For any time there's like large volatility or something big happens within the industry, everyone is glad and would applaud like Chainlink not having any downtime and being flawless, over the period that it's been online. But for every one of them incidents, right, you've got tens of teams everywhere around the world on 24/7 rotors. Like, all of us guys will be awake, like doing something at that point in time, right, and making sure like everything stays online. And it's amazing, really, because it's never really been any issues over the time that we've been online, to the point where it would actually cause issues to the Chainlink network, just because of the skill and the caliber of the people on stage right now and the teams that we've built over time. I think of the 2020 example, right? It was like the amount of gas needed to get transactions on chain, and it was like one of them things, you just throw an ETH at a wallet, you press in F5, and you're like, oh, that's another 5 ETH gone, or another 10 ETH gone there.
But the resiliency has improved so much too, right? I mean, I think now, like, we all know what's going to happen in those events, and everyone's pretty prepared. Like, everyone's got Ethereum ready to go. We know how to get things back on. The network itself, the software has gotten more resilient. And so I think every time one of these things happens, it just strengthens the network. And I think it just proves that it's not going to go down.
Yeah, you can see the total. I think what happened was it 8 billion was the biggest reference ever?
20 billion.
The recent one, it was 20 billion.
Crazy amount. But if you look at like the gas spent and stuff like that, that goes down, I guess.
Yeah.
It becomes easier, even though the damages are bigger. Interesting.
Yeah. I mean, that's a testament really to the, like the engineering teams of Chainlink Labs, really, and the developments that have come on within the Chainlink network over the years that it's been online. Like mainly like OCR and, a lot of the developments that they've done with like the aggregation protocols and how transactions are, like written on chain, which is excellent. But sort of just ran out of time. So would like to thank everyone and the guests on stage right now. Great set of guys, and appreciate it all. Thank you.
Good morning, everyone. Thank you for joining this section today. This section will talk about the trends that will define 2026. But before we get started, let's have an introduction for the very strong panelists. So my name is Owen Lau. I work at Clear Street. I am an equity analyst at Clear Street.
I'm Theo Fields. I'm a partner at Blockcelerate VC. We are an early stage VC fund investing in what we think will grow the on-chain economy. And then hopefully those companies also become valuable themselves. We invest in business and technical infrastructures.
Well, I'm Reshari Mascari. I'm head of product and research at Grayscale. We are the world's largest crypto-focused digital asset manager. We have about 30 billion in AUM with a 10-year operating history. And we are very excited to bring compelling crypto exposures like Chainlink to investors.
Hi everyone, my name is Wicho van der Poppen. I am from Amsterdam, the CIO and founder of a venture capital named MN Capital, and also a liquid fund, MN Fund. And I'm also the host of New Era Finance podcast, where we had Sergey on the show.
Hey everyone, I'm Spencer, the managing partner and co-founder of Blockspace Force. So we are a crypto native investment advisory as well as a licensed fund management company based in Singapore. We first spent a lot of time really at intersections of all things DeFi, crypto, and really just spend a lot of time these days as well looking at the equity space that concerns crypto underlying, whether it's operating companies, whether it's digital asset treasuries, or anything of that nature as well.
Fantastic. Thank you for the introduction. Before we get into the 2026 trend, I do want to reveal the 2025 trend. So what I recount there are a couple of key trends that we saw, including AI, debts, prediction markets, staking and privacy, on-chain perpetual swaps, RWA, regulation, and stablecoins. So there's a lot in 2025 to unpack. So why don't we go ahead, Spencer? Why don't we go from there? And then why don't you start to give us maybe one or two trends you saw in 2025?
Yeah, definitely. There's so many trends that are super interesting for us. Obviously, the first thing that we spent a lot of time this year is really the intersection of crypto as well as equities, specifically digital asset treasuries, and a lot of these kind of players that have emerged onto the space. We've also seen a lot of innovation in a Bitcoin ecosystem, overall, just in terms of scaling solutions, infrastructure, and so on. And we spent quite a lot of time looking at a lot of these potential interesting things. There's some really good research right now that some of these projects like Babylon has just published on trustless vaults for lending and so on that we are pretty excited about heading to the end of the year. And of course, what we have seen as well is just so much interesting new applications that people have been, using. Just like yesterday, of course, in New York, where we are today, we have a new mayor that's elected, Mamdani, and some of these prediction market companies like Polymarket, Kalshi. If you look at the markets over there, you actually see that there was actually quite a robust prediction market for that particular event. So of course, we'll see a lot more of these interesting things as well. But yeah. Definitely, those are the things that we paid attention to.
I think we just had elections in the Netherlands, and just 20 minutes before the actual results came out, the prediction markets already knew the outcome. So it's interesting to see that trend. But within MN Capital, we have been focusing on mostly of DeepIn. I think that the existence of DeepIn is not where it should be at, but where it could be going to. I think the pure future of blockchain is essentially providing value to anyone. And I think that the connection between robotics, AI, and DeepIn is going to be a big player into 2026, but has been interesting in 2025 in some parts. I think that's the one that we're going to focus on.
So I'll piggyback off that. I definitely think AI, the importance of data as a resource in the age of AI, the data infrastructure, the compute. I think we're going to continue to see a lot more of that. I think there's a broader narrative around concerns around the proliferation of AI. And some people, at first blush, it seems like, are AI and crypto and blockchain, are they antithetical necessarily? Because people think of AI sometimes as more centralized and authoritarian. And we all know that, blockchain is not that. But I do think that it's one of the use cases where there's a real opportunity to ensure that the proliferation of AI is transparent and egalitarian. I think DeepIn is going to continue to be really exciting. I personally love to see projects that are linking blockchain infrastructure to the real world systems and doing something. And then, putting on my traditional finance sort of institutional investor hat for a second, I think staking is really big. We now are in a world where crypto is an income generating asset. We are staking in our Ethereum, on our Solana ETFs. And so for me, staking is a big priority.
Yeah, one thing, a trend you mentioned that no one else has discussed so far is stablecoins. So 2025 was definitely the year of stablecoins. We got stablecoin legislation, but it's also important to note. I don't think I heard a lot of noise about this, but early in October we crossed 300 billion of on-chain stablecoins. That's a huge number, but I think when we look back, really we'll say that this was actually the Netscape era of stablecoins. I think we still have a lot that's happening. So we have ARC that will be coming live soon. We have Tempo. Dan Crud just left the Ethereum Foundation to go join Tempo and work on the Stripe stablecoin chain. We have Tether with Plasma developing their own chain. At the same time, we have every bank and every institution who's here is working on stablecoins in some way. So I think we're going to say 300 billion. That actually was like a laughably small number when we look back in a year or two.
So it's hard not to talk about macro, how that macro impact the whole industry back in 2025. Where you work at Grayscale, I guess you have some comments on that. Can you talk about, how do you think about the macro backdrop impact the whole industry, or the thing just talk about in 2025?
Yeah, so I think that we have, 2024, 2025, big years. I think from a macro perspective and a fundamental perspective, again, the proliferation of ETFs as a demand driver is huge. I think for the first time ever, we have a regulatory and administrative backdrop that is tremendously supportive of crypto and blockchain technology. If you had told me when I joined this space in 2018 that the president of the United States would be printing meme coins on blockchains, I would have laughed. And so I think from our perspective, and we're all watching prices. We see a little bit of choppiness right now. There's some concerns about strength in the dollar. There's some concerns about, weakness in certain sectors of the economy. But in general, the backdrop continues to be strong. Again, we are in a new regulatory era. And the economy is not falling apart. And the pillars that, again, from a crypto perspective, make this such an interesting asset class continue to be there. So you have, again, for some tokens, store of value, you have the technology upside, you have infrastructure, and then it just continues to be an uncorrelated asset class. So from our perspective and what we're hearing from investors, it's something that they continue to be excited about. And I will, we might have a different question about this, but I do think every time, I have this conversation, people ask about the cycle and where are we in the cycle? And we tie this idea of growth and, just price to these dramatic swings around Bitcoin's halving cycle. And I think it's time to kind of move forward from that. I think that if you look at where we are today from where we've been historically for the last cycles, how many times has Bitcoin died? We just have made such strides from an institutional adoption, from a regulatory backdrop perspective that I do think it's time to kind of transcend the cycle thinking. And I think it's kind of a self-fulfilling prophecy. So for as long as we're sitting around waiting for the cycle to end, and that's informing investor behavior, we might actually see that manifest in the market.
Let's spend some time more on the cycle and when Bitcoin will die later on. So before that, let's get into more interesting question, which is looking ahead in 2026 or moving forward. My question is, what is the single most compelling, obvious narrative that has the potential to break out in 2026? Theo, why don't we go first and then we'll go over there.
Yeah, I think that everything, a lot of the different components of what you might consider finance are converging. I think we're going to see that these finance super apps emerge. Right now, Robinhood has started doing sports betting via prediction markets. I think we're going to very soon see a future where if you want to make a 3-leg parlay, you have to either take less leverage on your perps position or onboard new funds, or maybe sell some of a certain asset, right? I think we're going to end up with these kind of super apps, and everything the prediction markets, perps, your standard investment kind of brokerage account I think all of that comes together and actually probably in the next year or so, and at least the first iteration of what that looks like.
I have a few things. I think the one, since I've been asked for one, I'm going to say that we're going to see a lot more in terms of staking and how we're translating that into investment products and how that's going to inform how digital assets are viewed as an asset class from an investment perspective.
Well, be bid. I think overall 2026 is going to be the year that we look back at maybe the crypto.com bubble type of thing where we onboard a lot of users through improved UX. I think a lot of parties have been building the super apps or anything that's a dApp that finally can onboard the people that are not really integrated into MetaMask and paying gas fees and all those things. So I think that we're going to onboard the next billion users in the next 1 to 2 years, and that will create a lot of hype and growth. So I think UX improvements are going to be the big trend, yeah.
So yeah, I think from my perspective, one metric that we actually track is just looking at some of these crypto operating companies like Coinbase. We've recently announced their earnings. If you look at the earnings, in 2021 and today, they have roughly the same amount of NTUs, monthly transaction users, which is actually quite a broad classification of how active a user can be on our platform. And we actually see the number stagnate for the last 4 years. From 2021 is 9.1 million, 9.5-ish. Now we're still at about 9.1 to 9.5 million. And I think I really want, from our perspective, 2026 to be a year where we actually see that to maybe be at 100 million, right? And the question is, how do we get to 100 million, right? I think it's really about, if you look at the growth of some of these applications, like AI applications, like ChatGPT and so on, they've really hit this like retail consumer scale. And I really want some of these new developments that we're seeing, whether it's the Asian protocols, whether it's some of these other retail focused applications or social or whatsoever, to really help us to kind of get crypto even more into the hands of people who are using it on a day-to-day basis in the US and of course beyond in the world. So that will be something that I'm super excited to see in 2026.
Fantastic. So we just talked about some obvious predictions that maybe you guys have thought about. How about some of your highest conviction, non-obvious predictions in 2026? Spencer, why don't you go first?
Yeah, sure. Definitely there's like so many things that are kind of like, floating in my head. But I'll just say one thing that I'm, really interested in seeing is just how essentially we can have even more interesting, unique hobbies to be represented in the crypto ecosystem. We're already starting to see some of that. With that, for example, Magic Eden as a platform has now rolled out this ability for you to open Pokemon card packs, streaming and so on. And I think some of these more Gen Z kind of activities, we'll love to see more of that. We'll love to see more video content that relates to crypto and Bitcoin. We haven't seen enough of that. I feel like we've only seen some ads or some interesting campaigns by bigger companies, but we haven't just seen some really good content from micro influencers and just regular communities.
I think NFTs are going to be bigger in 2026, 2027. I think it's kind of like the pushed away after the big bubble in 2021 with the profile pictures. But I think the technology itself will be integrated in a lot of DeFi contracts and a lot of workflow. So I think that the technology behind NFTs are going to have a big surge again, which something maybe for 2026 or 2027.
So my thought and my hope is that we continue to see more in terms of cross-chain composability. That's something obviously that Link is doing. I think that there are narratives like meme coins and prediction markets and NFTs that have gotten a lot of hype in the past and continue to be important because they are just very front and center in terms of the zeitgeist. But I think that we've all kind of been sleeping on a lot of the infrastructure build that has been going on. And so I think that perhaps 2026 could be the year of utilities and the picks and shovels that have quietly been building and connecting everything from, within crypto and between crypto and the real world, allowing hopefully crypto to eventually, fulfill more and more of its intended use case. I think that we'll see hopefully more of a narrative emerge around that.
I'll cheat and give two. We're long-term investors, which means that we're not very good at timing things. So I will actually say one that I think will definitely happen in 2026, and then one that probably is a little bit longer time frame than that. In terms of 2026, Michael alluded to this earlier. UX improvements, I think, will drive significant changes. My prediction is that we will actually see smart contract wallets flip traditional EOA wallets. So right now we have several 100 million traditional EOA. Think about your normal MetaMask wallet. That is because, I mean, I'm sure almost everyone in the room, probably everyone in the room has one of these wallets, but we're all kind of on the fringe. We're all early adopters, maybe hobbyists, like people who really are uniquely motivated to be in this space. Most people aren't like that, right? And so once they get into the super apps, once you have something like staking in your Robinhood account, that will probably be delivered in some ways, not necessarily staking exactly, but in some, like a lot of the products will actually be delivered via smart contract wallets. Yes, last year, the Stripe acquisition of Bridge was a huge piece of industry news. Less noticed was Stripe also acquired Privy, a smart contract wallet company. I think that will become huge, and we're going to see a lot of smart contract wallets in 2026 to flip EOAs in terms of pure numbers of accounts and in terms of volume. So that's my short-term prediction. Longer term, something that I pay attention to quite a lot is quantum. I think that quantum computing actually will be revolutionary, not just for our industry, but overall. So I think that you see within crypto, everyone's worried about quantum breaking elliptic curve cryptography. What does it do to Bitcoin when the first quantum attack happens? Yes, obviously that's very important, but also almost all internet traffic is encrypted. Everything important, every enterprise transaction, almost all data transfer on the internet is encrypted. With standard cryptography that can be broken by quantum. So when and if that happens, most internet traffic will need to move to post-quantum cryptography. So there's actually second order effects to that too. That will mean more processing power is needed. So we'll again have kind of a GPU shortage. More actual power is needed. We'll again have electricity shortages like we're having already for the AI boom. So I think that could all happen around the same time. I think that quantum will be just change the surface of the internet in a lot of ways that we don't really see. And it has really important ramifications for crypto. So those first and second order effects, probably not 2026, but probably before 2030.
Fantastic. So I want to go back to what Ray just said about the 4-year Bitcoin cycle. How does that shape the narrative you just talked about? Has the industry decoupled from it already? Or, I think the fundamental question is, I got this question a lot. Do we still have that 4-year Bitcoin halving cycle? I know Ray have some comment, but anybody else wants to comment on this before we go to Ray?
Yeah, I would kind of share that I think cycles, in my perspective, is normal, right? Think of it as like a wave, right? Like, when you're surfing in the ocean, you don't always see the peak of the waves to be at all times. It's just kind of energy flows, right? And I think in general, whether it's crypto or other ecosystems, there's always these cycles where people's attention flocks to something and then it goes to something else. And I think the Bitcoin halving cycle is one representation of that, right? So yeah, I think in general, we're not a huge fan of looking at cycles, but that being said, sometimes these cycles is undeniable. And I'll just maybe quote some people like Chris Bernisky and some of these other folks who have, I think over the past couple of months have called hey, this cycle has been a little bit long, right? We're maybe overdue for a bit of a correction. Obviously, it's easy, with the data yesterday to kind of say, hey, I told you so whatsoever, right? But I think overall, I think structurally, we're still very, very sound as an industry. It's just that we're maybe in some level of let's maybe reassess some of these things that maybe we're super hyped about recently. And let's see how we go from here.
I think, to be honest, the entire 4-year cycle is a Web3 created narrative that is completely non-existent anymore. The reason for that is that we have so much capital, institutional capital flowing into the markets that have a bigger impact than the halving. I think there's a big disconnect by these type of conferences and the prices. I think crypto as an entire asset class is heavily undervalued at this point, and it's the only asset class that can still generate a return for investors. Commodities and stock indexes are all up to the all-time highs and going vertical. On the other hand, a lot of the projects that were going live, token specific, have gone live on a valuation that is completely ridiculous. So they need to come down to a real value that actually makes sense. And from that point, we can start building again. So these two are actually combining. I think going into 2026, we will see that a lot of people will be surprised by the fact that this cycle can be longer than a 4-year cycle. Ray?
Well, I think everyone knows what I think, but I really agree. I think that cycles don't die of old age. And I think that the stories in life and investing and otherwise, the stories that we tell ourselves are important. And so, I'm a proponent of, yes, of course, Bitcoin is going to be halving every 4 years. Of course, there's going to be natural ebbs and flows of energy. Certain sectors are going to be overvalued, undervalued. But the idea that we all wait and hold our breath and experience fear about the end of, interest and investment and, building in crypto for a period of time is very like I love Game of Thrones, but I do think of like the long winter. I think we have an opportunity, again, given the broader picture, to kind of take a step back and think about how far we've come, and to, again, just it's time a little bit to transcend the narrative and to stop sort of telling ourselves this 4-year crypto cycle story.
I know. Yeah, I'll just say that I think people often look for one clear kind of cause and effect, and the reality is often more complex than that. So I think that in the past, there was kind of a traditional halving cycle. I think at some point we did slip into maybe more of the global liquidity cycle driving prices more. But then there's also things like natural hype cycles and interest, right? And so people got interested, ETFs happened, lots of new capital flowed into the space. And so that also drove a lot of activity, and that's not necessarily going to be cycle bound. So I think that it's hard to really assign cause and effect. And I think the cyclical nature of things isn't necessarily just one single cause.
Sounds great. So I don't think we have, I think we have like a couple of minutes left. Maybe my final question is, I like many Web2 business. I think they are fantastic companies, but we are going into Web3. My question to you guys is, which Web2 business model do you think it's most ripe for disruption from one of these emerging technologies you guys just talk about over the next 3 to 5 years, and why? Theo, why don't you go ahead?
Yeah, I'll start with just the obvious one. I think everyone's focused on banking and stablecoins. In the last year, or actually last few months, we've had a new stablecoin bank, Erebor, that got OCC conditional approval in record time. That's Palmer Luckey's company, backed by Peter Thiel and other folks. I think that obviously banking will be changed by stablecoins. I think all the banks acknowledge this. I think everyone's investing in this. How that works and whether or not any of us will actually see yields on our stablecoins is a different question. But no matter what, banking will change pretty dramatically, I think, soon.
Thanks. Ray?
I'm thinking centralized file storage and compute. I think that you have incumbents like AWS that are far more expensive and in certain cases inefficient. And so I think that's a space that's ripe for sort of decentralization. And there's compelling projects that are doing things there, like Walrus, for instance. Filecoin's been doing stuff for a long time. So I'm going to go with that one.
Axel?
I think essentially almost all service providers. I think yesterday Sergey gave a keynote about CRE, and I think the integration of AI agents and blockchain will basically disrupt accountants, consultants, or anything that takes time by a human being. So ultimately everything will be automated and therefore faster and more efficient. So essentially all service providers in that case.
Yeah, I'll say maybe like, for me, my point of view is maybe like marketplaces, like whether it's like the Airbnbs or Ubers. Obviously, crypto and, our industry hasn't really made much of a dent in those ecosystems yet, beyond maybe like accepting of payments or whatsoever. But I do think this model of like having to rely on a centralized party to essentially instill trust to bridge two parties, that is actually a perfect use case for contracts. It's a perfect use case for crypto economics and so on. And I think, John of Optimist also recently published this narrative about how maybe some of these blockchain networks should be positioning themselves more and measure their metrics more like a marketplace, because they're essentially creating, a two-sided demand or three-sided whatsoever between these various stakeholders, right? Developers, users, and so on. And if we start thinking more about it from that perspective, maybe we can become a little bit more metrics driven. We can also start thinking about fee revenues and so on, and start to essentially create more impact for the world.
Sounds good. I think it's a good time to end. I think we're about time. Thank you all. Thanks a lot. Thank you, Spencer, Michael, Ray, and also Theo. Thank you very much.
Who here today is working on the tokenization side of RWA? So you're helping to bring financial products into our industry. Anybody? Maybe one or two, a few. And so who who's working on the other side of that? So who's working in DeFi and you're working with RWAs in your platform, or you're working to bring RWAs into your DeFi platform? Anybody out here? All right. So everybody's welcome to join the discussion, of course. I'm Wormhole, and I'm the founder and CEO of LlamaRisk. LlamaRisk is a DeFi risk manager, and we work with some of the biggest names in DeFi, like Aave. So you're probably familiar with Aave. We help them to secure around $35 billion of TVL. And in the course of our work, we often work closely with asset issuers to help them to find ways to safely and to successfully bring their products into our industry. So to that end, today, I'm going to be talking about risk-managed oracles, our product LlamaGuard Nav, and how the work that we're doing is helping to bring down the barriers of adoption and to accelerate the growth of RWAs into our industry. So at this moment, RWAs are poised to redefine our industry. And we've been seeing over this past year, there's been tremendous growth and interest of tokenizing financial products across a variety of categories. And that growth rate is continuing to accelerate over this year. But at the same time, if we look over here at the total addressable market, it is enormous compared to what's been tokenized so far. So the growth continues to be a big opportunity. But at the same time, there continue to be barriers to adoption, and we're seeing a difficult time to integrate RWAs into DeFi. And many of you are probably familiar already with what the core of that problem is. It stems from a problem with composability, that these are highly regulated assets, and it makes it very difficult to integrate them into DeFi. Because of this highly regulated, whitelisting is usually required. There's little to no secondary market liquidity for these assets on chain. And we often rely on the asset issuer themselves as the single source of truth for the fair value of the fund. So that's the NAV of the fund. And typically an asset issuer will work in collaboration with a fund administrator, and they'll be making NAV updates on a daily basis or several times a week. But ultimately, at the end of the day, this constitutes a single point of failure. And we've observed historically that there have been errors in NAV reporting, and we can be exceedingly sure that in the future, this is going to continue to happen because of this centralization vector. So you can see here an example of an asset issuer whose daily NAV reports typically fall within the narrow range of what we would expect for the underlying assets of that fund. But occasionally, they give these extreme reports that are far outside of what we would expect, and we can only explain them as an error in NAV reporting. You can see another example of anomalies here. So the reason that this is important in DeFi is because when we use pricing in DeFi, we are using that to determine what's the borrowing power that this collateral should have, and what's the price point at which users get liquidated. So if we get an error in reporting, that means users get wrongly liquidated. That means a protocol can become insolvent. It's a critical failure, and we can't allow anomalies to occur in the first place. So this is why we bring the case for risk oracles and why we believe risk oracles are the future of oracles. This is a data reliability problem that I've been describing, and we can address this problem. We can overcome it if we view it through a risk management lens. So if we look at the protocols that are using this data and we see how are they using the data and what's their tolerance for error, what are the failure modes if we exceed those tolerances? And likewise, if we look at what is the protocol using this data, what's its capacity for or its capability for managing risk? What sort of parameters can you change? What sort of circuit breakers can you introduce? And then we can develop a risk oracle that serves the needs of the protocols that use this data. And so a risk oracle, So a risk oracle is as you can see here, very similar to what we're already familiar with price feed oracles. The type of data that Chainlink provides, we take as our source input data here, data which is quantifiable, objective, highly reliable, and we feed that into the risk oracle. And the risk oracle performs some kind of off-chain computation, and it's implementing a risk management methodology with the intention of executing one or more pieces of data on chain for the protocol that's integrating it. And that could be risk managed pricing, and that could be emergency risk response or some kind of risk parameter change. So CRE is the platform for building risk oracles. LlamaRisk has found a great symbiosis working together with Chainlink, and we're proud to be one of the early integrators building on Chainlink CRE. And there's a few reasons that we're building on CRE. So the first one is superior user assurances in terms of transparency, immutability, decentralization. So nowhere in the workflows that we're running is LlamaRisk inserting ourselves as a single point of failure in the operation of our risk oracles. So we don't have the authority to arbitrarily change the logic of the workflow or to stop the workflow from running. That's all run on the decentralized network of Chainlink nodes running on CRE. And secondly, we can move very fast. So because we have a separation of responsibilities and data infrastructure is a very difficult problem that Chainlink does very well, it allows LlamaRisk to focus on our core area of competency, which is developing sophisticated risk models. And we can design and implement systems very, very quickly because of this. And thirdly, we avoid a structural conflict of interest. So you could imagine if we were to deliver an all-in-one risk oracle solution where we define what are the key inputs and what's the quality of the data that we use, and we define how that's being processed within the risk oracle, and we determine if, when, and how that gets pushed on chain, then and we have unilateral control over the entirety of the process, that constitutes a gross potential for conflict of interest. And traditional finance has learned long ago, you manage this conflict of interest potential by having a separation of concerns between distinct entities that have clearly defined roles. And that's what we achieve here with Chainlink CRE. So we're able to have CRE as the objective, unopinionated data infrastructure, and LlamaRisk brings our opinionated risk management methodologies together. We bring them together and form a more trustful solution. So with all this background context, I'm proud to introduce to you all our product, LlamaGuard Nav. So LlamaGuard Nav in its first version is already live in production, and it's powering all of the Aave Horizon lending markets. You're probably already familiar with Aave Horizon. It's shaping up to be the preeminent platform for the convergence of TradFi and DeFi today. It's an RWA lending platform. And it's already securing over $500 million of TVL in just the first couple of months it's in production. So it's growing very, very quickly. We're currently working with the Aave Labs team at Aave Horizon to upgrade to the CRE-based version of LlamaGuard Nav. So if we take a look here at the architecture of what we've built, LlamaGuard Nav is basically two things. So it is anomaly detection through risk-managed bounded nav feeds. And secondly, it's emergency response. When we have detected anomalies occur, then act upon it. So it starts here with the nav report that we get directly from the asset issuer themselves. That gets fed into our CRE workflow. So within CRE, this is where the majority of our logic happens. This is where we implement our bounding logic. We take as our secondary input over here the parameters from the parameter registry. This is an on-chain contract. It is publicly verifiable, and it contains all of the individual configurations of all the assets that have a LlamaGuard Nav feed. And we set those configurations according to the underlying assets and the nature of those underlying assets and their expected behavior. So when CRE is executing its workflow and it's ready to push data on chain, in the happy case, it'll push the price update as it's collected from the asset issuer themselves, and that can be read on chain just like any other Chainlink price feed. In the unhappy case, where we've detected an anomaly, we bound the price according to our methodology, what is the safe bounds, and we push that value on chain. And simultaneously, we initiate a market freeze event. And that goes through the Aave Horizon Risk Steward. So the Risk Steward is a unique capability that Aave Horizon has to manage risk and to delegate risk management to a third party. In this case, it's delegating the freeze functionality to LlamaGuard that's running on the CRE workflow, completely automated solution. So if we look more closely at the bounds logic that we implement, we use dynamic bounding. And this is because the types of assets that we're working with, debt instruments, typically they're yield bearing and typically they're increasing in value over time. So because they have a fluctuation in value, we need our bounds to be able to be adjusting to that change in value without any manual intervention. Secondly, as I mentioned previously, the bounds logic is conforming to the individual characteristics of the what are defined in the parameter registry, and that determines how closely the bounds are to the NAV reported by the issuer, and how it fluctuates according to changes in NAV. So when we're thinking about applying bounds logic, we have to think about a balancing act between two things. We want the bounds to be wide enough that it allows for the organic fluctuation in the fund's NAV. And you can see as an example here, we're looking at USCC, and this is from Superstate. It's a crypto carry trade fund, and it exhibits higher than usual yield and volatility properties. So we need the bounds to be able to fluctuate with the changing NAV without triggering any kind of false positive. At the same time, we want the bounds to be as tight as we can make them, because the more tightly we set the bounds, that's more stability that we can guarantee to the protocol that's integrating it. So if we set the bounds very tightly, that means less likelihood users can possibly be liquidated wrongfully because of a mispricing, less likelihood that a protocol can become insolvent due to a mispricing. And the more we can push the exposure of that collateral on the lending platform. So ultimately, a platform that's implementing a solution like LlamaGuard NAV is able to be more competitive in the DeFi marketplace than a protocol that is not using LlamaGuard NAV or is using an inferior risk management solution. So we go one step forward, and we take this risk awareness we've gained from the anomaly detection, and we convert it into an actionable risk response. So in the case of Horizon, this means that we are executing a market freeze event. And that means for Aave Horizon, reduce borrowing power to 0 and reduce additional supply of collateral to 0. But at the same time, existing borrowers can repay their debt, they can withdraw their collateral. And because of that feature, we consider this to be a minimally invasive design, and it's an acceptable proactive measure for managing risk, allowing a manual review process to take place and determine whether we need to change any exposure of that collateral going forward. So what I've described here is our solution for Aave Horizon specifically, but actually, what we've implemented is a solution for all of DeFi. So if you're a DeFi integrator and you're working with another DeFi protocol and you want to use risk-managed data, you can simply read LlamaGuard NAV feeds just like any other price feed from Chainlink. And if you want to use anomaly detection to take risk management action, you can do that. It's a matter of creating a custom risk response module, and you can interpret our bounds breach state into an actionable response depending on the capabilities of your protocol. So if that's something that interests you, you can come talk to us. Our team of developers can help you to design and implement a solution that is appropriate for the capabilities of your protocol. So what's next for LlamaGuard? What I've described here is just the beginning of what we imagine LlamaGuard will be. We imagine that LlamaGuard will be an expansive risk oracle suite for a variety of different asset categories, for a variety of different use cases that help to propel those assets to new heights in our industry. So right now, we have our sights set on equities. This is the next category of asset we'd like to introduce to Aave Horizon. And it has these assets have specific challenges that we need to address. So firstly, they're highly volatile, and we need to be able to address that. They have market closures. They're closed on the weekend and on holidays. They have stock split events, and they may or may not have an on-chain secondary market compared to the off-chain exchange market prices. And thanks to the expanded suite of data that Chainlink provides, they give us all this data as a sort of data toolkit. And we can implement all of these pieces of data into risk management methodologies that we can use to safely onboard stocks into DeFi and into platforms like Aave Horizon. We can do things like reduce the borrowing power of the collateral over the weekends or when markets are closed. We can proactively freeze markets around a stock split event when we are concerned that there might be a dislocation between token supply and pricing that's delivered on chain. We can detect price dislocations between the off-chain and on-chain pricing for the asset to determine if there's any manipulation or some kind of stress event. So this is an example of where we're going next to bring more categories of assets into DeFi. And if I can If I can give just a moment of my own personal philosophy, I got into this industry because of Chainlink, because of the Chainlink vision. And I was captivated by the idea that we have a new ecosystem that's forming, and it's called DeFi, and it represents a fundamental upgrade to our financial system. So at the same time, we have an existing financial system that already powers the global economy, and it's worth hundreds of trillions of dollars. So we, as the DeFi industry, would be foolish to go off in a different direction and create a new ecosystem completely divorced of the real economy. We should be doing everything we can to strive to bring the two together for the benefit of both. So to all the asset issuers out there, we want to help you to be successful in DeFi because you are the lifeblood of our industry. And so it's our mission to develop products that help your assets become successful and to find integration success in DeFi. So come talk to us how we can help you achieve that. And lastly, we're hiring. So if you are a quantitative researcher, if you are a front or back end developer, if you're a risk analyst, and the vision that I've just explained here is something that resonates with you, and you think that these problems of solving risk oracles sound exciting and you want to help us to bring that into reality, then come talk to us. Visit our careers page, llamaris.com/careers, and let's achieve the convergence of DeFi and TradFi together. Thank you.
We're going to talk today about something I'm super passionate about, which is AI, and particularly how AI technology is going to integrate with our lives in finance, and hopefully go all the way through to kind of integrating with blockchain and really kind of changing the future of on-chain finance. I think would like to leave the conversation pretty open-ended today. AI can go in any direction. People have heard millions of talks about AI before, but let's just kind of see how it goes. The only constraint I want to put around it is a bit of a timeline. Let's look about what's happening today, what we've seen work, and then kind of project forward into what we see going to happen and kind of how we think the future is going to play out. You both have really interesting and unique vantage points on this problem. And so in order to set the tone here, let's do quick intros of who you are and the companies that you work for and what you're responsible for. And then particularly the problems you're focused on. Andy, if you could lead off, that'd be great.
Yeah, absolutely. So thanks, James, for having me here and great to see everyone. So my name is Andy Kangpan. I'm the founder and general partner at MetaLayer Ventures, which is an early stage crypto venture capital firm focused on supporting entrepreneurs building at the intersection of institutional finance and the blockchain industry. Before that, I led digital asset investing at Two Sigma Investments, which is one of the largest quantitative investment manager in the financial services industry. That's the quick background on me.
Awesome. Anka?
Yeah, firstly, this thing's pretty cool. I was just talking to someone from my team. I was like, if I'd known about this, then the offsite we're having in a couple of weeks, we just use this for all our breakout sessions. So already learning something here. But yeah, I'm Ankur Prasad, and I think the easiest, my LinkedIn says all things product for Capital One Bank, which means in the traditional sense, I'm the chief product officer there. What that means is my team is on point for the entire tech stack of what we need to get done. That starts from how we organize our data, which I'm sure we're going to talk about, how we modernizing our core and our infrastructure, all the way to how we building the next generation consumer experiences to unlock new value for our customers. And then very relevant to this is in terms of new payment methodologies, in terms of all the tech AI stuff that's going on, how are we reimagining the bank of the future as a whole? So broad charter, but very exciting. I'll just also call out that it's really good to be here. I've been chatting with Chainlink for years now. Prior to this, I was in Meta, and then one of the folks on our team from Messenger was the chief product officer here for a while. Also, I remember being here 2 years ago, 3 years ago when I was in Messenger as well. So it's really good to be back.
Very cool. I didn't know that connection. That's great. Let's dive straight into it. Anka, you have super interesting and unique vantage point of how AI is trying to integrate in today's financial practices, right? Capital One is one of the biggest banks in the country and in the world. What's been working for you? What is working for you at the moment of actually integrating AI into your kind of core product suite?
Yeah, I think I'll just take a step back and start with something which our CEO, whether he also is the founder, visionary still. So he says that he thinks of us as a tech company that also does banking. So I want to frame it in that conversation. So for a long time, years now, we've been building the foundation. So the data foundations, the infra foundations that will help us participate on how we can leverage GenAI, right? So that's been going on for a while. I'll like that. So it's all across the company, many different use cases, but let me hit a couple of them to make this real. I won't hit the whole customer service thing that everybody already is aware of and talks about a lot. Let's talk about something interesting in banking. So fraud is a huge, big thing in banking. When I started this role, it was a big learning for me, and it can have catastrophic consequences both for the bank as well as our customers. So we are investing a lot in developing the right Gen AI, but traditional ML models as well, to identify fraud patterns and trends so we can react to it much quicker, also without disrupting the customer experience, right? Because if we take too conservative an approach, then you're maybe stopping good actors versus the bad actors, right? So that's one big area that's working well for us, but we continue to invest in. I think the other area which I'll call out, which is very interesting, is on the other side of it, which is customer service. But we have been able to use all of what we have learned in customer service over decades and really train our models to help our service reps with what we call the next best action. So when you're talking to someone, you're getting a lot of live information, how do you gather the intent from it and then really pool in all of our collective business logic to give them a suggestion on what to do next, what's the best way to serve our customers. And I think the last which I'm excited about, very early stages, we recently launched a chat concierge for, by the way, not many people know this, but Capital One's also the biggest lender for auto loans in the country. So that's an entire division of its own. And we recently launched a chat concierge which can interact with people, understand them, and really help them find the best car for them in the dealers around. So those are three things that have been working pretty well. But this is just the start. I'm really, really excited for the next 3 years.
It makes a ton of sense. Like fraud is the early adopter of data things. Like fraud is always the first place that machine learning pops up. It's always the first place that the newest technology.
Also, some of the best hackers and engineers and PMs you can find. So also, figure out how you can recruit there.
Very, very true. And Andy, like from a venture side, like how are the smaller people in the space that are trying to build these financial products, like how are they having success building with AI at the moment? Or is it kind of all hype, no substance for them at the moment? And they're just kind of using it internally to be productive versus integrating it into their core products?
Yeah, so I can probably talk about two things. So one is from how AI is impacting the venture capital industry. I think it's actually pretty substantial. So I can also speak to some of the early trends we're seeing in the crypto space and how it intersects with AI. So on the operational aspect of venture capital firms, when we started the fund about a year ago, we prior to MetaLayer at 2 Sigma, we did a lot of research looking into how different data sets could impact how we approach the investment life cycle in the venture space. So like how we identify new startups, how we assess those companies, and how we manage the portfolio post-investment. And so at MetaLayer, what we're doing is bringing in data and applying AI to totally reinvent how we think about approaching the investment process. We're a relatively small fund, so it's a $25 million vehicle, and we compete against funds that are 10 times our size. So we have to do a lot of work to be everywhere, identify the right companies, and do that in an environment where other teams have many analysts scouring the ecosystem looking for these companies. So we've done a lot of work to identify data sets that can give us early indicators of founders and companies that are high potential. And a lot of the hard work that we do is actually making sense of that information, bringing it into one database and normalizing it, and building a recommendation system that actually goes through all of those companies and says, this is a company that's really interesting because the team is very high quality for different reasons, and doing that systematically 24/7. So that's how we think about sort of scaling how we approach the ecosystem. On the sort of earlier stage startup side of things, there's been a lot of hype more recently about crypto AI as a category. And, we've been a little bit more skeptical over the past year that there is really substantial products and services being built there. But one category actually that we feel particularly excited about is where agentic commerce actually intersects with stablecoin-based finance. And we think that intersection will totally reinvent the digital payments landscape. So, we can talk about that more, but I think that's one area in particular where we see a lot of interesting innovation and real adoption happening.
You just said something which is very interesting. You said you're smaller and competing with much larger funds. it reminded me of like back at Amazon. When I was at Amazon, there's a entire principle of invent and simplify. And what the entire thinking around that was if you have constraints, then you're able to figure out how to do things in a better way than if you have a lot more resources. So at least the way you're applying it sounded like really cool to me, and I'm excited to see how that plays out. But I also see it like as a big advantage, just being small and then being able to innovate, especially in this era.
Yeah, I mean, we see a lot of benefits to being small. Like statistically speaking, if you look at the performance of venture capital funds, once they scale past something like $50 million in size, the performance in terms of returns to investors of the fund drop off substantially. So we think there are a lot of benefits to staying small, but the consequence is that we can't afford to pay 30 analysts out of Harvard to scour the internet trying to talk to every single founder that changes their title from head of product to stealth. And that is actually a job that people have in there. So we can automate a lot of that using data and technology, and that's a lot of those practices we learned at Two Sigma, but are really advancing within MetaLayer.
What's the next capability unlock for you as a small firm that's really going to help you increase that advantage that you can have over the larger firms in terms of returns? Is it just generally more raw intelligence? Is it better capturing of proprietary data sets? What do you feel is the thing that AI needs to do to really help you be even more competitive?
Right now, so the first function really focused on is sourcing. So how do we find the right companies to spend time with? And you could think about this process from a human perspective. What would I look at a LinkedIn profile of a founder who just left a job. They look like they come from an organization that's had a lot of success and producing successful companies. So an engineer from Stripe leaves their job, goes to Stealth, has a co-founder. It seems like they're building something interesting that fits within our wheelhouse. So right now, what we're really applying AI against is systematically identifying those people. Because again, we don't have 30 people scouring the internet trying to find every single lead. So that's the low hanging fruit right now. I think where it really gets interesting for us on the sourcing side of things is how do you go from reactive, meaning right now we're trying to identify signals where things have happened. So they've changed their job title from product manager to stealth. But we think we can actually be much more predictive in terms of who we're actually building relationships with. So if someone, for example, is they've been at Stripe for 4 years, but they start contributing to 8004, which is the new ERC standard for agentic payments, it seems like they might be interested in building a company in this space because they're doing something entrepreneurial on the side. So building a data set of all these individuals, everything they're doing online that's relevant to what we focus on is the next step, and building a recommendation system that can become much more predictive as opposed to reactive on the things that we're seeing.
That's actually an unbelievably good segue. Anka, I think one of the things that is most interesting to me about how AI is actually going to really impact people's day-to-day lives in finance is how the biggest players like Capital One make use of your proprietary data and then using that in an AI context. What are the kind of things you're looking forward to unlock with that anytime soon? If you could share it, share anything or anything that's been publicly out there, any of the capabilities that you're looking forward to building internally.
Yeah, I think I'll answer your question in a second, but you just sparked a different thought, which I'd like to share with the group. And, let me just paint a picture, right? Imagine you're a company for 30 years. You've been capturing data over decades. Many people have come in and gone. Data standards have changed. How you categorize data, the data structures usually have changed. So you have insane amounts of proprietary data, but the big unlock is how do you harness the power of all of this data? And that in itself is multi-year journey, sometimes in a decade plus journeys for a lot of these companies. So I always like to set that ground in. Even if you look at Capital One's journey, right? From mainframes, they were one of the first companies to move fully into the cloud. That's the first step to doing that. There have been a lot of investments in figuring out all of the data sets. How do you standardize it? How do you make it ready? Both just for our basic analytics and decisioning in ML, but also then for model ready for Gen AI. So that's one piece, right? That's a big thing, which is always top of mind for us and something we've been investing in over almost a decade now, if we just start from first principles. The other thing I'll call out is that in our experience, both here at Capital One, but also in prior roles, it's relatively easy rather to get to an 80 to 85% good answer with what's out there. Like, take Llama, do some reinforcement learning, you're good to go. It's a lot more difficult to get it from 85% to 95%. And it's exponentially difficult to get from 95 to 99.9%, right? And I can just make it real in terms of self-driving cars. Like my FSD works really well or things like that, but it's not going to become prevalent till you've gotten it to a place where you're totally comfortable with all of the risk. And the very same applies to financial institutions and models as well, where these are serious things. They're like you're handling people's money, you have people's trust. And so where proprietary data comes in at the highest principle level is how can you use that to take it to the absolute max of accuracy and reliability, and how you can manage the risk. And I think that's where companies have invested in longer time have a disproportionate advantage. Now, obviously, you need to go through all of what I talked about to get to that point. But generally, that's my mental model of how you look at proprietary data.
So let's take that and zoom out and then say, okay, we accomplished all of those challenges. We're now 5 years in the future, 10 years in the future, whatever we think it might take. AI is reliable enough to moving value around in the systems. The way that we raise capital has changed. The way that we move capital has changed. What's going to remain uniquely human? Anko,
do you want to start?
Yes, please.
So I'm not getting on my soapbox, but I really care about this. So recently I was visiting the Capital One cafes, and if anybody's not seen it, just there's a bunch of them in New York, in fact. And if you have a Capital One card, you get 50% off coffees and lattes, which I was glad with because in San Francisco it's like $8 a latte now. So like $4 reminds me of like 2 years ago, 3 years ago. But like the associates there were telling me that one of the purposes of the cafe is to serve the community. And when I was talking to the associates doing empathy interviews, they were telling me that people sometimes just walk in and sit down and they feel relaxed because they feel that the associates are there to take care of themselves. They feel supported. They feel away from the regular pressures of life. Like, as long as the world is run by humans and not AI overlords, I would say that humans need to interact with humans, right? And just the human connection, because you could, and I'm sure there are a bunch of startups doing this, you could very well do financial planning with a Gen AI model and give great results. But people want to talk to people and feel supported and heard. Now, going back to my fraud example, imagine something terrible happens or you get scammed and you're calling. I don't want to live in a dystopian world where I'm talking to an unfeeling AI agent who can't empathize with me. It almost reminds me of 2001: A Space Odyssey, the voice. That's what plays in my head. I don't want that. I think there's the human part of supporting people, understanding, showing empathy, which should remain. I hope it remains. Otherwise, we're losing maybe what it means to be human, which it often does that. So I said, I may be getting on my soapbox, but I generally care about these two things, especially given I've also heard a bunch of people suffering during fraud calls when you listen to it and try to support. So it's definitely changed my thinking, especially having spent close to 15 years in Silicon Valley, where the mentality is completely different, right? Which is like tech forward, tech's going to solve everything. So trying to find the balance between both. The last thing I'll say is, even if everything becomes automatic and you can train your agent to do whatever you want, I think the fundamental human thing is judgment. You're the one who's training it based on your values. You may not want to, you may want something cheapest, but you may also want something which is from companies that do things in a sustainable way or based on your values. So the human judgment, I think, should be driving the automation. So that remains uniquely human as well in my mind.
Andy, can you get on your soapbox too?
Yeah, I think we're entering an era where products and services across the economy, especially in financial services, you're talking about personalization. I think this is going to be a huge trend where everyone in this room, for example, one of the first things I do now when I want to understand something or I want to write something new, I typically go talk to ChatGPT. And that's a behavior change that I think is still underappreciated, because even a few years ago, that was still a pretty small scale behavior. So I think in 10 years from now, everyone in here will have hundreds of agents working for them. And in the context of payments, I think that's going to totally reinvent the economy. And from a digital payments perspective, especially, I think it's going to transform that industry. And I think what that means is that everyone in here will have access to products and services that right now are really only available to the rich and powerful. You're going to have entirely bespoke experiences available to you in ways that were not possible before. And I think that's a very exciting future. And a lot of the infrastructure is being built for that at the moment. So it's still in the early stages of that innovation. But I think that's a really exciting future, 5 to 10 years from now that we can all look forward to.
But where are you going to connect with humans in that future, right? Like if we all have access to like family office planning, that's a group of agents, like you don't need to go and talk to people who run a family office anymore. Like where do you still see those human interactions coming in?
I think as Ankur said, like things that are emotional or frustrating, I think still requires a human touch. Like no one wants to be dealing with something frustrating and talking to Hal from the spaceship. Like I think that's not a pleasant experience. I also think like from a commerce perspective, there's like a subset of transactions that are very mundane and meaningless, like buying dishwasher pods or something like that. Like that whole class of like commerce, I think is going to be totally automated. And I think what's going to be less, it will be very uniquely human. Like I think the shopping behaviors that are like very much expressions or experiences, I think are going to, and you already kind of see this now where like traditional retail is kind of dying. It's becoming much more experiential, but it's like to the extreme in 10 years from now. And so I think that's where human interaction will be at a premium. And so I don't think the human element is disappearing. It's just the sort of texture of it within the context of how we interact in the economy will change.
Awesome. I think that's a great place to wrap it up. So thank you both for coming on and sharing your very unique perspectives on this problem.
Thank you. I learned a bunch myself. So there you go. Thanks.
We're hearing a lot about the nature of institutional infrastructure, what it takes to build something that traditional finance trusts, but also as DeFi gets more and more mature, sort of what does it take to build financial infrastructure that they will work with together on. I would argue that none of any of the other panels are possible without this panel because everything relies on what these guys are doing in the future. So I would also give the audience credit as being a little visionary for being here. I want to start off just by addressing a question to the whole crew here. You all sort of represent different aspects of the future financial infrastructure that's being built. Could you take a moment and just sort of help set the stage for what each of you are seeing in your various capacities is the biggest obstacle to either TradFi adoption or TradFi and DeFi integration?
Thank you, Michael. Hi, everyone. My name is Damian Brenner. I'm founder and CEO at OpenZeppelin. OpenZeppelin is a leading open source cybersecurity company founded in 2015. We've been working for a decade with the leading crypto native projects as well as the largest financial institutions as their security partner of choice. We created the most popular smart contract development library in the world, over $31 trillion of value transacted, used by 10 of the top 10 asset tokenization projects.
I was looking at your research. It was just 25 trillion. So it's like growing by trillions quickly.
And actually 9 of the top 10 stablecoins are leveraging our technology as well. So we have we're at the backbone of all these projects and we see what's happening. And with respect to institutional scale, I think what we need is deep secondary market liquidity.
Yep.
So that institutions can participate in, they can lower their operational costs, and also they can give their assets new use cases. And the technology is kind of there, it kind of works, but there's a bunch of compliance gating items that we as an industry need to solve. The first one is privacy. How do you know who your customers are and what their balances are without exposing all the information to the world? Yeah. There's a bunch of projects that we're actually collaborating with on CK technology, FAG technology, or the likes of Zama, the likes of Midnight, that are trying to solve. We're actually co-developing a standard on private ERC20 transactions.
So we're hearing a lot about the restrictions at the secondary market level. It's interesting, sort of like through your standard lens, that's the first thing that you focus on. Gentlemen, we had a chance to touch base a little earlier. I'm curious, sort of where from your different perspectives within the infrastructure stack, what are you seeing as the biggest obstacle towards large scale adoption?
Sure. Yeah, I'll take that next if you don't mind, Martin. So I'm Mark Kuchinad, CEO at Copper. We're a institutional focused custodian and technology, collateral management technology platform. I would say the biggest impediment traditionally for the traditional institutions has been just the regulatory and legal structures around some of the blockchain-based asset class. A lot of what we focused on over the last 5 years has been bringing law is law to the code is law asset class, right? This idea that for the traditional market participants to come in, they need to have some comfort that when things do go wrong, and they often do go wrong, especially in this new asset class we call crypto, that they can rely on some of the traditional measures that they always would, right? I mean, FTX might have had code is law and had their risk systems encoded, maybe incorrectly, maybe not incorrectly, depending on your point of view. But when the time came to actually resolve the estate, that went into a bankruptcy court that is like every other bankruptcy that I've lived through in the financial markets, whether it's MF Global, Lehman Brothers, et cetera, et cetera. And so I think you need to actually bring in this code is law ethos into a law is law framework when things go wrong. And I think that's one of the things that this marketplace needs, is to have the faith that when that they can operate the way they usually do and abstract away some of the complexities, both on the technology side and the code side of blockchain-based and smart contract-based trading.
It's a great example of like one of the reasons why I love this space so much. It's essentially a philosophical question that you're trying to solve with ones and zeros. Martin, briefly tell us a little bit about the perspective that you take on infrastructure today, and what's the one biggest obstacle towards large-scale adoption?
Absolutely. Hi, thanks for having me here. I'm a founder of Centrifuge, that is an infrastructure layer for DeFi, and also founder of Anemoy, which is a regulated asset manager using the infrastructure. And what was driving me into the space was the previous startup I had. It was a supply chain finance platform, and that supply chain finance platform was actually financing invoices and then distributing it to institutional investors, Web2, so nothing blockchain. And I really understood the restrictions of the current financial system, where it is broken, where it doesn't work, where it doesn't scale, who is actually who has not access to that system at the moment. And the vision behind Centrifuge is really decentralize those structures, kind of democratize access to investments on one end, but also actually build a broader, more scaling system for people to participate in the system if it comes to lending, borrowing, credit, etc. And of course, that is a long journey, decentralize financial markets and the financing system as we know it. So that needs to happen in pieces. And one of the pieces is really Anemoy as a regulated tokenizing issue and service provider, where we work with traditional finance institutions to help them adopt the technology and go that step further, where we can actually disintermediate also the value chain of finance and credit.
So is the technology already there and it's just a matter of TradFi getting comfortable with using it? Or are there achievements that need to be crossed in order to...
The technology is actually far ahead as usual. So Damien and I, we spoke, we started with Centrifuge in 2017, so also very early. And I think, one of these very first use cases we already had was how we can standardize it, how we can actually build structures to minimize the smart contract risk, so the risk in the code. And I think a lot of the things, if you do it right, are actually solved or very, very solvable. That what takes longest is adoption and, of course, even longer regulation. So basically build the structures that regulators understand what we are doing and how that actually can be part of the technology. Now, still, you see all these structures. Where basically all these regulators trying to understand crypto and kind of think how they can basically put crypto in existing regulatory frameworks. But that's actually the wrong approach. It's actually how you can extend regulatory frameworks to cover this new technology. And that is most likely something that will, I see it happening already, in the discussion, how regulators are actually changing in the discussion. So the US is a prime example, what just had happened over the last few months. So, yeah.
And Damien, you have actually worked with Martin on a couple projects over the years. I think it's really interesting as we're talking about sort of how to lay this foundation for larger picture projects. Your team is already imagining sort of the changing threats as we get into that stuff. We can't wait until we reach the large scale adoption before we start considering those threats. So can you talk a little bit about as you've watched the trillions of volume go across your technology as we get up into the quadrillions that the DTCC measures every year. How does the threat matrix change, and how are you building standards to consider that?
Great. I will first touch on Martin's point,
Please, yeah.
saying that the way I look at the industry is in the past 10 years, DeFi was fantastic experiments that showed that we can build a financial system based on open standards.
Mm-hmm.
And the way I see it is financial institutions looking at those experiments and now saying, okay, how can we replicate this in a way that it's safe, that's compliant?
Maybe being a little afraid they're going to lose some of the pie.
Well, but I think that makes sense based on all the requirements that they have. And that's what we need to kind of step up in order to make the true promise of blockchain technology happen at a worldwide scale.
Yeah.
And then we're in an industry where code powers real money, so that naturally attracts hackers. And the best way to protect yourself is to make sure that you're implementing blockchain native security best practices across your whole development lifecycle. We've learned that there's no silver bullet to security in general. And I think this is especially true for asset tokenization projects where you have multiple endpoints connecting to the on-chain system. So there's a few distinctions that you need to make between like blockchain native security and traditional security. The first one being the atomic nature of blockchain transactions makes it so that transactions are irreversible. Mm-hmm. And you're basically deploying a smart contract to the world and exposing it to anyone that can interact with it. Mm-hmm. So all the pre-deployment activities become critical, including selecting battle-tested smart contracts, leveraging, let's say, Open Zeppelin contracts library or others, so that you can integrate best practices into your code. How do you do security audits? This is not, in our space, security audits is not just like a checkbox thing, like a SOC 2 thing that you just do, but it's more of a collaborative effort to find vulnerabilities in your code and harden your code and infrastructure and processes. And then what we see that works best is the companies or institutions that choose a security partner and think of it as a strategic partner of choice for the long term, instead of helping them educate their team and build the muscle, design and architect their systems in a secure way, then do all the checks so they can go into production safely and compliantly, regardless of whether they're building internally, they're relying on third parties, or doing a combination of the two.
So I imagine that all of these standards that companies have access to as sort of a series of Lego blocks that they might look at which one they're going to choose and which two they're going to choose and in which combination. At what point in time in the build are you guys seeing, are you guys hearing from companies? Do they get started building with the open source blocks that are available and then come to you and figure out how they can integrate with your various platforms? Or are they coming to you first and building side by side?
I think it depends on who you're talking about, right? I mean, we're so early in the adoption cycle of both crypto and blockchain. Even though it's been a decade, we're still at the first out of the first inning, maybe, right? So we are having conversations with, and I think we have different client bases and parties we talk to where the people we talk to are not yet thinking about security of smart contracts and how they can change their internal systems to be operating on something that looks a lot more like Web3, because they might not have even migrated from their on-prem data servers to a cloud-based database, right? And so
I would say that's not the case for us.
No, I'm saying that's what we have very different, right?
Not the people you're talking to.
The people you're talking to are very much. And so, I think we have a wide spectrum represented here on this panel, because we're talking to people who, in their personal lives may have some exposure to Bitcoin or ETH or some crypto projects, but in their professional lives are at the very early stages of trying to get compliance comfortable, trying to get their ops people comfortable, trying to get cybersecurity people comfortable. And every time there's a story about a hack or a fraud or something, they take 4 steps back for for the 3 steps that they've taken forward. And I think what we're seeing over the last year is just a lot more of that forward momentum without many of the missteps that the industry had previously, or at least addressing missteps in a way that looks much like the missteps that traditional finance has. And so I think by putting these things into a context that they understand a lot better and that seems familiar to them, it's a very incremental evolution, not a revolution. And I think that's the big thing that we find with our client base is that we do need to talk about things in evolutionary terms. I mean, it is remarkable to me, and I'm only a year into this industry, so I'm the most TradFi noob probably in this building. But
Copper's been around for a decade.
Copper has, but Dimitri has quite a lot of vision. Our founder and the former CEO, but he thought it was the right time for the target clients that we're going after to bring in somebody that speaks that language and is skeptical of like change the same way that the big institutions can be.
Right. And I think the fact that you have so recently come on board is actually kind of important to talk to about like where the industry is. Many people in this audience, at least I think in the broader ecosystem, might still think of Copper as a place where you hold your assets. But you're actually more than that, and you're actively building those bridges. Talk to me a little bit about, as your potential clients come to you, what are they looking for? What are they shopping for? How are you sort of helping them answer questions that are keeping them on the sidelines?
I mean, we do offer custody of blockchain-based assets, right. But I think that literally, I mean, that is the foundation of where we started back when there were no real institutionally focused custodians to provide that institutional grade custody. At this point now, the names that are coming into the space are names that are going to dwarf Copper and our balance sheet and our brand. And it's not the space that we're looking to compete in. What we actually focus on is technology. And so we are having the conversations about, if you are going to provide custody, here are the things that you should worry about. Here are the things that you can use. By the way, we have 7 years of tech development that allows integration across 60 plus blockchains, abstracts away for your customers some of the complexities of interoperating on what is 60 different versions of Swift or 60 different versions of DTCC, right? Each one with a special use case or a use case that is maybe a little bit more primed for a certain case, a certain use that is a very niche in finance. But I think we still come back to the biggest thing that happened to this asset class and this technology in 2024, late 23, before November 5th, before the election day a year ago, was that the world's largest money manager in the world took a decentralized asset, wrapped it into a DTCC traded New York Stock Exchange or NASDAQ listed instrument, and had that go into everybody's traditional Schwab and Robinhood and Morgan Stanley account.
Well, it's like you're looking at my notes here, because Martin, I did want to talk to you a little bit about sort of flipping that script. We spend a lot of time talking about adoption as the BlackRocks of the world dipping a toe into DeFi, getting comfortable with it, depending on who you talk to, maybe trying to co-opt it a little bit. And there's a lot of talk as we're seeing the DeFi native companies get more and more mature, that script might someday flip, and maybe soon, where when we talk about adoption, we're talking about DeFi native companies building traditional native assets. Like, what are you seeing is, first of all, the status quo for that question, and how do we either actively engage in flipping that script, where when we talk about adoption, we're talking about DeFi native companies building crypto native assets?
Yeah, so very good question. I think the example you brought in is exactly reflecting where we are at the moment, that actually kind of, ETFs wrapping crypto assets growing faster than the crypto space. And
will we forgive him for that? Yeah. At least it was a pretty birds chirping.
Sorry, guys. And so wondering where
how the future of all finance is
how confusing to get that on stage and forgetting it. Sorry, it happens. Don't worry, that's exactly showing where we are at the moment. So that basically TradFi adopting crypto assets is actually happening faster than basically tokenizing traditional finance. And that is exactly for the reasons we have heard here. You do not need to build new compliance frameworks for tokenizing Bitcoin or ETH or Sol. You can actually use what you have, just the regulator needs to accept that it is working, and that has changed. But that doesn't need
new security laws. You can totally do that with security laws from 1933 and 1940 or whatever. Perfectly works for actually putting traditional assets into a token, make it more accessible and tradable on blockchain speed. Damien was talking about it, is a different game and takes longer. And I think the discussions we are having are actually twofold. It's most likely the early conversations is education. People don't even understand that tokenizing real world assets is not crypto. It's adopting the technology and then gives you similarities or actually the same possibilities you have with crypto assets in DeFi today. And then you have others actually understand the possibilities. And I think the biggest difference between the two is if that knowledge has already established on the decision-making level. And that is very, very rare. The best prime example is most likely, you have BlackRock and the CEO of BlackRock is understanding it and is driving it and makes that actually part of the vision of the company. If I look at traditional finance, and there is 99% of the market which don't do that yet, So, and that is the biggest differentiator. And that exactly, this is for us the low-hanging fruit, where we're basically saying, we have decision makers who understand that eventually everything will be a token and that the future is tokenized. If you would like to do it, you can actually do that with partners like us here, understanding the technology, providing you the infrastructure, and you only thing you basically need to do is be blockchain ready and actually wait for the tipping point and get that make your feet dirty is actually a low hanging fruit for a lot of those. That's why they can actually say, I'm extending my existing expertise in managing a portfolio and understanding risk and do due diligence and if you use the right partner to helping me to tokenize and distribute that. For now, it's a new distribution channel. It's opening for you the space into something which is beyond what you're having today, but eventually that will flip,
So I feel like, please go ahead. I can see the body language that we're getting ready to go.
I think that what Martin's saying is sort of plays to this. We're at the stage where real world problems need to be solved by blockchain, but they probably need to be solved by blockchain in a way where the real world problem, the people who have the real world problem, don't realize that it's being solved by blockchain, right? And so I think about, why did I even come into this space, right? It's a question that I sometimes ask myself on a Sunday morning at 9 a.m. when something's gone wrong and realize I'm in a 24/7 market. But I think that, the reason I came in this space is because I lived through Lehman Brothers. I'm probably the oldest on this panel, but
and I definitely talk later.
Definitely the oldest in the room, and older than the average in this room, at least. And so I lived through Lehman Brothers, right? And at Lehman Brothers, when we were facing Lehman Brothers on a giant derivatives portfolio at the bank that I worked at, on Thursday night, we called for collateral and they owed us $200 million. And then Friday morning, they paid us $200 million. It was all great. And then Friday, by the time they paid us $200 million on Friday, they actually owed us $600 million. By Friday night, they owed us, I think it was like $800 or $900 million. We went through the weekend, obviously no collateral received over a weekend because the banks are closed. Yeah. Why would we possibly need to send money around on a weekend?
Yeah.
And Monday morning we walked in, we were owed $2 billion, right? Because the market had moved. And so to me, it seems like you see that problem. When you can solve that problem and you don't have to talk to people about the blockchain or smart contracts, you can provide them a solution that what does it do? It allows them to move collateral at real-time speeds as they need it on demand in smaller amounts than 200 million or 600 million or $2 billion, right? Like every hour, what Copper does is part of our clear loop technology is we allow counterparties to move collateral every hour between themselves and the trading venue that they have a derivative exposure on. And so the moves can be small. Over whatever it was, 3 weekends ago, Columbus Day weekend, our clients moved $1 billion of stablecoins and other assets because there was a huge market move, but not one single call was $1 billion.
So I'd like to take your answer and Martin's answer and bring them together and ask Damien a question. So I love the term that you use, Martin, about being blockchain ready. And I'd like to ask you, how might Lehman have played out differently if all of those counterparties were blockchain ready? If they were building with Open Zeppelin standards, if they had sort of begun the process that we are working on today, how would a problem like that look differently?
That's a great question. The way I look at it is like, what does it take to build a financial system based on open standards? And that means that you can check what are the smart contracts that everyone's using and where they were audited or not and how they work. You can audit them. You can see transactions. You can see assets in real time, at least with the technology we have right now. So the way it looks to me, and I'm originally from Argentina, so that's what kind of inspired me to join the space maybe like 2012, 2013, seeing how this technology could solve many of these obscure financial markets operations.
I think most of the audience probably knows what you're talking to, but like very briefly, what is the problem in Argentina that you see this technology helping solve?
Do we have 30 minutes?
Very 2 sentences. Very. The journalist in me has to make sure that we bring that out.
For me, it's all about visibility, transparency, and permissionless innovation.
Yeah,
that's what blockchain brings, and that's what we lack in the traditional markets.
Well, I think we had that problem. I mean, it's the transparency, those very things, right? Like, we were running around the Fed. Nobody knew what each other's exposure to Lehman was. We had no ways of figuring out you're long and I'm short. How do we just go meet each other and get Lehman out of this loop instead of you owing Lehman money, which the bankruptcy court is going to take, and then Lehman owing me money, which the bankruptcy court is not going to give me.
Exactly.
Right. And so we had no transparency about that. The regulators had no transparency. The Fed had no transparency. We had no idea the size of the risk. There's so many things that a centralized database that people can share and have their own views into with privacy, and so that not everybody's seeing everything, I think would have dramatically changed that.
I'd like to come back to the title of the event here, Infrastructure in Action. We're talking about Argentina and Lehman Brothers. Martin, can you talk very briefly? I can feel you over there. You've got stuff to contribute.
Yeah.
What does infrastructure in action look like in these contexts or in the future generally?
I don't disagree. I would most likely just go further. I would argue a Lehman Brothers wouldn't have happened if everything is tokenized. Just consider every mortgage is a token. The structure, kind of, how to collateralize it is tokenized. And then the distribution of that is tokenized, most likely through different levels. You directly see, in totally connected system, what is the default rate on the underlying, and that is directly impacting the performance. And exactly this delay we are having with all these intermediaries and the intransparency it's creating had actually kind of, caused that issue, basically. Exactly, totally agreeing, but having it actually into something that is atomic, directly connected, those things would not happen anymore.
So as we kind of wrap things up here,
FTX is another good example.
Please,
by the way.
Yeah.
Hey, if you look at FTX, it was CeFi and DeFi. The DeFi part worked perfectly well. Everyone could actually, in their default, exit at a market price for actually everyone who has CeFi exposure. So the FTX was an off-chain counterparty. We're still struggling to get it kind of resolved.
And if I had to summarize, I think we need to move from markets that are based on trust to markets that are based on proofs. That's a big difference I see today. You're trusting all these intermediary institutions. You have no visibility into what you are interacting. What does the system look like? And we're moving towards technology-based systems that you can prove that you have an asset, or you can see things in real time. And that, at least for me, it's game changer.
I'd like to ask you some brief questions. There's brief answers. I want to get to 2 final questions. First of all, the infrastructure that is in action right now, in spite of the fact that it's supposed to be really stable and safe for everybody to build on, is moving a lot. It's impacting a lot. It's changing pretty much everything. Are you seeing, who do you see as the right and the current, in case they're different, best leaders in the space? In other words, should infrastructure be leading this and regulation responding to it? Or should regulators be leading this and infrastructure builders creating compliant technology?
I mean, I worked at a regulator. I will tell you, I have a very strong opinion that regulators respond to market needs. So I don't think that they can dictate how innovation should happen. They will respond when innovation does happen to make sure that it happens in a way that they deem is safe and secure and protects, right, the people, the participants, and general economy, to not allow, again, revolution. They're looking for evolution.
Love it.
And so I think we just need to keep that in mind as we develop innovation, so that it looks more like evolution than revolution.
So I'm seeing two heads nodding. I'm going to let that answer stand for the panel right now, even though I asked everybody. I want to get to the end here. I'd like to ask each of you to take 1 minute and let's look to the future. What do you see over the next 12 months is going to be the next live on-chain technology asset that we do not have today that's going to build into the future? This can be at your own companies or industry-wide.
What I'd like to see is real capital efficiency and real collateral mobility for tokenized assets that institutions can participate in because it's compliant. Basically moving away from pilots and proof of concepts to production-ready systems that are attractive. And for that, I guess on the Open Zeppelin side, we'll be announcing a few partnerships and clients and technologies that will solve some of these compliance scopes with respect to privacy, identity, and security per se. So I'm quite excited about that.
How many big banks are you working with?
A lot.
Amar, next 12 months, what's going to be live and from a trading perspective, a product perspective, an infrastructure perspective?
I think Damien's going to be happy to hear that that's exactly what we're working on with some of the same big banks is how do you make the collateral mobility posting and movement of variation margin on OTC derivatives and some exchange traded derivatives, especially those on crypto, blockchain and smart contract enabled.
Martin, what's the one thing over the next 12 months that's going to launch, that's going to make the biggest change in the DeFi, TradFi interaction question?
I think real asset tokens and crypto digital asset tokens will merge. The utility will be more and more the same. It makes it much more easier and much more accessible for basically the wider DeFi ecosystem, real assets, I mean. And that will be the trigger for much more and more broader adoption of real assets.
Gentlemen, thank you so much. If everyone could please join me in giving them a round of applause.
I'm joined by some incredible builders. Trailblazers is part of the build program. It's a very, very exciting time to be a Chainlink Marine and to be part of kind of the build and Chainlink ecosystem, having just announced Chainlink Rewards Season 1 yesterday. So very, very excited. Culmination of a lot of hard work and a vision that we couldn't be more excited about. So I'm Roman Torona. I lead the build program here. We're going to walk you through kind of a deep dive into who's part of Season 1, the amazing builders here, what they're focused on, and we'll kind of start off with some introductions. So welcome, everyone, and let's get started. So, Adam, would you mind kicking us off?
Sure. Hey, everyone. I'm Adam. I'm with Dolomite. Dolomite is a money market with a very wide range of asset support, assets you can't find anywhere else, and with deep integrations that really give you the ability to continue using your assets for all the things you love, your best in staking, rewards voting, even while borrowing against them.
Awesome. Hey, Scott Dykstra, co-founder, CTO of Space and Time. Space and Time is the first kind of tamper-proof database that allows smart contracts to actually ask questions about data, ushering in kind of a new era of data-driven contracts, very inspired by Chainlink, born within the Chainlink ecosystem. So we're really happy to be here for our fourth SmartCon.
Absolutely. Edwin?
Hello, everyone. My name is Edwin Mata, the CEO and co-founder of Brickem. We are a tokenization as a service platform. It has served for over 300 billion in 6 different countries. And yeah, we started our journey here since 2021, I believe. That's when we entered the build program. So happy to be here to explain a little bit how that journey has been. Thank you.
Awesome.
Jack?
Thank you very much. I'm Jared. Originally, we were one of the first guys into the build program as well. We've been around for a long time. We started off as Trueflation, so inflation data. Some of the previous panels were talking about not trusting the data that's out there. We believe that too with the government inflation data. And now we're expanding out into the Truth Network, and a tested, verified data layer for everything out there in the market.
Awesome. Amazing. And yeah, I can attest to how much work you all put in over the years and, to be fourth SmartCon. Scott, I hope this one shapes up. It only seems to be getting better and better. Great. I think we're going to start off with just kind of what is exciting to you right now. You have Chainlink Rewards Season 1 kicking off. What's on your roadmap that kind of also is, in confluence with this launch that you'd love to talk about and touch on? What excites you most kind of about this launch, Adam?
I think, at least for me, we love the Chainlink community. It's large, it's active, it's very deep into crypto, very aware. And for us, we really love what we build. It's something that is appreciated. The more you care about crypto, the more you know about it. And for us, bringing it to the broader Chainlink ecosystem, that's big for us. That's what we're really focused on. That's what we love about it. And especially with how core Chainlink is to our ecosystem, to our protocol. So I think that's really what we're looking forward to. And we're looking to really grow a lot of our assets, and all that's powered by Chainlink.
Amazing. And how about you, Stat?
I think Space and Time was the first or the second, maybe behind Trueflation as like a second build partner. Mm-hmm. So it's been a really fun journey since early 2022, getting this off the ground. I agree that the Marines, the Link ecosystem, the Link community is extremely strong. Space and Time has a pretty significant rewards program to deliver to Link stakers, the first batch of which has already been delivered to Link stakers. And
absolutely,
we were pleasantly surprised how supportive the Link staking community was. Like a lot of people really held their rewards, which was a pleasant surprise for us. It was to be expected in that it's a great community, strong. But also on the engineering side, we've been really pleasantly blessed, I say, by like Chainlink's engineering help as well. Like, and we've had a lot of access to product management engineering on the Chainlink side that's helped us get Space and Time off the ground. So it's been a great journey.
And I'd say that's the biggest thing that we really benefited from the build program for us as well. Having that kind of access is what we love about it.
Oh, that's great to hear. And I will definitely dive more into that. But how about you, Edwin?
Yeah, so I mean, on the tech stack, we integrated absolutely everything, and now even studying is ACE. So it's kind of like we are very, call that linear to the Chainlink vision, right? And today, for example, or yesterday, a couple of Marines already approached finance. Hey, get a reward, so I want to learn about your project. And that's kind of like a different from a normal airdrop where it's like, oh, I'm just going to farm and dump. Here, there were people trying to educate themselves as to, okay, so what do you guys do? I want to learn more because I want to hold. And it's kind of like the mentality of the Marines. I mean, it's one of the most positive communities still. Back in 2018, I was a Marine myself. And I remember like it's a knowledge pool and everybody's trying to build because we do believe in that decentralization and blockchain, how it's going to change everything. So yeah, I mean, for us, it's kind of like spread the know-how as to what is freaking building, because you never know who's going to hit that wallet. Maybe it's a client, maybe it's a community, an ambassador, or just a believer in what we're doing, which is tokenization.
Absolutely. Awesome. And how about you, Jared?
Yeah, so a culmination of a lot of what's already been said, but I think as you were stating about being someone that was first in with build, is that the duration of how the community has interacted with us over time has always been great. And I know there's a lot of other chains out there that, there's the new kid on the block and then eventually it kind of just fizzles out over time. But Chainlink and its community have always been supportive since the beginning. And there's a lot of amazing work that you guys are doing and the community itself. So of course we want to reward that as well. So yeah.
Yeah, absolutely. And I definitely want to touch on too, you mentioned, Edwin, just the community, being interested and really kind of taking control of the knowledge they have, about the projects that are being and in companies that are being part of Chainlink Rewards Season 1. At the foundation of Build, we want to, really showcase you guys and how you're leveraging Chainlink and how that is benefiting the entire ecosystem as a whole. So it's our job to educate the Chainlink staking community to really understand, appreciate, and ultimately evangelize what y'all are building. So I think that's a core tenet of what we try to design here, and I'm very, very excited to see it kick off.
I would just add as well, sorry.
Go ahead.
The community themselves are also very educated. As you were saying, they've come to the booth, they really want to hear about what you're building. It's not just when is the airdrop, it's what are you building? We really love it. Let's talk more about it. Mm-hmm. We've been a Link Marine for forever, stuff like that. So that's pretty rare in this industry. So I think that's also pretty incredible.
Yeah, it's definitely something that we take great pride in at Chainlink, and we're very blessed to share it with you guys. And that's part of the reason why the build program is something we're proud of and excited to kick off here. So let's get into a little bit about your journey. I mean, the founder's journey here in Web3 and crypto is the hardest in the world, in my opinion. Not only are you navigating product market fit, but you're also navigating almost industry market fit at the same time, right? There's a ton of different things and factors that can help you pivot, move. You've been through certainly so many different iterations. We've been on this journey together. So how has being part of this ecosystem shaped your journey and direction? It's been a few years. You mentioned 2022. Now we're in 2025. SmartCon isn't the only thing that has changed since then, right? There's been a ton of different things that have gone into that. So maybe starting with you, Jared, talk a little bit about kind of the journey and the role of the Chainlink ecosystem.
Yeah, that's a great question. It has been a very interesting journey. And the thing I always loved about the crypto community as a whole is that they are very passionate, whether for good or for bad. But it's been really, really good working with Chainlink over time with all the products that we've had. And we've definitely seen as well more and more adoption of crypto. And honestly, the word I could use for it is respect, in terms of from bigger traditional players. Like we just had a great presentation about a lot of traditional finance that's moving over into the crypto space. And I think Chainlink is seeing that in the future and allowing a lot of their projects to kind of interact with that. And yeah, I think ultimately the journey has been great, and it's getting more and more serious, but in a good way.
Mm-hmm. Absolutely. And how about you, Edwin?
Yeah, I mean, when you're a founder, I gotta say, you gotta be a psychopath to start something in blockchain, right? I mean, it's crazy. But then in the back, you also want to have some partners, but not that once you sign a contract and it's just a piece of paper. Yeah. Like you want full support. And over the past 3 years, we've been very really close to the Chainlink and the team, and we have a lot of respect for every single member. And I think the culture of Chainlink itself and the team is very positive, so that kind of nurtures the community. So sometimes for us, kind of hey, we're doing this, what do you advise? Or hey, we can talk with this person because they did this. So there's always kind of like a network effect. And Chainlink, obviously, it's a bigger organization than us. So that kind of amplifies our possibilities to try to reach the right person that we want to talk to. So, but like everything, just because you're in Chainlink build doesn't mean that they're going to give it to you. So you have to ask, you have to nurture the trust. And I think that's kind of like bilaterals, because now also Chainlink opens the door for you. And we have a lot of synergies. So for example, we had a standard 7943. They trusted that standard could be one of the RWAs, and they integrated in the A's. And that doesn't happen overnight. That's a trust validation that has happened for us being in years, but also doing things by the book.
That's absolutely right. And that, it's our job as a build program to put you in a position to succeed and capitalize on some of the amazing things that are being done, not only in Chainlink, but also across the industry. So that's definitely an accomplishment and absolutely. What about you, Scott?
I'd say just to switch it up a little bit, maybe talk less about the vibe, which is extremely high, more about the journey. I think Chainlink really inspired the space and time team to go more institutional focus, like marquee DeFi protocols and large financial institutions. And again, we were probably build partner number 2 in 2022, early 2022. So we right behind. Yeah, maybe at the day. It's around. It might have been and it was years of believing that the institutions would come, mainly because of Chainlink, right? It's Sergey and the Chainlink team were hammering this early on, saying, hey, institutions are coming. That's going to bring a wave of liquidity, a wave of new use cases, a wave of new DeFi protocols and RWAs. And Chainlink's going to lead that charge. And we believed it mainly because Chainlink's been saying it since 2019 or something, HI. And so we focused a lot on institutions, and then that led us to Microsoft, Microsoft's venture firm M12 led a round, and they pushed us even further towards institutional. And that was also an introduction from Chainlink. And so here we are today now, 2025, and I don't think anyone's doubting that institutions are not just coming, they're here. And I think building technology for larger financial institutions that need to take traditional data from a source database and mint it on the blockchain, like mint RWAs, mint T-bills as stablecoins, for example, create money markets. There has to be a strong infrastructure that banks and financial institutions and money market players still secure using. So I think just getting deep in the Chainlink ecosystem pushed us in that direction has been very positive for space and time.
Absolutely. And it cannot be overstated how incredible you and your team have been to work with and as partners. And there's something very special about this moment on stage with all of you as a culmination of so many years of hard work between our orgs. So kudos. And how about you, Adam?
And also, I think the journey and the infrastructure are just the two biggest things that stand out to me. My co-founder and I started building in DeFi back in the start of 2018, before it was called DeFi Open Finance back then. And the degree to which the space has changed is incredible. Back then, the whole DEX market did maybe $5 million of trade volume on a good day. We were explaining MetaMask to people and what a decentralized exchange is, and there just wasn't the infrastructure. We couldn't have built what we have today back then. But I think that's really just what's so incredibly useful about Chainlink is it provides this layer that lets people succeed, that lets people do more, lets founders and builders build more. And so much of what we have today is built off of Chainlink, especially with the huge breadth of assets we have. A money market like ours really depends on good price feeds and being able to work and be nimble and spin things up quickly. And that's why we jumped on the build program. Just like the others, we were a very early member, and we've loved it ever since.
Yeah, and I love what you said about kind of like, the growth of the industry. Like you spend a lot of your life when you're young learning about other, parts of history and industries and different things that mature. And to be part of something in an industry that's really hit terminal velocity, right? And something that we've all been building in, it's an incredible feeling, and it makes you kind of think back to your own journey, which I kind of want to get into with you guys around kind of specifically the lessons you've gained as a founder in crypto, and maybe some of the things that you'd like to share, because I can tell from experience that it's not, it's the most rewarding job on the planet, but it also is the most challenging, right? At the same time. So would love to hear about kind of the lessons, and maybe Adam, you can kick us off.
Sure. I think, there's a few things. You have to be agile. You have to, I think above all, you have to be a member of the community. You have to be an active user of crypto, of the technology, and that is really where the best ideas come from. The best opportunities are identified by the people who are in the space, who are all in on it, and they are the ones who are going to be the first to move as well. And that really just came from our journey. We were coming in as people who were trading frequently back in 2017, and we just hated centralized exchanges, the hacks, the fraud. We thought there would be something better, that something better could exist, and we just love to build, and we dove into that, and things evolved over time. But that's also where we saw the opportunity for a money market for that next generation of DeFi. And that's really what we were building, what we loved, and we were building something that we wanted to use above all else.
And that shines through with Dolomite. It really does. And that's part of the reason why we're so bullish on everything you're building in the team. It's such an incredible testament to your vision early on, and your co-founders. So it's been a pleasure, and we're excited to see.
It's been a great journey. Couldn't have imagined something like this back. Kidding.
Certainly, especially the headphones, right?
Those headphones, nice touch.
Yeah, it's cozy in here. But Scott, let's jump to you on the kind of lessons or insights.
I say just don't build everything yourself. We were fortunate enough to have some good fundraising early on in Space and Time's journey, largely through introductions from Chainlink. And because we were well funded, we wanted to build a lot ourselves. We built our own data indexer to collect data from blockchains. We built a lot of orchestration services ourselves. And, this was 2022 when we started, and the infrastructure wasn't quite as mature as it is now. And especially now, like if I'm a startup founder today, starting fresh, I'm going to build on a pretty big stack of tools that are already available to me across the board, from, cross-chain swaps to DEXs to data indexing infrastructure, collecting data, or powerful oracles to get off-chain data on-chain or get price feeds back to your smart contract. So like Space and Time spun our wheels in the early days, like of building a lot of the info ourselves because it wasn't quite mature enough yet at the time we thought. But honestly, if we would have just not done that and just waited and just like built the core things we absolutely 100% needed and let the rest of the market build some of the other stuff, like it's matured so much since 2022. And I'm sure in 2022, people said it's matured so much since 2017.
Right.
And so like, don't build everything yourself. Take the team you have, focus on your core product, on what you absolutely need, and build from there. And then secondly, you mentioned like, hey, in the early days, we didn't love sexes or centralized exchanges, I should clarify. And I'd say now, like the second piece of advice is, I don't know if launching on centralized exchanges really matters that much anymore. Like there's really good DEX launch programs now through there's like Aerodrome on Base as an example, one among many, where the DEXs are stepping up, building new tools for essentially ICOs or for fundraising or for launching your token on chain. And I don't, this big push towards centralized exchanges probably isn't as important anymore. So those would be my two pieces of advice.
I'm going to send that recording to my community. No more listings.
Exactly.
So on our end, we evolved. Obviously, we had the vision that from early 2020, because one of my co-founders came from capital markets, that we saw that all financial instruments would run on chain. Like that was the goal. Like we knew it. But we had to start on what was the lowest hanging fruit. And at the time, there was a lot of real estate, kind of like, oh yeah, super heavy asset, you cannot invest and whatnot. So our first approach was, oh, well, let's create a crowdfunding for real estate and we'll put it on the rails. And then we started evolving because the market started maturing. So we have been evolving alongside the market, not trying to over-educate because then we wouldn't have clients. So when people started doing real estate, we started doing the real estate tooling. And then we evolved into private credits. And then we evolved now into our latest deploy that we just now have funds administrations. So we always go with what the market was doing. And I think that's because blockchain is kind of like, it evolves so fast, but yet the product and the business model is not so fast. Kind of like the adoption rate is that. So we don't want to overdevelop. And now also that we maintain our lean structure, we have the vision, the corporate works. And I do believe that we started to add-ons because other people started building what we needed. So we don't build what we don't have to. We just connect, plug and play. And that's basically what is helping us to have a huge tooling box on tokenization. So kind of like my concept here will be, or the best advice is learn to pivot, thrive on the pivot. Don't be scared about the pivot because this is not a Web2. Web2, one day you can hit it. Kind of like, oh yeah, I'm going to do this. And the 100 years you did the exact same. But in Web3, you have to analyze how the market is trending and you have to be quick on that or you can die because probably, like Metaverse, I never believed in it personally, but maybe some founder found the way and they say, okay, Metaverse is going to die, but I can get on some identities that they can do something. So if they started pivoting fast, I found a company who did that. Now they're doing KYCs and they were in the Metaverse and I was like, that's a super hard pivot. But he told me the journey and I was like, Chapo, I think you did great there.
Oh, that's excellent advice. And I think there are many such cases, right, of the most resilient builders being able to find ways to create value, right? We let the market dictate, and also having conviction. It's that balance, right, of like pivot versus conviction, always. How about you, Jared?
Yeah, it was quite interesting what you were saying about developing and not building versus buying, right? And you can't really blame yourself for that because some of these products that have come over time just didn't exist even in 2022. So there wasn't even an option to think about buying it. So we went through a similar thing on our side. And to the point of everyone here, agility is hugely important. And this industry is relentless, but it's kind of the deal that we signed when we got into it because we didn't want to move at a very slow speed of the more mature industries, so banking, for example. And it's something that we're really excited about, but we need to be proactive about because we need to see what is coming in the future, how things are moving in the market, and how we're going to react to it. So with trueflation, inflation is still very important, but there's also so many other assets out there that we want to capture.
Absolutely. No, it's well said. And I think moving forward, we have about 7.5 minutes left on the panel here. The staking community is going to be learning about each of your products, right? Each of your companies. And I want to dive into kind of what's on the horizon for your team and what should stakers and community members, look forward to, learn about your company, and give them a moment to really like internalize some of the incredible things you guys are building. So maybe we can start with you, Jared, and then work our way down this way. And please let us know what stakers should expect.
Yeah, so stakers should really expect a lot more breadth in what we're doing. So we started off going really deep with inflation data, but with the new network that we have the ability to have lots and lots of different data points that might be asset-backed, for example, but also narrative-driven derivatives, for example. So we're seeing more and more. I don't know if anyone saw in the Times Square. I know the mayoral elections. I'm from Australia, so I wasn't able to vote, obviously, but all of that kind of narrative-driven markets and prediction markets is getting more and more. So we're really looking at how do we move the network in a way that we can support people building like that and being able to certify that data as well, which is also hugely important because more and more people are going to be using these markets and they want to be sure that when something resolves, it resolves properly. The other thing that I would mention is more and more AI support. So stuff like MCP, for example, so people can use agentic solutions out of the box on the chain and be able to create these markets, not even themselves. So through AI agents as well. So it's really, really exciting. We're forward looking while also trying to have conviction and make sure our product is true to what we originally wanted.
Absolutely. And it's never been more important in the age of kind of information inflation right now.
Yeah.
Have that. So excellent. How about you, Edwin?
Yeah, well, I'm right now in one of the hottest narratives, which is tokenization, the tokenization of everything. Some things make sense or not, where we're here, and we've been doing it for a couple of years now, 5 concretely. So I want them to understand what we're doing, but I'm going to challenge them. I want to say, we are in real world assets. Jump in the community and test investing in a real world asset. Get your APY of 10 to 50%. Test that kind of like maturity, because the Web2 people are used to even lower interest and we're giving higher. So if they come in and then see that, I want them to understand the value of diversifying a portfolio that is not full in crypto or digital assets, but also some yielding that comes from the real world assets. So I'm inviting them to jump with us, but put 10 euros, not even more, or 100, I don't care, into one of the assets of one of our clients, because we need that adoption. Now we have an oversupply of assets being tokenized, and the liquidity factor is something that everybody is struggling. So the Web3 community should also push that, right? Because if we all succeed, in really every single financial capital market is going to go on chain, and that's going to be trillions and trillions of market cap to our industry.
Absolutely. And Birkin really is pioneering the adoption of those RWAs, right, on both sides. So I'm very, very excited for our community to be able to learn more and dive in. So appreciate that, Edwin. How about you, Scott?
So Space and Time is basically the first tamper-proof database. We invented and patented ZK proofs, novel new ZK proofs specifically for databases. So a smart contract can ask Space and Time to run a query, look up historical Ethereum information, or look up the wallet that's trying to borrow from a lending protocol and see if they've already paid off loans, answering questions for smart contracts that are often complex. And so just today, we announced Space and Time V2, and we're really excited to, here at SmartCon, tell everyone, hey, Space and Time is not just collecting data from major EVM chains and allowing EVM smart contracts to query that data. Now, any financial institution or RWA player or anyone with important, valuable financial data can create their own tables on Space and Time. Have self-custody of those tables, control those tables with their wallet, and then allow their smart contracts to query that data and get cryptographic assurance, tamper-proof assurance that the data hasn't been messed with. And this kind of opens up a whole new world for DeFi and for on-chain financial institutions that need to get like TradFi, market data or balances from traditional accounts off-chain to a smart contract to facilitate usually RWA minting. And we're really excited because there's now this whole market of teams that are creating their own tables on Space and Time. You can think of them almost like blockchain ledgers. And we've been doing a lot of work with Chainlink to use Chainlink as a conduit, as an oracle to get our data from Space and Time to smart contracts for developers in DeFi that are already comfortable with Chainlink, that already, build with Chainlink and already know how to use Chainlink contracts as an intermediary. And then finally, sort of the second, I don't want to say the word airdrop, but the second round of rewards going out to Link stakers for the SXT token, the Space and Time token, is on its way. So we're really excited.
Absolutely. And
great to be here.
Yeah, we couldn't be more excited about the launch and congratulations on the launch today and the announcement as you guys continue to kind of revolutionize how we interact and how people interact with data. I think it couldn't be more important, and it's definitely special to be on the journey with you, and excited for stakers to dive in, test, use, and kind of mess around, tinker with. So, how about you, Adam?
Yeah, at Dolomite, a lot of our focus is making Dolomite your home for yield in DeFi, and that's where a lot of our developments are focused. We're going to be expanding out our asset listings by quite a lot. We have a great roadmap of yield-bearing assets, ones that will provide new yield opportunities. We're putting a lot of focus on our new deployment on Ethereum mainnet, especially around yield-bearing stablecoins. It's been a huge narrative and a great opportunity for people. And to facilitate that, we're working with World Liberty Financial to really grow USD1 liquidity on Ethereum mainnet. We're the first DeFi protocol that they are allocating points to for their USD1 points. Suppliers can earn from that. But on top of that, we're always building out new features to give people more power, more control, more opportunity. And one of those big ones coming out soon is our smart debt and smart collateral. Essentially, you could turn your debt into trading liquidity that people could trade against. And as they do so and pay fees, it pays down your debt. Same thing, you could earn more on your collateral. And it turns Dolomite into a venue for trade liquidity where you could do swaps between various assets, flipping free swaps between stables. And it's all about continuing to build out those opportunities and give people as much as we can.
Absolutely. And you guys have done a masterful job at making it so easy and smooth to really use your product. I'm very, very excited for the Chainlink community to go on and experience that. I know for a lot of people that I speak to about Dolomite, that's the case. So congrats also on the announcement of the partnership with USD One World. Of course. So that concludes our panel. I want to take a moment to thank all of these founders, the grit and really integrity they've led with outshine. I think most of the people I've worked with in my career. So thank you so much. We couldn't be more excited as the Build program and Chainlink to launch with you at our side, Chainlink Rewards Season 1. So I really encourage you all to snap a picture, check the website, go on and kind of support, evangelize, and push this industry forward by supporting the best founders in the space. So thank you all and have a great rest of your day at SmartCon.
Good afternoon. Ironically, my name is also Matt, but I'm Matt Blumberg and I'm filling in as moderator. I'm head of DeFi at Ondo. I obviously know Nate pretty well, but I think just for the audience, it might be good for each person to give just a quick overview of what you're doing in crypto, what your mission is, and what you're excited about.
Great. Thanks for that. I'm Nate Ullman, founder and CEO of Ondo Finance. My background is in traditional finance, originally in private credit, and then I was at Goldman on the digital assets team before starting Ondo about 5 years ago. And at Ondo, our mission is to expand the accessibility of financial products and services by tokenizing financial assets and developing on-chain financial protocols and infrastructure that make security tokens more useful.
Cool. Alex Cordova, CEO of Tradable. I have a background as really a technologist, tech operator, but I've been in traditional finance for the last 4.5, 5 years. Tradable is a private asset marketplace on the front end and a tokenization engine on the back end. We specialize specifically in private credit. That might be ABF, it might be direct lending, other kinds of private alternative or yield generating assets. We really view blockchain or crypto as enablement technology first and foremost. We work almost exclusively with traditional financial institutions, and we view blockchain as kind of best in class market infrastructure more so than anything else.
Yeah, and hey everybody, I'm Jim Hildner, co-founder of Superstate, connecting the world's financial assets to blockchains. We run an asset management business, but increasingly have been focused on bringing equities on chain, tokenizing shares of publicly traded companies and, bringing real world assets into DeFi. Before this was at Compound, one of the larger DeFi protocols. So really understand, how the, systems work on chain. And, the goal is to make them as compatible to the traditional securities markets as possible and grow the size and scale of every on-chain asset, every on-chain ecosystem.
Hey guys, I'm Dan Silverman. I'm the co-founder and co-CEO of Balcony. Balcony is building a foundation for modernizing the world's property infrastructure by bringing land records and the legal process of conveying ownership entirely on chain, thereby creating a transparent, secure, and programmable foundation for real estate ownership. And in order to bring this process on chain and make these tokenized assets authoritative, it requires working with the government agencies responsible for housing and maintaining these records. So we're demonstrating that right now, right across the river in Bergen County, New Jersey, where we've partnered with the clerk's office to migrate all of their deed processing on chain. It's the largest blockchain deed initiative in U.S. history. And the goal is to create a permanent, immutable chain of title that preserves record integrity, mitigates deed and mortgage fraud, and helps bring trust and transparency to citizens, institutions, and real estate professionals.
Cool. Thanks so much. I guess we have some individual questions, just kind of dig in a little more to each project. The first one is for Alex from Tradable. So y'all have tokenized, it looks like, over 2 billion in institutional grade private credit. What do you think is the unlock that makes these assets useful on chain, useful for asset managers? What do you think about secondary liquidity? I mean, private credit obviously has its fair share of skeptics, including me. I'd love to understand kind of how you respond to some of the more common
it's a great question. So for public equities, you've got the DTCC. For public credit, you've got QSIPs. There's there's nothing for alternative assets right now, right? So you've got 20th century solutions to ownership of public assets, but there is no 21st century solution for private assets in particular, right? And so you need, essentially, for what the QSIP was to public debt, you need the alternative for private debt, for private indebtedness, for private credit, for private alternative assets in general. And that's what we view the blockchain as being, that 21st century solution. That gets compounded by the fact that private credit is really unlike any other asset class in terms of the amount of work that goes into it. With public equities or public debt, you buy something once, you get whatever money at some future time. But in private credit, there's a lot of stuff or a lot of baggage that goes with it. You've got middle office, you've got back office, you've got funds flows compliance, you've got do not lend lists. There's all sorts of different things that contribute to transaction frictions in the market. And the way that we view the blockchain, and really how we've been so successful to date, is that we've built a market infrastructure being market neutral, where we co-located the asset, the private credit deal, the facility, with the infrastructure for that asset. So all the servicing, all the waterfalls, payments, flows, compliance, all that stuff is built into smart contracts that act as, essentially, again, the market infrastructure in a very disintermediated and transparent way. That's been the pretty key unique unlock. Liquidity doesn't just happen. Liquidity happens because you've got less transaction friction in the market, you have good penetration, and you offer people something that doesn't otherwise exist that makes some part of the process smoother for them.
I guess, I was supposed to do, according to the agenda here, I was supposed to do a big, how does Chainlink fit into each of your plans thing? But I think it maybe makes more sense to go with the individual questions. How does Chainlink fit in here?
So in any market, you need disinterested third parties who provide data, right? And whether it's Chainlink or whoever wears that role or that hat, you need a way of connecting the outside world into what's happening on chain in a way that, you don't get the First Brands or Tricolors or whoever it is of the world. And then two, you need them to be disinterested, and you need them to act as kind of the eyes and ears of that financial system, right? And so we would expect the Oracles of the world, or we would expect the Chainlinks of the world to fit in there. I think it's a pretty valuable or pretty important role in the financial system in general. And that, I think they've done a good job of it to date.
Cool. My next question is for Jim. So Superstate is, quite loudly approaching tokenization through the lens of regulation, right? Taking SEC registered funds and putting them on chain. What's kind of broadly your design philosophy around blending these compliance first structures with the blockchain, the efficiency, the sort of global nature of the market that makes these things interesting?
Yeah, it's a great question. So there's two different lines of our business, and one very institutional focused and one that's broadly accessible to investors globally, whether they're retail or institutional. I'll start with the first. We run two different funds. Tokenized treasuries has definitely become, one of the larger categories in RWA. Credit to Nathan and Matt over at Ondo for really kicking a lot of that off. But we've taken an approach where we actually are the asset manager for those funds. And so we run an RIA, which is a registered investment advisor, SEC, governed entity that basically looks like a very traditional fund underneath the hood, very vertically integrated in terms of the operations of how the fund operates, the investment management strategy, the custody, and so on and so forth. That looks like a traditional mutual fund or ETF under the hood. the technology that we built on top of that product, as well as our carry fund, is what makes it unique compared to a traditional asset. And so instead of taking a investment into a brokerage account, you can instead hold your shares of those funds as a token on Ethereum, Solana, and various other blockchains. From a design perspective, for those funds in particular, there's an addressable market of addresses, whether they are individual wallets, non-custodial, custodial, or smart contracts that are permitted to interact with those assets. Because it is a security, there is a limited set, of course, of counterparties that can interact with that asset, and especially because the structure of those funds, which are private today, are only for qualified purchasers. But given the DNA of the team that came from Compound, a lot of our folks are ex-Uniswap or various large DeFi protocols. We really understand the mechanics of how smart contracts work. And so embedding the compliance framework that I described in terms of who's allowed to interact from a holder perspective is also embedded into the smart contracts that we work with. Aave being the largest DeFi protocol on Ethereum, they created a separate market called Horizon recently. And within Horizon, there's various institutional products that are allowed to be used as collateral, specifically only RWAs. We happen to be 2 of the 5 assets that are currently listed there. And of the market, about 200 million of our carry fund, which is a higher yield, low vol strategy, which looks like Athena, but in a very institutional CME basis, as like the underlying investment for that fund, can be used as collateral within DeFi. So now you're taking an asset that instead of just holding it, on a website in a PDF or in your phone, you can now actually put it in your wallet and go into Aave and be able to use it as collateral, either loop it or like on Friday when, the market sold off when tariff on 10/10 when Trump announced the tariffs, clients were like, hey, I've got cash in this vehicle. Like, how do I actually go and get, Stablecoins against that? And they could go to Aave and borrow USDC and then go off and buy Bitcoin on the dip or whatever it might be. So we take, a very, kind of like dual-minded approach where, to your point, very regulated, focused on, the infrastructure that's required from a security standpoint, but also how does that marry with DeFi? And I think, our realization sitting at Compound was that, the ceiling for DeFi was only this high in terms of the total addressable market if it's only going to be interacting with ETH or Sol or the assets that were on chain. And so our job was to go off into the real world and try to make as much of the traditional securities markets compatible with blockchains. Then just the last thing I'll add is on the equity side, we are a transfer agent with the SEC. So we're able to work for an issuer, Galaxy Digital being the largest that we've announced thus far, where we actually are sitting alongside their very traditional transfer agent and helping investors that want to take the shares instead of on, the NASDAQ, take the same QSIP and bring it on chain and use it as collateral within a smart contract on Solana. And so whether it's proprietary products that we build or traditional security issuers that we work with, we're helping kind of like have these 2 worlds converge.
Cool. How does Chainlink fit in?
Yeah, so maybe I should wrap that up into all my responses. I mean, Chainlink, brings a lot of the information, both on the funds from a proof of reserves perspective. Like, our money market fund has Bank of New York Mellon as our custodian, but, another level of diligence for on-chain investors is making sure that there's a proof of, what the assets look like in that vehicle versus what, what investors see on the website. And so there's verification underlying that. And then separately for a company like Galaxy Digital, it trades on the NASDAQ, 9:30 to 4, Monday through Friday. There's a price for that asset. And so if you think about market makers, arbitrageurs, or even just investors alike, if you want to go buy Galaxy, you want to make sure you're doing it at a price that you would also be able to get on the NASDAQ. And so, oracles play a critical role in making sure that the price of an asset is also, reconciled with what that looks like on chain.
Thank you. I guess the next question is for Dan from Balcony. So real estate on the blockchain, we've heard it a lot. And it feels like there's a lot of different problems that real estate on the blockchain broadly is attempting to solve. There's liquidity, there's frictions, there's trust. What are the pieces that Balcony is trying to solve, and how do you approach it?
And don't forget Chainlink.
I will not forget Chainlink.
It's okay. I'll remind you.
So the important thing for us is bringing in the underlying data. And what we realized was we needed to mirror the real life process that describes ownership and bring that entire process on chain. So in order to do that, we, in every transaction, there's two distinct parts. There's the settlement where value changes hands and new ownership is conveyed. And then there's the recording where the new deed actually gets recorded in the official government system of record. Sometimes there's as much of a 90-day gap in between the settlement and the recording, which is extremely inefficient. And the players that are involved in this process are the title companies, lenders, brokers, attorneys, et cetera, that are responsible for the actual settlement part. And then there's the county recorder's office that's responsible for the recording. Our approach takes this entire workflow from title clearance and escrow to deed recordation and brings it into a secure on-chain environment. And by doing so, we're able to create a digital system of record that's faster, more trustworthy, and programmable. And the impact of that is that properties will be able to interact with a broader tokenized economy, opening the door for faster transfers, real-time recordings, fractionalization, decentralized collateralization, and stable token and crypto-based settlements, all while maintaining the same trust and legal recognition that underpins real-world real estate today on Chainlink. So as I said, Balcony is in the business of tokenizing real estate at the asset level. And in order to do that, real estate is composed of its authoritative data, its deeds, liens, surveys, permits, and other legal instruments. And without bringing all of this on chain, you can't really have a truly digitally native asset that can be programmed against. So in order to bring all this information on chain, we partnered with Chainlink. So anytime we source government data from one of our partners, a Chainlink Oracle will act as an independent verifier of source provenance and data integrity. That way, anyone who's looking at it can verify the origin and the authenticity of the official record and know that it hasn't been tampered with. So, we think that looking forward, standards like this that combine provenance, interoperability, and these data level attestations will be essential for institutional adoption, and that institutions won't just want tokenized assets, they'll want provably authentic assets that they could trust across chains, systems, and jurisdictions.
Cool. Thank you. And then last question in the individual round is for Nathan. So Ondo's global markets platform is bringing tokenized U.S. equities and ETFs to an investor base around the world. What do you think are the sort of key lessons, whether they're regulatory or liquidity or operational, when it comes to launching these things at scale?
Yeah, so tokenized equities have been tried a good number of times historically. And, there hasn't been any traction yet. I think the biggest reason for that is because they haven't had sufficient liquidity. So if a user wants to go and buy, tokenized stock historically, and I won't name examples, but there's really quite a few of these, but
I'll name examples after the panel.
But the price of that would be like, orders of magnitude worse than if they went to just, buy a stock at their traditional brokerage. So, I think it's table stakes that we get tokenized equities to a point of like pretty similar liquidity and safety as equities traditionally for them to start to take off. I think there is a fairly fundamental architectural reason why it's been very challenging to create liquidity in tokenized equities, particularly those that can be traded permissionlessly, like stablecoins historically. And that's because they have been distributed on pre-funded trading venues. So on centralized crypto exchanges and automated market makers, where only inventory that market makers and other holders who've already, paid for and minted these tokens and have on offer, only that inventory is available for buyers. And so when you look at, hundreds or thousands of equities, it's just, totally cost prohibitive to hold, a ton of inventory on offer. And so we designed a different solution where buyers on these secondary market platforms can make requests to market makers and other participants who can fill those requests to buy different tokenized stocks in a real-time basis by coming to us, minting the stock token. We buy the underlying stock in the stock market, take the advantage of that deep liquidity. And then that stock token gets resold to the end buyer all in, a couple blocks. So call it, a few seconds. And that's really led to orders of magnitude improvement in the liquidity that these end buyers get. And so, I think we launched that 2 months ago now, and there's 400 million or so in value in these tokenized stocks. So I think it's still super early. I mean, that's a drop in the bucket, of course, compared to the broader equities markets, but the growth rate has been super strong. And I think that's the first time we've seen anything more than 10, 20, 30 mil for these sorts of products. So it's very exciting, and we're very, very bullish for what's ahead. And as far as Chainlink, do I get to speak to that too? We use Chainlink in two big ways right now. One is for cross-chain messaging, particularly to institutional permission chains. So the best example of that is what we did with JP Morgan earlier this year, where we made it possible for, and this is a sort of proof of concept transaction, but we're working towards, production rollout. But a user of, JP Morgan's tokenized deposits could buy our tokenized treasuries on Onchain. And they were able to do this cross-chain. So the tokenized deposits are on JP Morgan's Connexus permission blockchain. They're able to do this cross-chain in an atomic delivery versus payment manner, thanks to Chainlink. And then the other use case is related to global markets, where DeFi protocols like Morpho that want to use our tokens as collateral reference Chainlink oracles to set the collateral price. They can reference prices that we provide as well. But, if we were ever hacked for some reason, it would be, catastrophic if the oracle failed and, that led to an unwanted liquidation on one of these DeFi protocols. So we have all sorts of protections against that, but there's always a desire to have, third-party oracles that add additional redundancy for those sorts of black swans.
Thanks. Okay, we have a few extra minutes, so toss-up questions. What do you think is the number one mistake that people in this sort of intersection between traditional finance and crypto tend to make? That's purposefully very open-ended.
Yeah, I'll start. I think what people get wrong a lot of the time is that just because you create a digital representation of something, one, doesn't mean that digital representation is any more valuable than the traditional representation. Or two, that just because you have a digital representation, it doesn't bring, liquidity to a market that otherwise wouldn't have it, right? And so, you need, to your point, you need some 10x reason for me not to go to Fidelity to just buy a stock versus coming on chain to buy it. If I buy the tokenized stock, what can I do with that stock that I can't do at Fidelity or something, or that I can't do at Schwab or whoever else in the world? It's why Tradable spends so much time essentially building, as I said, market infrastructure that's co-located with the asset, because the off-chain version of the asset doesn't have all of the bells and whistles of the middle and back office. I shouldn't have to rely on my counterparty to calculate the right amount of interest I'm due, or to send it to me via wire, or to make sure that my information isn't going to the wrong people. I should be able to see all of that just by dint of the infrastructure in the market. And then on the liquidity piece too, just because, again, you create a digital representation of something doesn't mean that suddenly it's any more liquid. You still have all of the, and you guys I'm sure know this from being TAs, you still have all of the bells and whistles and regulations that go into making an effective market. And with liquidity, again, it's not just being digital, it's, okay, you're digital, now what?
Yeah, I would say I echo the fact that just because you tokenize something doesn't mean that there's demand for it. And so I think when you start looking at something that's highly illiquid, that marks, on a very infrequent basis, that has long redemption cycles, that becomes challenging at least in today's world, be compatible with the velocity of capital that moves around on chain. And so to say that you brought something on that's going to all of a sudden have a bunch of demand is, to me, I think is kind of going at the problem backwards versus being like, what do people actually care about and what can't they get and why is this better? And then, backing into what you actually would create. And I would say the second thing is expectations on timelines. Like, I mean, amazing. It's been a couple of years now and we've got to $8 billion in tokenized treasuries. That is like infinitesimally small compared to the $7 trillion that's in money market funds in traditional finance. And I think we're all excited about the growth because on a scale versus the last few years, it is impressive. Like, don't get me wrong. But there's just so much more to come. And I think everybody is so, focused on instant gratification and instant success that like these things take time. And we're now in a regime in the last year since the election that in the US, you can actually start to do things. But it doesn't mean that the financial system is going to completely go on chain in 2025 or 2026 or maybe even 2035. Like this is, a large foundation that's going to take time to be built. And, luckily we're in a position where the infrastructure is there in terms of chains are fantastic, applications are fantastic. The integration with, the traditional world is growing on a regular basis, but it's still going to take time for this all to mature, for it to really, be a substantial competitor, if not parallel opportunity to the traditional world.
I'm sorry, I was promised 100 trillion on chain next year.
Well, I'm not a consultant, so I don't make those ridiculous claims. I'm actually a realist and I see what it takes to build every day.
We should put it on Polymarket. How many trillions next year?
I'm surprised it's not on there, actually. Might be.
So what I was going to say is like when people think about real estate tokenization, they instantly think about fractionalization and then they wonder why there's a lack of liquidity. And the reason is because they're skipping a step. And we think the first step before fractionalization is tokenization and tokenizing the data and having it come from the legal authority so you could trace the provenance back to it. And that will drive liquidity. That'll open the floodgates for liquidity. So we're kind of taking the approach of setting up the foundation, allowing for this provenance layer so records could come on chain from the right source and you could trace it back. And then the future we see is that people will be able to trade in and out of fractional property shares right from their phone the same way they traded in and out of stocks and crypto on Robinhood today. But in order to get to that spot where we have liquidity, we have to worry about the base first, the foundation.
Ethan, any thoughts on mistakes?
Yeah, I think that people from TradFi can be very hand-wavy about what blockchains can be used for. I mean, I so frequently hear folks, reminisce about all of the problems with TradFi settlement and slow settlement times and, opaque, like disjointed clearing and settlement systems. And even folks from crypto, I think are often very unaware of why things are the way that they are. And so tokenization is not, a magic bullet solution to a lot of this. And often people will sell tokenization in a platform context for a lot more than it is. I mean, there's a lot of platforms that do a lot of like end-to-end automation of like workflow settlement processes that has a lot of value, and they like do happen to do it on a permission chain. And so they make a lot of fuss of the fact that it's tokenized, but that's actually kind of an irrelevant part of it in a lot of cases. That was actually the work that started happening at Goldman a lot back in, 2019, 2020, when there wasn't, the appetite to do interesting stuff on public blockchain. So that's why I left. And, I think there's value in a lot of that. It just doesn't really come from the use of blockchain. I think we have to remember what blockchains are good for. I mean, it's coordinating activities between parties that don't trust each other or don't want to trust each other or don't want to trust some central party to, manage all of that activity. And often in, narrow institutional financial use cases, there is some central party that actors can trust. And so, blockchain isn't necessarily, that transformative. And so, we try to stay very narrowly focused on where blockchain adds the most value. Permissionlessness is a big one. I mean, Bitcoin, really brought to life this idea of a digitally scarce asset that could be held by anyone, transferred anytime, anywhere. And, that is the innovation that we are focused on repurposing for, the broader financial landscape of treasuries, stocks, bonds, et cetera. There certainly are exciting institutional use cases as well, but we just have to be sort of very precise about the use of blockchain in those.
Yeah, it's a very hand-wavy part of the space, right? Because you have people who don't understand the other side very well, and you have TradFi people that come in and think blockchains do all these things, and then you have blockchain people that think TradFi does all these things just because of like path dependency, where sometimes like something like 2+2 settlement actually can be valuable in a lot of cases, right? And it improves the liquidity profile of trad markets. Okay, we have just a few seconds. Where's the best place for people to find out about your projects?
Ondo Finance. What are we on Twitter? Ondo Finance.
At Ondo Finance, I think. Yeah.
Tradable.xyz, our website.
Don't follow me on Twitter. I am very boring, but superstate.com. And then Robert Leschner, who created Compound, is definitely a guy to follow.
Our website is balcony.technology, and our Twitter is at balconytech. And if you want to look up more about the Bergen County thing, you could just Google Bergen County and Balcony.
Cool. All right. Thank you so much, everyone.
What I want to talk about today is what I might call the institutional speedrun. It's very clear among this audience, I've never been at a crypto conference with so many suits, and that is a very positive thing, I think. But it's also the case that we've been playing this dance for a very long time. And so what I want to do today is share some perspective from what Optimism gets to see working with partners and from what we've seen from years in the industry on the space. Because guess what, guys? Enterprise blockchain is nothing new. It's all been here before. We've seen it before. In fact, I'm very thankful for Chainlink to having me. I feel like the OG, the original blockchain with enterprise maybe was Chainlink with their Swift announcement. I've been literally hearing from 2016 that Chainlink is going to bring Swift and the traditional financial rails into the world of crypto. And it took a while for us to get there. So we've seen it before. The question is this time different? I think if you look back to what people were saying in this era of crypto, there's a way to read between the lines. All of the announcements during this era were things like, we're launching our digital asset initiative. We're launching our pilot program for a revolutionary blockchain stack that's going to transform finance. And really behind the scenes, if you read and translate that, what that really meant was, I don't know what crypto can do for me. I'm not sure crypto can do anything for me, but I need to market that I'm at the cutting edge, and I need to hedge against it becoming something. So this was like the 2017 era narrative that we had. I think it's fair to say that today is different because we're actually seeing people moving meaningful financial products on chain. And if you read that between the lines, that looks very different than launching a pilot program, than doing your next initiative. It means that you as an enterprise have evaluated an opportunity and determined that there's an ROI that is worth it for you. And on the scale of the businesses we're talking about hundreds of millions of dollars. So if we're going to try to interpret people's actions as words, I think that this era is different. I think it's fair to say that there is a difference. But I also think we should think a little more critically. Now, look, it makes sense that this might be the time, right? We have the tailwinds, we have the momentum. Capitol Hill is engaging with people now. We're hearing from our partners, and in our experience, you could actually go and talk to these people and not be laughed out of the room in a heartbeat. We, of course, also in the last year had a very big deal. The Genius Act was passed, and that meant that we have regulatory clarity, especially around stablecoins. And ultimately, there's more work to be done here. We can argue all day about whether this market structure clarity bill is going to succeed or it's going to, die in some deadlock. The point is, this isn't needed. We already have enough clarity. People are starting to move on chain. So this is a big deal. It's real. And then if you look at the numbers of what's actually going on in the industry, you can also point to a lot of momentum. Stablecoins are at $300 billion. That's an eye-popping number. 300 billion is a lot of dollars. And it feels like every week, new announcements are coming out. In fact, arguably, I think if I had to point at the 3 top trends of institutions moving on chain, they're all about stable coins, right? Not only is the TVL going crazy, but yield protocols are going crazy. We see folks like Aave and Morpho absolutely overwhelmed with inbound supply. And even on a mimetic level, stablecoin chains are the hot new meta about block space. And we've seen a lot of, iterations of the next hot chain thing to be doing. Right now, it's stablecoins. Ultimately, I would say, honestly, all of this is really dwarfed by this one chart right here. And this chart, to me, is tangible proof that stablecoins are finding product market fit in a way that is decorrelated from the rest of crypto. So if we look at years prior, what is this graph showing? This graph is showing in the bars, we have spot trading volume in crypto, and the line is transaction volume of stables. What this shows is that in the past many, many years, and up until this year, what was the primary use case of stables? It was clearly to dump your speculative assets into. This chart over the past year is different. That is decorrelation if I've ever seen it. And that is a big deal. It means that people are finding use cases for stables that are outside what we normally see in crypto. I'm going to be talking about the speed run of institutions. This is also a speed run talk because we've got 15 minutes. So obviously we've got more acronyms than the bankers, it feels like these days at times. And there's a lot of great stuff that's going on. Real world assets are 30 billion. That's an order of magnitude lower, but surely nothing to scoff at. We have their ETFs, digital asset treasuries, all these things that felt like edge cases. Oh my God, is it going to happen? Have all come true in the crypto industry. So it must be the case, right? That we are at the finish line. We are all doing a speed run. Look at all these institutions coming on chain. Spoiler alert, I know it's hard to tell these days, but this is an AI generated image. And you should in reality be a little more dubious and look a little more critically. Is the institutional speed run real? And I think even at a deeper level, it's not about, is it real? It's hard to argue with the numbers that I just showed you. But it is also the case that not all of it's real. And I think it's important for us to dissect and try to examine what if it's going to pan out and what if it's not. Because I got news for you. We're seeing a major announcement every week about the next institution moving on chain. 1 year from now, that is not going to translate to one launch per week of game-changing products that transform our industry, that transform capital markets as we know them. They're not all going to pan out. They're not all going to work. They're not all going to launch. Many that launch will fail. So I think it's important to think a little more critically, and I'm lucky enough to be in the position to talk to a lot of enterprises. If you don't know Optimism, we're a scaling solution that powers a bunch of Ethereum layer 2 chains. What does that mean? It doesn't matter. They're chains, and a lot of big institutions use them. And so we have big numbers. We're not just using those chains as a small infra partner. There are huge amounts of assets flowing through these systems, many successful chains. That's really exciting. And I could take the approach of going and pitching you guys on the wonderful properties of the OP stack and why all these partners are choosing us. We have such modular technology. It's really well battle tested. We'll hold your hand through all the parts that you don't understand. The reality is none of that matters. What institutions need to understand is that there is now battle tested, relatively turnkey infrastructure at scale. And that is something that was not true in the past. And the reality is that just launching a chain is actually only one component to moving a product on chain. In fact, there are several steps before you even start thinking about the important stuff of your product and distribution. And the reality is you need to be thinking as an institution critically, again, how can I minimize my time spent on this part of the graph and keep all my time focused on my unique value? That is what we are seeing the successful projects and the projects that we get excited about building. It's the people that are focusing on their unique value. Product and distribution. So we have the clarity to be able, no pun intended, to be able to start making moves in the crypto industry as enterprises. We have the infrastructural capacity to support those movements. These are two big unlocks. And I think that you could make a case that this is the era of the institutional speed run based on that. But the reality is I'm cheating if I give you that answer, and I'm cheating if I give you that argument, because these are just unlocks of problems that in the past were preventing anything from happening. But that's not the same thing as saying all these institutions are going to be very successful when they move on chain. And so what does it merely mean to speedrun? It needs to answer the question, why? Why should an institution come on chain? What is optimism, and what are we seeing those successful institutions doing? And that kind of comes in 3 layers. So the first layer is kind of the most simple. It's solving pain points. Maybe disintermediation is the fancy legacy. I'm an OG blockchain guy. I love disintermediation. That's what it's always been about. Another way to say this is just solving legacy pain points. If you look at something like transferring assets across borders and you compare what that looks like in a traditional finance environment to blockchain, it's just night and day. It's overnight. There's no crazy settlement times. It's anywhere in the world and it's seconds. But in reality, I think solving the legacy pain points is the smallest piece of the opportunity. When we see partners that we get really excited about and they're getting really successful, what are they focused on? They're focused on distribution. They're focused on realizing I have a bunch of users in my traditional ecosystem, and it is more valuable to those users if I bring that distribution on chain. Why? Because it gives my customers more things to do in fewer clicks, and that equals more business, that equals more value. And then, of course, most fundamentally, why are we all in this if we're not actually fundamentally innovating? And that is the bread and butter, most exciting potential that an institutional speedrun has. It's not just taking a bunch of legacy components and making them better. It's not just taking a bunch of existing users and giving them a little bit more to do. It's about providing fundamentally new products, speedrunning the creation of new markets, and transforming the industry in that way. So to me, it's like the crypto speedrun is running really fast in this direction. We want to solve the legacy pain points. That's easy. The real money is in leveraging your distribution and using that to build new products. And from what we're seeing in the market, this is being speedrun. I think if you are just thinking about how can my legacy infrastructure be improved by the power of crypto, you are already behind in your thinking. When we talk to folks, what we see is that major players are sitting in, how am I going to leverage my distribution? And what are the fundamentally new products that I couldn't have built before crypto that I now can build? That is where they're focusing their time. And they're thinking not on the order of months, not on the order of removing one major pain point. They're thinking on the order of years and launching massively transformative products. Ultimately, I guess you could still keep saying, why, Ben? What does that actually mean? You're just saying a bunch of words. So I'll try to speed run in my last couple minutes here. What does competitive look like in this context? What are people actually building? And what are the lessons that we're starting to see people learn as they progress through the institutional speed run? I think the most obvious one to say is that distribution is really key. So people have an understanding, which is, by the way, for those in the audience that are really crypto focused, this is an understated thing that crypto missed for so gosh darn long, is the fact that you need users to build good products and you need to provide a good experience to them. Outside of, within our little crypto bubble, we spend a lot of time building for a lot of people that we thought existed, but we had never talked to. And it turned out there were only like 10 of them, right? I think the other thing that we're seeing is that just put it on chain is not going to cut it in this era. One of the reasons that I think we saw so many of these 2017 era pilot programs, institutional digital asset initiatives failing was because they kind of completed it. And at the end of it all, it was like, well, we moved our database to a backend that even fewer engineers understand. And that's great, but we don't see the upside from that. That's just a change in the backend. And what we're seeing is that in reality, you have to go think with the next step in mind. Once we've moved the server backend to an on-chain environment, what are the new products that we can build that unlock change? And to me, like when I think about that in my Ethereum engineering brain, that comes down to composition, right? That comes down to composability. So the fact that we can take many products on the same server backend and compose them together is the superpower of crypto. I think an unsolved or a problem that institutions are just starting to grapple with and comes to terms with now is the double-edged sword, the trade-off filled nature of bringing applications on chain. One way to think about that in a more traditional, like put on my consulting cap, it's the customer journey matters, and I need to think about the long-term customer journey. I think if I were to dumb that down into like blockchain language, it's like you take all your users, you put them on chain. Now they have a bunch of one-click options for other things they can do. That's great for my distribution, unless their click is to go and bridge somewhere else and do it in somebody else and use somebody else's products. So this is the double-edged sword of crypto. It is simultaneously a superpower that the walls between silos of our infrastructure are just completely non-existent. At the same time, you have to think through what it means to be building an ecosystem that doesn't have walls in the same way that traditional finance rails do. I think last but not least, what we're realizing is that pay-to-play and incentives that kind of worked in crypto are not going to be worked in like earlier cycles of crypto, are not playing out as well in this era of bringing real institutions on chain. So what do I mean when I say that? What I mean is that people are pumping incentives into stablecoin programs. And while they see improvements and rises in their TVL and metrics, while those incentives are there, many customers are realizing that once those incentives dry up, those customers that they brought were not loyal customers and that they will go elsewhere. And I think that's, maybe another way of talking about number 3, that is a signal that you're not thinking about the long-term story. But very particularly in the world of stables, this is what we're seeing, is that pay-to-play incentives are not sticky and folks go elsewhere. One other thing that we're seeing is that, how do I want to put this? I guess one other thing that we're seeing is that you need to be thinking steps ahead, and you need to be thinking about what the rest of your market participants are doing. So what I mean when I say that is, we talk to a lot of folks where they say, oh, we have a bunch of idle assets. We see all of these earn programs and these stablecoin yields. Obviously, all we need to do is take these idle assets, put them into a yield-bearing form, and return that to our customers. But the reality, especially in the world of lending, is that there are 2 sides to this marketplace. And you are one of many market participants that are providing supply into the lending environment. And so the implication of that is you need to think years ahead of what happens when more people provide supply and where is that demand going to come from. So what we see in the institutions that we think are doing very, very well here is they are thinking years ahead, not just about, oh, there's a source of yield today that I can plug into, but they're thinking about there's a demand side and a supply side, and both of those curves have to match over a long period of time for this to be a truly sustainable business. So if you're just thinking about plugging in your yield, that's not going to cut it, because yield is a function of 2 sides of a market, and you can't only think about one. Look at that timing. We're at exactly 0. Number 6 is the shill. Finding the right partners matter. I happen to think that Optimism is a great partner, so you should come and talk to me. We are building the largest shift in decades of institution. I think that absolutely, unquestionably, the speed run is real. It's about finding the winners and losers, and we are here to help you hit the ground running. Come find me after and hit us up if you're in the live stream, wherever the camera is, at Optimism on Twitter. Thank you very much.
Machine learning is a data-hungry endeavor, and machine learning systems, in consequence, have consumed a mountain of data, a vast amount of data, to the point where essentially we are running out. In the sense that we're running up against the limits of useful information scrapable from the public internet. So the problem fundamentally here is we're running out of data because there is only one internet. But is this actually true? In some sense, there are 2 internets. There's the surface web, the publicly scrapable portion of the internet, and then there's the private web. The private web is the portion of the internet that is only accessible through access controls, the walled-off portion of the internet, if you will. And this is where I would argue the most interesting data lives. Things like health records, email, financial documents, sensitive data live on the private web. It's estimated that the amount of data in the private web is 2 orders of magnitude greater than that on the surface web. But the data, all this data on the private web is largely unusable for machine learning purposes. And the reason is essentially a security-related one. Let me explain by way of example. All right. Let's suppose that somebody is training a health diagnostics model and training it on or fine-tuning it on electronic health records. Alice has an electronic health record that she would like to provide for the purposes of training this model. The problem she is naturally going to run into in most cases is that most web servers don't support general-purpose, secure third-party data sharing. There's no easy way
for Alice to relay her electronic health record to the entity that's training this model unless there's some kind of pre-existing relationship between her health provider and this entity in general. And so this doesn't quite work. What Alice can do, of course, is just download her electronic health record and then upload it to the training environment. But if she does that, two problems ensue. First, there's the problem of privacy. Alice is sending it into this environment, but she has no idea whether her electronic record will be protected there. Second problem is one of integrity. Whoever is training this model wants to know that the electronic health records it's ingesting are authentic. They actually come from real healthcare providers. But if users are just uploading documents, there's no such assurance. And so we have these two security problems. How can we address them? This is where blockchain technology can be helpful, and not just in a blockchain context, in a general sense. If we plug in an Oracle, and in particular a confidential Oracle system, like Towncrier or confidential HTTPS in the CRE as introduced yesterday, then we can ensure that the electronic health record Alice is providing is authentic, hasn't been fabricated, hasn't been tampered with, and Alice can do things like privacy-preserving filtering of her electronic health record, can release only the data she wants to release. All of this can be done with no modification to existing web servers. This is the beauty of confidential Oracle systems. Alice gets other privacy protections as well, and there are other integrity properties here that I don't have time to get into. This idea, generally speaking, we refer to as props or protected pipelines. The idea is that using the confidential Oracle system combined with other privacy-preserving systems like trusted execution environments to do model training, we end up with a full end-to-end security perimeter so that the integrity and privacy of the data being ingested by the system are protected from the time that they're sourced through the time they're used and beyond, potentially. Well, this setup I've shown you looks a lot like the Chainlink runtime environment, the CRE, with two features involved. Confidential HTTPS to source Alice's data, again, from unmodified web server. And this is based on Towncrier or Deco, as Sergey mentioned yesterday. And confidential compute, a protected environment to do the model training or fine-tuning. So to summarize the benefits you get here using props for model training, there's an explicit step involving consent of the user, consent by the user. Alice is the one who logs in and grabs her electronic health record in order to relay it to the entity training the model. We get this property of data authenticity. The provider knows that the EHR came from an authentic healthcare provider. And we have the form of confidentiality or forms of confidentiality that I described. Basically, Alice's records go directly into the training environment. And once the model's trained, her electronic health record can be deleted. And again, no modification is required to existing infrastructure. So that's the benefit of props for model training. Props can also be used for inference. For example, suppose that somebody is selling a token, can only sell it to accredited investors, investors who have the financial resources to incur the risk that this offering may involve. Well, what props can do then is ingest financial records from trustworthy sources, financial institutions, the IRS. Right? Alice can, for instance, provide a transcript of her tax filings. And an LLM can process these documents and determine whether Alice is indeed an accredited investor. All of this, again, can happen within a security perimeter, the security perimeter defined by the prop or props. Exactly this setup we have in fact fully implemented in a demo, which my colleague Philip
will come up and describe to you. Go through it step by step so you understand exactly how the system works and what security assurances it provides.
Well, cool. Thank you, Ari. Welcome to the demo part of this presentation. Happy to walk you through how we actually implemented this accredited investor workflow in the CRE. So instead of going through this high-level diagram here, I will actually go step by step and show you how the application actually would run from a user's perspective. So this kind of flow starts, in this example, at Demo Invest, an investment firm which would like to provide a product to a user which requires accredited investor status. And this system then would interact with our system to indeed confirm that the user is an accredited investor. Here on your left side, you see which parts of the system are currently interacting. So at the start here, we just have a user interacting with the website of Demo Invest. When the user starts this authentication flow, he is redirected to the Chainlink workflow running our accredited investor verification process. There are two options here. A user can do to verify its accredited investor status. For the sake of this demo, we will go into the first flow where we verify based on income. So on this page, the user selects whether he wants to do a single filing or a filing with his partner. For simplicity, again, we go for single filing. And then all the user basically has to do is to sign into the IRS website. From there on, we will be able to access the data in a secure way, fetch it into our secure systems, and then do the analysis on the data. So from the user's perspective, the user sees typically login as you would see with the IRS. But what in the background is actually happening is that this authentication flow is tunneled through the Chainlink confidential computing environment. In particular, his credentials are forwarded through the runtime that we provided, and then are tunneled and available for the TE to use to access the data on the IRS webpage. And we use these credentials the user just provided to fetch the tax return transcripts for the past 2 years. This is an example of how such a transcript looks like, contains a bunch of financial information about the user, which should be kept private and secure. And the user starts this documents automatically uploaded into our system, and then the verification process starts. So here, the documents that we fetched securely from the IRS website are processed within a secure trusted execution environment, and are fetched and provided to the LLM for processing. For the sake of this demonstration, we used a very large language model using roughly 400 billion parameters and like a RAM size of roughly 250 gigabytes, the Llama 4 open source model, which is actually a bit overkill for this use case. But we just wanted to show and experiment on how big of a model we can actually run within the constraints of a secure system. This is the key point here. So after a few seconds where this verification takes place, the user is either greeted with a screen saying, hey, cool, everything is fine, or a failure case. Let me go forward with the successful case first. So here there's just a legal requirement where the user also needs to confirm that he is indeed knowledgeable about what an accredited investor is and he meets certain criteria. So the user confirms this legal requirement. And then the system steps are basically completed from our end. Apart from one last thing which happens here, which is that the trusted execution environment creates an attestation confirming that indeed this particular user, with the information fetched from the IRS, is an accredited investor. This is basically just a single bit telling yes or no. And the private information, all of the sensitive data we fetched from the IRS are kept confidential within the trusted execution environment and are never forwarded back to the demo investment page, which required this verification in the first place. After this step, the user is redirected back to the original investment for our website and can there proceed with investing in these products which require an accredited investor status. And the final step is also that we will delete, at this point, we can delete all the data that was previously used for processing within the TE. Now I'm going to show you what happens in case something goes wrong. So for example, the user doesn't meet certain criteria required to be an accredited investor. So the user is redirected to a failure page instead of the success page we saw before. And here we give the user the opportunity to ask the large language model that we use to evaluate his accredited investor status to figure out what is actually wrong with his or her application. So we can give the user access to the large language model running inside of the trusted execution environment with the private inputs we fetch from the IRS or other private inputs that are just available for this particular user to use. Never shared with any third parties like typically ChatGPT or Google Gemini or these kinds of parties. Yeah. And I think with that, I'm already finished with this brief demo. For more details, please check out our paper here or talk to us afterwards. Thanks so much.
My name is Harry and I lead the developer relations team at Chainlink Labs. And today we're going to be talking about CRE. Now, I know that many of you have heard a lot about CRE over the past day and a half, 2 days, but this talk is all about the developers. We're going to be talking about how CRE enables developers to build quicker, build better, build more efficiently. We're going to talk about how its capabilities unlock powerful new use cases for the builders in both the on-chain and the off-chain world. And we're also going to be touching upon the power of building with developer platforms and the superior developer experience. I'm joined here today by a bunch of very highly respected and esteemed technical leaders in the blockchain ecosystem. And I'm thrilled that they're going to help me participate in this discussion. Gents, do you want to introduce yourselves starting from this side?
Hey everyone, my name is Rahat. So I lead DevRel over at Move Industries or the Movement. Kind of focused on building out a good developer experience for folks there. Excited to be here and talk more on Siri.
Hey everybody, my name is Patrick Collins. I'm a co-founder and CEO of the Cypher team. We do security and blockchain education, doing everything in our power to make developers and security researchers' lives easier and make all the smart contracts safer.
Cool. Hi, everyone. Bogdan, one of the co-founders and CTO at Tenderly. Tenderly is a full-stack infrastructure platform for Web3 teams. Concretely, we do developer tooling, observability, testing, and production infrastructure.
Hey everyone, I'm Jake, co-founder and CTO at ThirdWeb. We help developer build, monetize, and kind of scale the application, Web3 applications. And more recently, we're thinking a lot about like the intersection between AI agents and crypto. So I excited to be here and talk more about this.
Thank you. Okay, so let's start off by just touching on your experiences with CRE. Now, CRE has been live now. Some of you may have played around with it a little bit earlier, but despite you being CTOs, CEO, and co-founders and head of DevRels, you're all technical people. You're all builders. I'm interested to hear, what are your thoughts after playing around with it for a little bit? What do you think of CRE in general? Rahat, maybe we can start with yourself.
Yeah, I would say it's definitely, I love the fact that I was able to just go into CRE and just start. It almost felt like this is a platform where a bunch of the different Chainlink services can kind of come together, just be more accessible, easily used within the platform. I definitely, as I was reading through things, loved the, was super interesting to kind of see blockchain fundamentals kind of be brought into API calls and everything like that with consensus kind of being attached to I'm not sure what you guys call it. Sorry.
Consensus computing?
Consensus computing. There we go. So it's definitely cool to just kind of see that in action, that when I went through just from a builder perspective, doing the on-chain calculator tutorial that exists there in the docs. It was cool to just see API calls and then calls to on-chain contracts and just being able to mix all of that together and build something on top of that is definitely very, very cool.
That's fun.
What's the question again?
What are your thoughts on CRE, Patrick? You've played around with it a little bit now, haven't you?
I'm like trying to figure out how long I want to talk for.
You have 60 seconds.
Oh shit. Okay. I swore. My bad. So Chainlink CRE is a product that I was able to beta test, and I gave the team a lot of feedback. And it's a product that, if you've been following along the Chainlink ecosystem, that has almost kind of gone through some iterations, right? If people remember Chainlink Functions, this is almost like Functions 2.0. And before Functions, there was a product called Any API. Now, blockchains are, in my opinion, not that interesting without a connection to the outside world, to external data, to external function, to external whatever. And right now, Chainlink's done an amazing job making price feeds, which has basically given rise to DeFi. And we haven't really gone that much farther outside of price feeds. We've done proof of reserves. We've done, getting maybe like index data or like basically other derivatives of prices. But we have the power to have these smart contracts do anything. But we haven't had a product that is able to reach out to the real world in a decentralized way and do anything. And to me, this is something I've been dying for pretty much my entire crypto career, like a product where in a decentralized manner, you can reach out to the real world, you can do things that are really interesting, and then have your smart contracts react in a censorship minimized, a trust intermediary minimized manner. I'm going way over than the 60 seconds, but so I've been dying for a product like this to exist. For whatever reason, Functions and Any API didn't quite take off the ground as much as we would have liked, or I would have liked. But I'm really hoping, with kind of more traditional, finance and money looking at this space, they have these creative ideas on how to make creative products, and they go, well, how do I do this? Well, I need a decentralized, almost like cloud product, and boom, Chainlink CRE is it. Like I said, I was able to beta test kind of the early version of Chainlink CRE. I gave a lot of feedback, but I think where it is right now, you can do some really cool stuff already. And I really want to see people make some amazing stuff with this.
Awesome. Thank you. The thing for me, and I'm going to talk about this maybe even too much during this whole panel, but I love how the abstractions are extremely simple, but you can still do complex stuff. Mainly, I'm talking about the term in CRE called capabilities, which completely abstracts the chain reading and chain writing into how you move data around. To me, that's the most powerful thing that I saw while we were using CRE. I'm going to talk a bit later what we were doing with it. But as I feel like 2026 is going to be this crossover year crossover year where the Web2 companies or the traditional finance companies are coming to Web3. I honestly believe after 8 years in this space that the whole point is to show people that this is not a different type of development. It's the same type of development. And CRE, I think, looks sufficiently enough like the traditional stuff that exists, but has all of the powers that Web3 gives it. The main thing is the powerful thing of just doing a simple HTTP call in Web2 that's not provable. Here, suddenly it's proved automatically for you. Again, a capability. So simple abstractions, but complex use cases is the takeaway for me in beta testing them.
Awesome. Yeah. And talking about that, Happy is saying, we work with a lot of developers, and a lot of time when you tell developer hey, this thing's not suitable for a smart contract on-chain, and it's, that there's a whole interaction and just figuring out what's on-chain, what's off-chain, and then what's approvable, what's not, what's verifiable, and what's not. I think CRE really, elegantly unify pretty much everything that you would need to do as a developer, and giving you a really nice set of abstractions and interface, and giving you the value of, building the Web3 space as well. Thinking about decentralizations, thinking about, minimizing trust. And CRE just kind of tied that very nicely. And, one line of code, two line of code, you're able to set up triggers, a crumb, based on timer, HTTP, or you can base any events. And that unlock a lot of different use cases that would have been otherwise just not able to be not verifiable systems. And I think CRE just makes it so that it's verifiable and just very simple to set it up as well. And there are a lot of use cases that kind of come from here, and we'll talk a little bit more about that too.
Yeah, let's actually go straight into use cases. So I'd love to hear on your perspective, what are some use cases that came to mind for you when you started going through the CRE docs and started playing around with it? And which of those, if any, do you think could be harder or even impossible to do when you're looking at just a blockchain?
I think there's a couple of things that, like, ideas I kind of like in my head as I was going through. One is like doing, so this kind of like was inspired. There's this video on Twitter of like a couple of AI agents who like came in and were like trading shares and different dexes. And I thought, okay, cool. Now what if we had, let's say, not everyone has like that risk appetite to like give a bunch of money to some agents and hopefully they make a bunch of money in perps. So like, what are different levels of risk you can kind of like build out, experiences you can build off of people? Kind of like a cross-chain yield aggregator when it came to mind, maybe an agent that kind of like looks at the different yield opportunities that are available across like different chains that Chainlink can like look into. And then you have like some off-chain service that is the AI agent essentially that executes like these transactions on these chains, depending on like where you want to ape into, I guess. So I think that's pretty cool. Another thing that kind of like came to mind as I was thinking a little bit deeper is just like AML, anti-money laundering. Just like with blockchain alone, it's kind of hard to do something like that. With something like CRE, you come in, you could like cross-check reference against like, I don't know, some like blacklists or whenever list exists, and kind of like bring that information to like some on-chain features and do a little bit of that there too. So I think just like in general, as you're like looking at this combination of like on-chain and off-chain data and capabilities, it's really cool to see the different possibilities that come out there.
Yeah, it's funny you talk about compliance. Actually, we have the Chainlink ACE automated compliance engine, which actually uses CRE to do exactly what you said. So it's got the on-chain part and then it's got the off-chain part, right? And you can define policies that say, hey, we can't send any money or value to this address unless it passed this policy check. So that's a great example.
Nice.
Patrick.
Yeah, I think, if you look at the history of like the smart contracts, like for a while, we were really into these purely on-chain contracts. And we thought, hey, let's like do this pure on-chain mechanic. And we quickly decided that was not very interesting at all, right? DeFi didn't exist until Chainlink price feeds existed. They needed some type of connection to the real world. And, Chainlink price feeds came on and boom, now we have DeFi. So the next boom, the next thing is going to be with some connection to the real world, right? So we're talking about like compliance, boom, that's a use case right there. So for me, the summary of this product is really like, okay, the next big cool thing that you want to do, like this is your edge to get it, because just having pure, the pure on-chain smart contract, there's really not much, innovation that can happen there. Well, I mean, there is, but the world of creativity is completely wide open with a product like this. Compliance is something that they just mentioned. I think that any of like the real world assets conversations people were having, in order to tokenize real estate or like tokenize a business or have some type of financial product with a connection to the real world, you need kind of a decentralized cloud that has that connection. Boom, this would do that. If you have really expensive computation where putting this function on chain would cost $1 million in gas, it just doesn't make sense. Great, you outsource it to the decentralized cloud, to the Chainlink Siri. Boom, your use cases are just blown wide open. I know privacy is kind of a big theme here. If you have a really, really expensive proof that you need to validate, a mathematical proof, boom, run it in Chainlink
exactly.
Chainlink CRE, get the result back, and boom, you can do these crazy proofs that are validated on chain, and your exposure kind of grows there. But yeah, like literally, like if you go down the list of ideas or innovations or things that they're talking about in politics of like what's coming next with the blockchain stuff, I think honestly it's going to happen through this. And literally anytime someone brings up like, oh, I wonder if we could do this in the cloud, or I wonder if we could do this on chain, I almost immediately go, okay, if you can't do it purely on chain, CRE. Like if there's if you have an idea, you're not sure how to implement it, I almost guarantee you can do it with CRE. So that's like what is crazy powerful here.
Awesome. Thank you.
Yeah. For me, I mean, talking to these, again, we call them Web2 crossover companies. So moving from traditional finance into DeFi or connecting the world. I'm not going to give the creative answer. I'm going to give the boring answer.
Hey, that's a good answer. I like boring answers. Yeah. There's a lot of money in boring answers.
Yeah. That's most of the money is unfortunately there. But there's decades and decades and decades of infrastructure being built.
Exactly.
And now when we're talking to these companies, what we see is nobody's like, hey, we want to rewrite 50 years worth of our stack. Nobody talks about that. Everybody's trying to technically, I love the term bodge, but they're trying to force the blockchain ecosystem into their existing ecosystem or their existing ecosystem into blockchain. And I honestly believe it's going to be cramming blockchain into the existing ecosystems. I think we're foolish to think that an industry that has existed as much as the human race will conform to something else. CRE is the perfect solution for that, because now if you have 10 teams managing 10 different legacy systems, if you're Fidelity, if you're Citi, if you're whoever, CRE is the perfect way to once do the on-chain integration, and then just these subsystems are calling the same integration. So the thing that excites me, because I'm excited by bringing more stuff on chain, is the actual boring use cases of plumbing, where I think CRE will thrive.
Yeah, I agree with you. I think things like stablecoins resonate with me a lot, especially because CRE enables many of these traditional financial systems to easily integrate with blockchains without having to manage things like RPCs and things like that. But we'll get to that in a minute. Jake.
Yeah, and adding on to this, is like, maybe it's interoperability. It's kind of like, like how from the existing infrastructure to this kind of this new infrastructure, or I think like CRE does offer very interesting solutions. And I think that, even if you think about just authentication, right? Like you as a person, as an identity, like how do you prove yourself who you are? And I think CRE can, in a way, be the authentication technology of like identify who you are and combine that with a wallet solution, like a smart account contract. And that allow you to kind of, bring your identity of who you are and transact on the blockchain. And as we kind of go down the stack of like thinking about like money movement on the blockchain, there's more than one blockchain, unfortunate reality. And, like moving money or moving assets across different chains, that's also something that I think CRE really shine on, because one, CRE supports multiple blockchain, and two, it offers a verification, a way to verify that something happened. And what that really means is, when you think about like a bridging product of like moving asset from one blockchain to another blockchain, you can actually, one, just create a trigger to listen for a contract event, and then, do an issuance or do whatever you want with it to validate it. And then after that, you can issue the asset on the other chain as kind of a cross-chain bridging solution. And then there's more than that. There's just like, if you think about just like AI agents, it creates a more trustless way for AI agents to actually execute the code and logic. And CRE can be the runtime for these agents, can be the verifiable execution for these agents. And, obviously there's some nuances on like deterministic execution, but I think CRE does have like some solution and some foundation to kind of set up with it. And so there's just like, a lot of different use cases ranging from like wallets, authentications to, money movement on the blockchain, and obviously proving of assets, to just like thinking about more the intersection around AI agents as well.
Yeah, I actually did a demo on the main stage yesterday, exactly what you discussed, but we had an AI agent pick the 3 best responses to a question that we put out to the crowd. And we used CRE as a way to validate what the AI agent did before we transacted the value that was going to happen after, which was free SmartCon pickers. So you can ask an AI agent to do some work and it can think for itself and it's very clever, but the AI agent is not always correct. Sometimes they can act a little bit weird. Sometimes they say things that are wrong. And the thing is, they have high confidence in their responses. They're like, oh, yes, this, and this. And you're like, no, that's not the case. So in this case, we offloaded the verification part to CRE, to the application where you know what the code is running, you know that it's verifiable, and you can give it certain rules. And you know when all those checks are done, you know how they were done, and you know that they were done in the correct manner by this other system, and you're not just trusting the AI to audit itself, basically. Okay, let's move on because I know we're behind schedule. I know all of you are no strangers to developer platforms, so I'm keen to get your thoughts on what makes a good developer platform and what are the benefits of developers having a unified stack to build with. Maybe this time we will start with you, Bogdan.
Sure. So Tenderly has 5 pillars, and what we saw by 5 pillars, I mean developer tooling, again, testing infrastructure, observability, production infrastructure, and security. So the thing that we saw is that developers naturally gravitate towards a single place for multiple solutions. I think CRE is finally dead for Chainlink because people so far would either pick CCIP or price feeds or Chainlink functions or the VRF stuff, etc. CRE is now finally a thing where they can go into one place and solve most of, if not all, of their problems. As Patrick mentioned, that like probably most of the stuff can be solved with CRE. And I think developers love, I mean, we can talk about developer experience, but it's it's a very abstract topic, and we can literally talk about it for 6 hours and not cover even like 40% of it. But the thing here is that people mostly gravitate to a single place to do stuff, because once you get the trust, we're here, I'm not talking only in the mathematical sense, but like the team behind it, they can finally now go to Chainlink, which they trusted with the price feeds, with CCIP and everything else, and have this compute part solved as well. And I think, I mean, Chainlink is a great example in Tenderly's case. You guys started using us for monitoring it first, but now Chainlink has the highest seat count in Tenderly and uses all of our products depending on the team. And I think CRE is that thing for Chainlink now, finally, that exists.
Awesome. Thank you. Patrick, did you have any thoughts?
Yeah. So for me, developer activation has always been around making it as easy as possible to reach an aha moment where you go, oh my God, like I understand this now and I can see the future of how to use this to be productive. So developer platforms where activation is easy, activation is smooth is super important, right? And, Chainlink CRE, I was one of the beta testers. I was able to get through the docs really quickly, give some feedback to make it even easier. Any way you can remove a button press is one you should do. This is why you see like, my favorite example is like sign in with Google, sign in with Facebook. That became super popular because it was faster and it was a couple button clicks fewer than typing in your email and password. Typing in your email password is actually many button clicks versus like one click sign in is fewer button clicks. If there was on your phone, you'll see a lot of apps are like, oh, Face ID. Why they do that? Because it's one fewer click. So if you can get into the app quicker, you're going to activate the user quicker. And developers are the exact same. A lot of people think developers are these like people who love like really hard things and like making their lives. No, we're lazy. We're super lazy. I want to be as lazy as possible. I work really, really hard to be really lazy. And that's the whole shtick. So like making things easy, getting activation quickly. And these days also like making things work really well with AI agents, like agentic. So like historically, everyone was like, oh, like what IDE do you work with? Do you use VS Code? Do you use Sublime? Do you use like whatever? These days we're kind of moving towards an ADE type environment, in an agentic development environment. So people are like, oh, do you use Cursor? Do you use, Claude Code? What do you use? Cursor is a great example. Cursor was a fork of VS Code. But the reason it picked off was because, again, it just made doing things easier. And now VS Code followed suit and Claude Code, and you have all these AI products. So, and again, it's still solving the same thing. How do you get productive? How do you get results with as little work as possible? That makes a good developer platform. And not only how do you do it as quickly as possible, but how do you make powerful results as quickly as possible? And that's it. And whatever platform can do that is going to be the platforms that win. So, looking forward to more AI being stuck into CRE soon, I guess.
I'm sure you'll see it soon.
Yeah.
And your point about the rise of Cursor and those things plays perfectly into your other point of devs are lazy?
They're very lazy.
Jake?
Yeah, obviously we work with a lot of developers at their web, and basically what Patrick is saying, like this, how do you take something that is powerful, something that is used to be complicated, and simplify it? I think to me, when thinking about simplified, it's like literally how much work you have to do to get the benefit. And I think like in this case, in the CRE process, like trying to run your logic of code in a way that's like distributed, it's decentralized, and has kind of like, and that's verifiable. It takes a lot of like infrastructure and everything kind of set it up. And I think like CRE just kind of makes it super simple and give developer a way to do it. And I think, the second to that is RPC. I think that a good developer tool is more like a framework. There is a distinction in programming, distinction between a programming library and a framework. Library is, you need to use like 10, 20, 30 libraries to build something. A framework is, it actually offers you everything that you would need and almost like an environment for you to actually thrive in. A good example is you think about Notepad versus code editor, right? Why do people not code in Notepad, but people code in code editor? And I think like the similar argument can be made for like CRE as like it actually offers a developer a framework to build a trustless and trust minimized software and programming. And I think like that is the key unlocked. And again, just the simplicity on using it is so trivial that it almost makes it knows not to do it. Because you can actually use it for the on-chain side, which is pretty much everything that build at.
Makes sense. Thank you. Rahat, did you have any thoughts?
I think everyone kind of touched on all this stuff, but the basic thing there is just how it works smarter, not harder, is like what we're trying to go for from the developer experience standpoint. So anything that helps me move quicker to like whatever my end goal is, I just want to figure out like, usually like from a developer standpoint, you have like a specific task or a specific PRD that you need to fill out with whatever it is that your product guy told you need to do. And I just need to find the service that helps me get to that endpoint. So like having a good platform that leads me to the thing that I need as quickly as possible is always going to be the best thing. And I think like one of the cool things with CRE is like, as you add all the different capabilities of like the different services that Chainlink has, you can now, I guess, kind of like have this one-stop shop almost of like all these different things accessible through this like CLI tool, which would be amazing to see.
I think the theme here is definitely time to success matters, and the platform helps with the time to success. Now, we've only got a few minutes left, so let's try to touch on two more questions here. Fragmentation across ecosystems exists in the forms of different SDKs, tools, and APIs. How does CRE standardize the developer experience? Who would like to go first?
I can maybe say, because we've had the first tactics of experience here. We have a product called Virtual Testnets, which lets anyone fork a chain and have a production environment ready with all of the production data, but they can use it for testing, for CI/CD staging or whatever.
Products we use them on SafeRoute.
Yeah. Thank you. Anyway, the thing that people requested is, hey, how can I spin up multiple chains and then orchestrate workflows from there? Currently, we have teams like Aave using CCIP actually, and then connecting multiple virtual testnets together. But when Harry sent me the docs for CRE, we thought that there was going to be a non-trivial amount of work for us to support CRE. And then I remember we sent it to one of the engineers, a huge shout out to Mikhailo, who's handling all of the chain and stuff on VanEck. And he said, and I quote the Slack message, dude, I just put in the RPC link, our link as an RPC link, and it worked. And I think people who haven't built in Web3 don't understand how rare this is. I see a few people laughing in the crowd. Don't understand how rare this is. Even in Web 2 is rare, but we literally had to do one single coaching. So it took us like 30 something minutes for Tenderly to have first class support for CRE. And I think this means that the SDK team and all of the whole team did an amazing job. What does this mean for us as Tenderly? We didn't have to spend like 2 or 3 months, if you look at full-time employee costs for everyone else, and FTE costs to add support for something. It was almost a coffee break type of thing. So it's amazing.
Awesome. Thank you. Jake, did you want to go next?
Yeah. I think, fragmentation obviously is like, it's always existed. And, there's like different level in which you can operate as a developer. I think, kind of touched on it earlier too. It's like, I think CRE, the way that it brings everything together and providing a unified interface, what that really means is that's all you need to get something done. And previously, you kind of need to know what to use, which library or which tool to use. But now, because it's more like a platform, a framework, it has everything that you can just access. It's right there. And it kind of almost anticipated your need for, really building anything. And yeah, like, I think, I know we're coming on time, but like, I can go on for longer, but I think that's kind of the main thing around is like simplify interface, unlocking kind of power and give developer a way to access this much quicker.
Unlocking the power for the devs to access things quicker. Patrick.
Well, we have like 15 seconds. So I guess fragmentation bad because it makes it hard. Hard is bad. I want easy. So CRE is more easy.
This was 8 seconds. Good.
Great answer. Okay. I'd love to chat more with you all and to interact with the crowd here, but unfortunately we're at time. But this was a great discussion. It was cool to hear your thoughts on CRE, some of the benefits it provides for developers, some of the use cases that it unlocks across the ecosystem and the on-chain and off-chain world. I think there were some other definite themes that came up, such as the power of building with developer platforms, how time to success matters because developers are lazy, as we said, and that CRE can kind of help developers to build these new solutions and existing solutions, make them better using the power of the platform. So thank you for joining us, gents, and thank you to everyone for coming and listening to us. Just quickly, if you're a developer, we are running a CRE workshop this afternoon soon, I believe, on the 3rd floor in the developer workshop room. So please join us for that. Thank you, everyone.
I'm Johnny Reinsch. I'm the executive director of the Tokenized Asset Coalition. And this is Stablecoins in the Evolving Financial Stack. Congratulations. You guys know what 1-year anniversary we just crossed? Anyone? Stripe announcing that it was going to buy Bridge. That kicked off this whole thing with stablecoins. Do you guys remember what stablecoins were before that? Very, very different. Trading use case only. And since then, we've had a bunch of other stuff happen too. The Genius Act was signed into law on July 4th, which preemptively kicked off the end of summer for most people. I don't know if anyone feels tired out there. But volumes also kicked up. In 2024, stablecoins did more volume than Visa and MasterCard combined. And on top of that, we're actually getting more use cases emerging. And we've got a few different builders that build along each of these use cases today. And traditionally, stablecoins have been a trading use case only. It was a way to get liquidity among exchanges. Now we have B2B payments, we have remittances, and we have neobanks being built on stablecoins. So very excited to moderate this panel. I think stablecoins are one of the coolest exports that crypto has so far. One of the best innovations in the financial space that we've seen. And I've got 3 different projects and their CEOs that can walk us through how their solution works. And we're going to talk about some of the innovations that we expect on the horizon as well. So first, I've got Marcus Frank, CEO of Mento Labs, Jeremy Ng, CEO of Open Eden, and Rhett Chip, the founder of the Avant protocol. Why don't we kick off with just a brief introduction of what you guys do? And Marcus, let's start with you.
Yeah, thank you very much. I'm very happy to be here. Always happy to talk about stablecoins. My name is Marcus. I'm founder and CEO of Mento Labs. Mento is an on-chain FX platform. In the end, you could imagine it as a local currency stablecoin DEX. FX in general is the largest market in the world. There's $7.5 trillion in trading volume going through the FX markets every day, estimated by Bank for International Settlements. And we think that at some point, a part of this will come on chain. And with Mento, we want to offer basically proper infrastructure so that users not only can actually interact with dollar stablecoins, but with many other currencies as well. We have 15 currencies already on Mento. Of course, the dollar, but also a euro, a Swiss franc, a British pound, a Philippine peso, Kenyan shilling, and so on, so that users can easily go between different stablecoins. I'm very excited to be here.
Amazing. Jeremy, why don't you go next?
Yes, sure. Good afternoon. My name is Jeremy. I'm the founder and CEO of Open Eden. So Open Eden is a comprehensive end-to-end RWA tokenization platform, fully regulated. We've launched our 2 products, and the first is a tokenized money market fund that has the world's first Moody's rated. And also recently we got a AA+ rating from S&P. And more recently this year, we launched our own yield-bearing stablecoin called Open Dollar, USDO. And I think our vision is to go beyond just creating our own products, because we've built a end-to-end comprehensive tokenization platform. We envision to become the Shopify of RWA, to be an enabler to our partners, whoever that likes to bring on their products on chain. Very happy to be here as well. Thank you.
Amazing. Okay, Rhett, let's hear a bit about Avant.
Yeah, thanks for having me. So yeah, Avant Protocol seeks to give our users the best risk-adjusted yield on dollars, Bitcoin, and ETH currently, where all of that yield comes from on-chain market-neutral activities. So it's a very DeFi native product. AVUSD is minted from USDC, and then that USDC goes onto these dollar-neutral yield-generating strategies. So yeah, very, very DeFi native, but excited to be here with those that are bringing traditional assets on chain. We love that. Since we operate entirely on chain, it's really great to see some of those things coming.
And I think I'll stick with you. What's the core use case today on Avant?
Yeah, so you could call it kind of your on-chain savings account for those who are very DeFi native. And we're starting to see some more traditional institutionals that play in DeFi that use AVUSD and our other AV products. But yeah, at the moment, think of it as your on-chain savings account. That's our current main use case.
Got it. And Jeremy, my sense is that your users are more institutional. Is that right? Can you talk about like the actual use case in Open Eden today, who your customers are?
Sure. It is really 2-part. The institutional part would be the first part, because USDO, to primary mint and redeem, you have to be fully KYC. And right now, with a partnership with Binance, where an institution can now hold USDO, which is yield-bearing and backed by T-bills, off exchange into selected custodian that is approved by Binance. And Binance will essentially give you a 1:1 mirror asset onto your portfolio margin account, so they can trade options and futures and derivatives as if you have collateral on chain. So that is one major use case, and clearly that is reserved for institution. But we are also very integrated into DeFi, whether it's lending protocols, DEXs, yield protocols like Pando, and that opens up for the mass market to participate, not directly with us, but through our DeFi partners. So I would say that our products, in a way, is catered for all, and is really meant for multi-purpose. And think about it as a savings plus a payment into one token. So when you are not using it for spending or payment, you are already saving, because USDO itself rebases on a daily basis, generating the yield from the underlying collateral, which is treasury bills.
And I have to follow up with one other question, because I'm curious, what was it like to go through the rating process and be first, the sacrificial lamb?
So we got our rating last year, June, by Moody's. We were the first. So we were almost like a guinea pig, and it was a very long process, because Moody's is also obviously trying to understand more about blockchain, more about all the different smart contracts that we have used to build our product. And I believe that we spend a lot of time educating them. But at the end of the day, they do appreciate the fact that the way we build our product is very much regulatory compliant, because it's regulated, it's got proper audit, it's got proper valuation, KYC, AML, and all those different things that they look into. And obviously, we kind of check the boxes. And subsequently, I see once we announce that we have got the ratings, I think a lot of the other tokenized products begin to go for ratings as well. And I would say that it was others. It was pretty much like how a traditional finance issuer get their rating from the agency. And we're very proud because the fact that it is clearly a lot more complex to have a product that's on-chain compared to just a regular fund. And we didn't get like the highest rating, just because they feel that, anything that touches blockchain or stablecoin add additional complexity and risk. And that's why, it was at a single A. And then fast forward this year, when we start speaking to S&P, they were very interested in what we're doing. And we went through the exact same process. And to them, I think, they probably a little bit more advanced in terms of their blockchain knowledge. So they awarded us AA+, which is a maximum rating that any tokenized, T-bills fund can get.
Well, congrats on the investment grade on both fronts.
Thank you.
Okay, Marcus, you guys come at the stablecoin landscape in a slightly different way through FX. Curious, and I'm sure the audience is as well, what are some of the real world use cases that you're seeing users leverage Mento for?
Absolutely. And I want to call out 2 examples for real world use cases. In general, FX, I mentioned it, is the largest market in the world. $7.5 trillion trading volume a day, more than $2 trillion in the FX spot market. So it's a huge market. And the more volatile currencies get, the more interesting it is to actually engage in these markets. One real world use case is actually, I'm based in Europe. If there's projects that want to do business in stablecoins this year and maybe also earn yield in stablecoins this year, they want to use euro stablecoin. The dollar lost more than 20% in value against the euro this year alone. And therefore, for many projects in Europe that work with stablecoins, they need to have the option to either hedge the currency or to swap between 2 different currencies. So this year, actually, when the dollar got more volatile for different reasons, we saw more and more directional trading between actually dollar stablecoins and the other G7 currencies, where users went from, for example, dollar to euro, dollar to Swiss franc, and so on. In that, on that volume side, we currently do, or the Mento as a platform currently sees around 100 million in trading volume every day. So we actually see quite some adoption here on the trading side. But I also want to call out another real-world example for local currency stablecoins. If you're, for example, an entrepreneur in Kenya and you want to get a small loan, and you only have the opportunity to get the loan on chain, you actually have a local preference for local currency, because if your revenue is in local currency, you don't want to bear the FX risk to the dollar when you have to pay back that loan. You want to pay back that in local currency. And then furthermore, actually, if you're doing business out of Kenya with Ghana, and you want to go from Kenyan shilling to Ghanaian cedi, in a traditional market that only works via the dollar. In the traditional market, you also have typically T+2 days settlement times. So if you can only go from Kenyan shilling via the dollar to Ghanaian cedi, it already takes at least 4 days if there's no weekend in between. On chain, we can offer this instantly with stablecoins. So we see more and more projects that actually leverage this for basically doing cross-border business, to hedge currency exposure, to trade on currencies, to take out local currency stablecoin loans, and so on.
I would imagine you'll see that lending use case pop up in other developing markets too.
Yes, totally. And I think it's really, really interesting because, I mean, in some way, stablecoins have become a household name. They're considered in some way now a part of the financial ecosystem. But what we haven't seen so far actually is like a surge of these local currencies, lending in stablecoins, FX trading, even though all of these financial primitives really benefit from Web3 technology, that it's like openly accessible and 24/7. I mentioned it 2 times already. It's the largest market in the world, FX, but it's not 24/7, which is really, really weird. And with this technology, we can actually make it 24/7 and accessible anywhere. So I think there's a lot of potential there.
For sure. I mean, the disparity in the market dominance of USD-backed stablecoins is your guys' opportunity for sure.
Absolutely. And I think the dominance also comes from the lack of infrastructure so far, because existing infrastructure on chain is actually in the past at least not set out to cater FX markets. AMMs don't work for FX because the price is determined off chain in the interbanking market on FX trading desks in London. Is not determined on chain, and therefore you need projects like, for example, Chainlink to mirror the off chain prices and bring them on chain so that you can offer these prices on chain effectively.
Thank you for kissing the ring for us all. Okay, switching gears slightly. There's sort of a fight brewing in the US between the traditional banks and deposits, and putting pressure on Congress to inhibit the way that stablecoins will be regulated under Genius. I'm actually very curious, as between stablecoins and what might end up being deposit tokens, how successful do we think deposit tokens actually will be on chain, and how much will they actually compete head to head versus being different products? And I'll open that one up to the group, whoever wants to take it.
So we're talking about tokenized deposit, essentially. Now, I think my view is that if every single bank issue their own tokenized deposit, then the question is it going to be fungible? Is Bank A's tokenized deposit going to be accepted by Bank B, right? Mm-hmm. And also, they got to agree on which blockchain to use. So there is actually multiple layers of complexity, and getting all the banks to work together and agree among each other, I think that is probably something that is super, super, super difficult. So the way that we have seen how it has been working so far is a company working with one particular bank to use that tokenized deposit from that bank for transaction intra-company across their own subsidiaries, East versus West. So we've seen that is working. But also I've got insiders of those banks that issue these tokenized deposits saying that actually it is just a glorified spreadsheet. They could have done it using the traditional way, but just to show that it's a proof of concept, that they're using blockchain, blah, 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 they develop tokenized deposit. So in my view, I'm not entirely sure whether that can be commercialized in a way that everyone across cross-border can use it. And I still believe that stablecoin is the solution. But if it is within a closed network, closed system for a very large conglomerate that has a lot of different subsidiaries across different countries, yeah, they can choose to use a single tokenized deposit issued by a bank. But that's just my personal view.
Totally.
I don't have a super strong opinion, but I kind of feel like stablecoins are just objectively a better product.
Okay.
So if I'm holding, for instance, OpenEden's USDO, and I'm getting treasury yield, that's better than most savings accounts are going to give me, right?
And lower risk.
Yeah. And more fungibility. And so it's like, okay, why do I want to have a tokenized deposit at a bank that's giving me lower yield, worse fungibility, worse risk? So I think banks will just have to compete more to give their depositors a better deal. And that probably shows up like them using these sorts of stable coins. That's my genre here.
Yeah, I agree. Yeah, I mean, there's also like a product differentiator that I feel like the banks could latch onto to compete head to head with stablecoin products, which I agree have more fungibility, enable use cases like FX at eventually at good scale. In the US, you have FDIC insurance. So if you actually could on-ramp between deposit tokens and stablecoins and go back and forth really seamlessly, I feel like that's the value prop that they should be shouting, from the hilltops. And so when you're in the closed ecosystem, maybe, that's what gives them their edge. And I talk about this a lot because I would actually prefer to see the banks innovating and talking about that versus saying, don't do stablecoins. Don't pay yield on stablecoins. Don't do rewards on stablecoins. But yeah, I completely agree, Jeremy. Like, for that to work, if I open up my Chase app and I can just see my balance, that's not that exciting. If I can do something with a deposit token like I could do in DeFi, which I think would be a very difficult hill to climb, then maybe that could be a better product, but I still don't think so. But I think there are a lot of barriers there. So group consensus thinks that maybe these aren't competitive products at all.
I think, uncompetitive, and they should just, accept that stablecoins will pay yield and then come compete and pay better yield to their users.
Completely agree with that. Okay, so switching back to more like use cases, we've seen incredible adoption over the last year. I think we just crossed 300 billion of total stablecoin volumes on chain.
Yeah.
And we've basically been growing 1% week over week over week since roughly summer, I feel like. And yet we're still at what, like 1% of M2? Is that about right? And then we're not even talking about like savings deposits as a subset of that, which is probably way less than 1% if you take all the synthetics. What infrastructure gaps are there currently that inhibit adoption? And I'll leave that open to the group as well.
For me, for sure, better FX infrastructure. I mentioned this. All of this volume that you mentioned, it's like mostly actually happening in dollars. And the reason for that is that because in the past there was no proper infrastructure to efficiently go between currencies. And as I mentioned before, with like the examples of these different use cases, if you want to go cross-border, if you want to hedge your currency exposure, if you want to get a local currency loan and so on, I think you need that proper infrastructure that you can go efficiently between different currencies, either between different stablecoins or in the same currency, but more importantly, to go between different currencies. And so this is why we are focusing on building that infrastructure, that on-chain FX infrastructure. And then there's probably in every use case more infrastructure that is still missing, even though now in many countries we have regulation that is trying to keep up with the development. Problem with stablecoins, the product is very global, regulation is local.
Definitely.
And that mismatch makes it sometimes a bit hard.
Yeah, I think I was reading earlier this week that Mika and Genius are actually not compatible. So if you have a Mika compliant stablecoin, and then when Genius regulations come out and there's rulemaking around it and you're compliant with Genius, it doesn't necessarily mean that you can issue in both markets. So interoperability from a regulatory standpoint feels like a massive barrier for what you're talking about, for sure. Anyone else?
Yeah, that's the off-chain part. I feel that the on-chain part is the fact that we have got, I might be offending someone here, but way too many chains where stable coins are operating. It becomes extremely fragmented for people to try to use certain feature that is only offered on this chain by this app versus the other part. And then you need to try to bridge one over the other, and it's not necessarily able to. For example, CCIP is great, but it doesn't mean that it allows bridging for every single chain out there, because every day we're going to have new chains. So I feel that the fragmentation of stablecoins residing on different chains is one of the blockers to have a lot more seamless flow of stablecoin transactions.
Yeah, try explaining to your grandmother how to bridge. Not going to happen.
Yeah. My view is somewhat similar here. So, we use a lot of stablecoins on chain, and it has improved a lot since the days of, 2020 DeFi summer. But cross-chain bridging is improving, but could be improved more. Really good liquidity and fungibility and integration. So if I want to go from USDT on chain A to USDO on chain B, can I do that quickly, conveniently, with low slippage, with low, fees? And in some cases, yes, and it's getting better really quickly, and liquidity is getting deeper. But I think there's a fair bit of maturing that needs to happen there.
Yeah. Do we think that from a UX standpoint, crypto as we know it remains sort of like a developer product, and then the things that get built on top of the primitives are what end up getting in the hands of the consumer, maybe, or in the institutional users' hands? Because I agree, bridging is awful and dealing with multi-chain is terrible. And at the end of the day, all I care about is what my USD balance is if I'm in stablecoins.
And there's a lot of things where you try to abstract away all these problems that blockchain brings with it for end users. I mean, bridging is one. You already mentioned it for stablecoin transactions. Especially when you talk about emerging markets, you need solutions where you actually can do a stablecoin transaction and pay also for gas fees in stablecoins. Because it's probably hard for end users in Kenya that want to get that small loan to explain to them that they now also need ETH for gas to actually then do something with that loan. Also there you need to build infrastructure that abstracts away these problems.
For sure.
So I think on that front, it might be jumping the gun. One of the way that we would like to see, and this in Open Eden, is we're beginning to integrate more and more with the, let's call them Web 2.5, the fintechs and the neobanks that came from the traditional world, but then beginning to migrate into crypto because they actually understand what is good UI.
Yeah.
And they understand how consumer works, and they can abstract away all these complexities of wallets and whatever. But our crypto native world is really built for people like us. And even though everything is clunky, nobody seems to care. Say, yeah, it's okay. You just kind of figure out how to do this multiple bridge, and then eventually you get there. So I think it'd be a good thing that we're going to see more and more these fintechs coming in, partnering up with projects from crypto, and then to have an end product that can then invite the traditional Web2 consumers to kind of come in and adopt. And that is a much bigger market than what we have right now.
Yeah, definitely. I mean, if I was going to build, I built a payments and lending company 10 years ago. And if I was going to build it today, I would for sure use stablecoins and avoid a lot of the infrastructure that I had to build out from scratch beforehand. So, I mean, it seems like there's definitely a big unlock there, especially with the Web 2.5 folks. I like that moniker. Okay, let's look into the future a little bit. Let's take 2030. I think the numbers that the BCGs and McKinseys of the world have are staggering. Let's say they're all true, and in fact we blow it all out of the water. What had to be true along the way for that to happen, and maybe what's the success case for each of your guys' stories? And I'll leave it super open so you can just talk about that success case.
So some of the things that have to be true along the way. So we need a lot more scalability in every blockchain. That I see that improving really well. So I think we're on track there. There needs to be really good interop for chains. And then, the applications need to mature. To the earlier question, actually, having used DeFi back in 2020 compared to now, it is a world different already. And then you have some of these things like Coinbase. You can have a savings account that touches DeFi, but the user doesn't have to see it. So those things are all kind of working and growing in the right direction. So I think kind of a continuance of those in order to get there. I think the success story for us is, by 2030, we have trillions of dollars of stablecoins on chain. We have trillions of dollars of tokenized real world assets, everything from equities to bonds, et cetera. Those all create great yield generating opportunities for Avant. So that's great. And then along with that comes people who are looking for a more DeFi native, yield bearing dollar, Bitcoin, ETH, et cetera. And so, the success case for us would be we grow alongside that market. So, take us where we are now and the market, and then, we kind of grow together. That's what we would consider success.
Amazing.
For me, it would be convergence. I think I mentioned a little bit about that earlier, the convergence of the Web 2.5 world with Web 3 world to create a really good and solid UX UI to attract not just the crypto community, but the Web 2 community. So that's one. And the other one is a lot more challenging, is the convergence of regulatory standard. Because like you said, right, MiCA versus Genius is just one thing. What about in Asia, rest of Europe, I don't know, Latin America? If we don't have a somewhat, I wouldn't say exactly consistent framework, but somewhat loose enough for every jurisdiction to be agreeable for certain standards, then it becomes very difficult to have to try to build this stablecoin or products according to each region's regulatory compliance. So I think that
we need Chainlink of global regulations. Is that their new product offering? Maybe. I hope they're listening. I can help you guys.
If Chainlink can help us solve their problem, that'll be fantastic.
No, but I feel like it's super complicated because it's also things that are mundane like tax treatment, and there are just a lot of layers to how you ultimately do get regulatory interop. But I do agree that from my standpoint, I think that's one of the biggest hurdles to making this stuff all work really, really well, which also presents opportunities. Chainlink, solve this, please.
But then, we might not need that happen in order for stablecoin or tokenized RWA to proliferate. There can be more than one stablecoin, and depending on which industry, which geographic region, I think each of them could strive in their own way. And until a point, we'll see whether things get unified or not. If it doesn't get unified, then you just be in a way fragmented in its own ecosystem. And I think it will still thrive. It will still achieve what it should achieve, which is cost efficiency and speed.
Yeah, totally. Marcus?
Yeah, +1 on exactly that. I mean, we see that there will be these different stablecoins for us coming, or with Mentor having a focus on FX. This not only means different stablecoins from different issuers, it also means different currencies as stablecoins. And then, for bringing a part of the FX market on chain, you need that convergence of infrastructure. You need that convergence of regulation, because in the end, when we work in FX, a large part of our users want to do something cross-border, and therefore having basically similar infrastructure in both locations, similar regulation in both locations, that they can actually bring a part of their FX trading on chain. For us, that is important. And if we are able to just bring a fraction of the FX market on chain, I think we can build out a huge opportunity for Web3 because of the size of the market.
Yeah. I mean, with the size of the market that you mentioned, like having just a small piece of it sounds like a huge opportunity. And between the three of you, it feels like the fintech or the Web 2.5 should build their super app with each of you. So I hope that happens, and that Chainlink does the interoperability piece. But that is our time, everyone. Thank you, Marcus, Jeremy, Rhett, for the discussion.
Thank you very much.
Thank you for
that.
As you guys know, we launched a new product called CRE, Chainlink Runtime. And here we have 4 innovators that have been building in CRE over the past few months. Without further ado, maybe do each one of you want to introduce yourself, your project, and
Yeah, sure. So hi, everyone. My name is Arthur. I'm the CTO at Swapper Finance. At Swapper Finance, we are onboarding people from Web 2 into Web 3. And we are focusing on providing simple user experience and low rates.
Like this, Magic. Hey everyone, I'm Oleg. I'm co-founder and CTO of Concero. We are a role-based interoperability protocol, fully decentralized, powered by Chainlink technologies. And one of our core features that we're trying to pursue is high scalability. So as we have measured it in a couple of live streams that we did previously, we are able to scale to an EVM chain within as short as 20 minutes. So and we achieve that by using third-party RPC providers instead of rolling out our own RPC nodes. So we're focusing on high scalability as well as high modularity and configurability for the end user.
Hey everyone, I'm Austin Pribish. I am a co-founder at Instruxy, and Instruxy makes up one half of the Real World Asset Federation. If you haven't checked out our booth, my team and the RAC team is sitting downstairs, and please come check us out. At Instruxy, we are focused on the tokenization of real world assets. And if you think about tokenization, it starts with valuation. It's in the middle, you have digitization, and in the end, you have distribution. And at the RWA Federation, we are focused on finding as many real world assets to unlock that next $1 trillion tranches or crypto.
Hello, everyone. I'm Zeki. I'm the technical lead at the LlamaRisk. LlamaRisk is the risk provider, big names in the DeFi space, specifically Aave and Horizon. And Horizon is the RWA liquidity layer. and we are working there for the onboarding of the assets and safely pricing the assets. And we are using the CRE in that regard to safely pricing the assets.
Very cool. I think on the topic of risk, what has CRE enabled you guys to actually build from Llama Risk perspective?
So, like when it comes to the real world assets, it is more different than what we are seeing in the on-chain assets, because the price is coming from the off-chain and it has to be safely priced also to be used in the on-chain. And before that, to bring that by yourself, you can build everything in the AWS or Google Cloud, etc. It is quite cumbersome and it's hard. But with the CRE and with the, we are able to do it quite easily. And that's pretty much the gist of what we are trying to achieve there.
So it's like you're able to spin up your own oracles instead of having to rely, all of the architecture is complete and ready out of the box. And what you guys are doing is just calculating the NAV, adding additional risk parameters, and pushing this as a payload yourself on-chain.
Yeah, so the real-world assets has a specific character that are you can estimate where the pricing should go because they have certain APYs, certain characteristics, and it is easier to build some guardrails on that. And the LlamaGuard is doing that, building the guardrails to safely price the RWAs on-chain. For example, there is the infinite mint situations is quite easily be avoidable by building these safe guardrails and protecting on-chain liquidity. And the LlamaGuard is doing that easily with the CRE.
Very cool. And Austin, you guys are also building custom oracles. Could you tell us a little bit more about the builds that you guys have been?
Yeah, very similarly, we are building NAVs and proof of reserves for real world assets. Not for Aave or Horizon, but we're actually out looking for things like property, gold, minerals, and we're connecting price feed data as well as CRE data to live ERP systems, SQL databases. We have connectors to almost any modern REST API or database situation that your enterprise might have. So we're able to derive those proof of reserves and NAVs directly from the source system of our customers.
And what was it like before CRE?
Before CRE, so you have to kind of go way back to think about this if you were building on Chainlink back in 2018 or 2019, you were probably going home after a long day's worth of work after your Web 2 job. You didn't have an LLM to do this, and you were probably watching Patrick Collins videos to learn how to do all of this by yourself. So I'll let the other guys maybe talk about how cool the abstraction is and how easy it is to use. But when I thought about this question, I think what's different now than it was back in the day is not just the documentation, but access to the wider Chainlink team to support us and giving us access to these early products and the support to actually use these and get these kind of workloads into production is completely different than it was in 2018. So from a developer's perspective, it actually feels like we're first-class citizens in the Web3 space rather than, Web 2 developers trying to transition into some weird, awkward abstraction.
So very cool. Awesome. Maybe, Oleg, do you want to intro Concero and talk about, I guess we could do the same before and after.
Totally. So yeah, as I mentioned, we are a cross-chain interoperability protocol. We aim for high modularity. And I guess to really explain the benefit of CRE, I also have to go back to our version 2, the previous version of our protocol, where we use Chainlink functions to validate our transactions. So the whole gist of the protocol is we have some separate roles that are responsible for the life cycle of the message. So as with any other protocol, you have the gateway or the router contract into which the user puts his incoming message into. Then it's picked up by a relayer whose job it is to get the validations for the message. And as soon as the validations are received, that message needs to get relayed to the destination chain router on which it will get delivered to the client. So that was mostly the concept of Concero V2, where we use Chainlink functions to obtain such verifications. And we're very happy with functions. The only thing is, for functions, we had to trigger the report, we had to obtain the reports only using the on-chain communication with the functions coordinator. That's kind of the design of functions, but that added up into the cost and speed of us obtaining those validation reports. With CRE, it's fully off-chain. So what the life cycle looks now is when the message comes in, the relayer will trigger the report retrieval from CRE completely off-chain, obtain that report, and then relay it to the destination chain. So considering the transaction count for a single message, for V2, we had 4 transactions, and now we have 2. So pretty much as little as it gets with the source and the destination chain transaction. This might sound like a very minor improvement, but if you think about messaging as a fundamental part of anything else that could be built on top, as efficient as this piece get, the more efficient this piece gets, the more efficient everything else is on top. So it's crucial for us to optimize every last bit that we can to make sure the messaging is faster, cheaper, and more secure. So in terms of security, what Chainlink CRE brings us in comparison to functions is at the moment CRE is being signed. Their reports are being signed by 10 DON nodes instead of 4 with functions. So better decentralization, better report security in that sense. Secondly, again, since we're not interacting with functions on chain via third-party RPC providers and doing direct communications with CRE, we take out this intermediary, which will give us another second of speed improvements for messaging. So for now, we do cross-chain messaging for within 15 seconds. We're probably able to achieve 12-second message times if we push CRE to its limits pretty much. But overall, I'm very pumped about CRE, to be honest. It's the best product, in my humble opinion, that Chainlink has released, and I'm super excited to see what other applications we can figure out with CRE. But yeah, that's really all it is to CRE in our infrastructure.
I want to double click into something which, and curious to know what is happening on the LlamaGuard side for this, which is now you have the ability to create your own custom oracle, push this data on chain, and then you can orchestrate the automations of what this data does, the updates it would do for certain protocols, etc. Could you tell us a little bit about like an example flow that you guys are using?
So there is the 2 sides of the price feed. So like there is a price feed comes in, and then there is also the actions that you can take it depending on the price feed. So as I already mentioned, that the RWAs has like a certain characteristics. Like there's what we are approaching this as bounding it. So the LlamaGuard is bounding the RWAs price feeds to have like certain upper bounds or lower bounds, and then we are always having a look from the previous examples, like we have a look down window. And also on top of this, with the CRE and with the other systems also, and the Chainlink has a good reputation in this regard to have automated response based on this data. So you can have like automated risk adjustments based on this data. This is also something we are working towards, and I think also as an industry we should go towards. That is more like automated systems is dealing with this based on the price feeds coming on chain and taking actions. And Chainlink CRE is enabling these kind of innovative solutions for us to really experiment at early stage and test it, and also make it production ready products.
And so you're able to orchestrate all of this in a single piece of code.
Yeah, exactly. So yeah, I don't know if everyone followed along, but the CRE is quite, so it's easy to do, write your workflows because it's quite opinionated and it's quite tailored to on-chain communications. Like previously, as also other panelists already talked about, we can do everything with the AWS or any cloud solution, but it is not tailored for on-chain communication, and you are building a lot of tooling around it. But with CRE, everything is already there. It's just like you write one piece of code, either with the JavaScript, either with the Go code, and Chainlink does it for you. So it is quite easy to do those things with Chainlink CRE.
Nice. Tell us about Swapper.
Yeah. So in terms of Swapper, I want to focus a little bit on the product that we are building right now. So this is a widget for deposits, and we want to abstract away as much as possible from the user. And the goal here is to make it like as easy as possible so that the users from the Web 2 are easily getting on board to the Web 3 projects. And there are a few caveats with this. First of all, we understand that a lot of users who are like just starting are not having any Web3 wallet or anything like that. Maybe they're using some centralized exchange. Maybe they want to use an on-ramp, but they got scared away of the complexity of using the Web3 wallet, or maybe the fees for the on-ramps were too high for them, because they can be as high as like 4%. It's just like very, very high. So there are two things that we're focusing on. First one is to make it as simple as possible, and we are utilizing smart wallets to make it fully custodial for the non-custodial for the users. And after the deposit, we can provide the conversion by utilizing something which is called session keys, and this allows us to perform like a swap and deposit to the platform who is utilizing our solution. And this also brings one more thing that we deliver, which is a smart contract execution after the deposit. So if you are running staking, for example, and someone from the Web 2 would like to participate in the staking, they can use their card to basically just pay with card, and there will be already stakers in your pool. And there's quite a few steps to do so, and to do that securely, reliably. There is a full part of the execution, which we are taking care of. So we need to detect the deposit, to process it, and it's basically a workflow. And therefore, CRE is a great tool for us to build that, because we can detect it and react based on the tailored integration with one of our partners. And we are like aiming to make it work out of the box, make it very simple for both the end users and the projects who are integrating it. And what Chainlink provided us, which is a solution with the new solution CRE, is the decentralization, security, reliability, and gives us like certainty that what should happen will happen. And this is something which we really, really need, because we are talking about Web 2 users. They are not familiar with something like transaction revert or stuff like that. They don't know what's going on. They don't want to take care of the missing funds or whatever. They want to be certain that when they perform the deposit, they will get it. To answer one more question, which other speakers were talking about, how it would be happening without CRE, or which part is like the most important for us. I think like the way that we can utilize the triggers in the CRE system, that we can monitor on-chain activities and react to them. This gives us like a very good advantage in terms of speed, because to do this reliably, we would have to build like a whole centralized solution that will be listening constantly on multiple addresses and multiple smart contracts. And with Chainlink, we can simply set it up on multiple chains, on multiple addresses, and just start listening, and adding a new chain would be very, very simple for us.
I completely agree with Artur. Just to chime in, I think the most important part here is not only the functionality of CRE that it brings us, it's importantly the responsibility that we can lift off our shoulders on this on the Chainlink CRE. That's the exact same deal we had with functions, right? That allows you not only to not worry about things not working correctly, but also it just it doesn't have to, you don't have to reinvent the wheel in a lot of ways to build the same stack of security, reliability, etc. So that responsibility that we can, move onto CRE is what helps us sleep better at night, I think.
Yeah, I've built a few solutions like that in the past, and it's really hard to trust the RPCs. Like, for example, we had a problem in production. We didn't know what was going on because the RPC was like happy with the responses. They were saying like all good, but inside there was like an error, and they said like, no, there's all good, but it wasn't all good. And there was no easy way to find out. We had to change the RPC to another provider, and we only got notified by the user. And when we are dealing with Web2 users, as I said before, yeah, we don't want that to happen.
I think what's interesting about what both Arthur and Oleg were talking about here is they're actually now more focused on building a proper user experience as opposed to security infrastructure. Spending time on really mundane tasks now is allowing the two of them, and obviously everyone here using CRE, to focus on building that Web 2-like feel, or that reactive feel that Web 2 users are really, really used to now in their modern day banking apps. And that's something that Web 3 has really been lacking. Yeah. But CRE is actually pushing us more towards that kind of final goal of really easy to use web applications.
Also, I see the brand image is quite important here. It's like the working with Chainlink, we are like putting that title there. Like it just brings a lot of like a trust into your system, and that you don't need to answer a lot of questions anymore coming from people, because it's a battle tested from 2014. It's coming. Like Sergey in his talk is also mentioned like early days, how it was, and like how price feeds are now. It's going with the guarded rails, and like CRE is allowing that flexibility to other teams to innovate.
Yeah.
So that Chainlink also giving this responsibility to us to innovate, and then I think all the teams are in this board are doing their job in the innovating that.
Yeah, initially CRE was actually created for us to like help us just like provide the services we provide in a more composable and actual like scalable way. And so the ultimate like thing about CRE is it's running on the same security framework that is secured DeFi today. So like 70% of DeFi, like 60, 70 billion today, I think it's like enabled trillions of value across the time. And today what CRE provides, or what Chainlink is providing, is like Chainlink self-serve in a way. But yeah, just cautious of time. I'm curious to know, what was the moment that CRE really clicked for you guys as like an aha moment that really was like, okay, we're going to dedicate and put a good portion of the actual infrastructure of your business within CRE?
I'll start with, for me, it was the ability to really write in lower level code like Golang. Having all of the individual things like consensus or randomness, all of the individual components that an Oracle would typically do for you, or Chainlink would have done for you in the past, you now as a developer have the ability to customize. And for me, that kind of taking the training wheels off the Oracle experience was, for me, why CRE makes a lot of sense.
Yeah, for us, it is like to create this in our use case, like a LlamaGuard, to have really proper production level price feeds with the guarded rails. You need to have really stable system. And ideally, you need to have, if you want to do this like traditional SaaS, in different cloud providers you need to use for the redundancy, because if one goes down like last week's, you need to have like a backup, and then you need to have like a different system dealing with the different parts. So you need to create this separation of concerns to be able to serve in the high level. But with the CRE, it is already done by Chainlink, because there's a decentralized Oracle network is just built for that. It's already, the node providers are taking that load out of our shoulders and building that. And then we can just send a critical code, what we actually need. And then they are doing that for us. So that is the critical moment to understand, okay, yeah, I don't need to spend that much of time, so that they can just do it for me, and then I'm good to go, and then I can have production level LlamaGuard to serve our customers.
Nice. I'd say from our side, the strategic part of my answer would be, merging all of these services into one composable interface makes so much sense that it's pretty obvious to me that CRE is here to stay, and it's wise to proceed working with CRE as opposed to, other services individually. From the tech standpoint, as a coder personally, I'd say, the minor improvements in such things as I described previously, like the HTTP triggering, HTTP responses that we can use in CRE, they add up to to a more efficient messaging system, but also the relatively that's pretty much one of the biggest things. That's mostly it.
And for us, this was, as I said, the way we can take off our shoulders the detection of deposits in this specific use case, and sleeping well at night, knowing that everything will be executed as it should be. But beside of that, we are really, really into the capabilities that are being provided by the CRE. We know that with our collaboration with Chainlink and MasterCard in the future, we'll be able to provide next level or next generation fiat payments into our systems. And we are working towards this bright future where there will be no middleman, which is an owner provider. This is still a vision for the future, but we know that with this solution, we'll be extremely competitive in the whole Web3 space.
Awesome. Guys, that's all we have time for. Let's give a round of applause to the panelists.
Hi, I'm Shay. I'm from Flashbots. We're a research and development group that you have probably never heard of if you don't work in crypto. But if you've ever used a blockchain like Ethereum, then it's very likely that we sequenced your trade. And today I just want to show you how that works, how transactions actually get executed, how financial markets actually work in crypto. Because it is probably not what you expect. Most meaningful activity on blockchains today doesn't actually get executed on chain. There is a very complex set of off-chain infrastructure that actually determines things like price. And under the hood, what makes that infrastructure special is auctions. Crypto runs on auctions. Unlike in traditional markets, a single transaction in crypto will often pass through many auctions with sometimes hundreds of parties before it actually lands on chain. So if you're in the audience here because you're thinking of launching or adding, offering digital assets to your customers, or maybe launching your own crypto products or regulating these markets, then I personally think it's worth kind of peeling back the curtain and seeing what they're actually made of. Because in my view, that's the really interesting stuff. So how do trades get executed? What makes good auctions? And where do we go from here? Those are the questions that I want to talk about today. I'm going to focus on Ethereum because that's kind of what we're closest to at Flashbots, but many of these things that we'll talk about are relevant in other domains too. Okay, how do trades get executed? Probably the most popular thing to do in crypto is to click this button, the swap button, exchanging one asset for another, and it looks maybe pretty simple, but what happens when you do this, what actually goes into getting a good price? Under the hood, it actually looks like this. Under the hood of crypto is an economy of bots, where there's tons of different actors that are, participating in some way in executing your trade. And they do this by competing in auctions. Bots are competing in auctions to fill your trade, auctions to backrun your trade, auctions to merge your trade and into an ordered sequence of other trades. Your very simple single transaction will go through a whole suite of these auctions before it actually lands. And you probably, unless you work in the field I do, you probably have no idea all this is happening, but it is. Your favorite trading apps like CowSwap and Uniswap X run auctions to outsource the execution of your trades to sophisticated parties like solvers who then compete to find the best route. And so instead of, relying on a single wholesaler, you actually get a competitive market bidding to give you the best price. Your favorite wallets are privately auctioning off your order flow to improve your execution too. If you make a really big trade, you will often create an arbitrage by moving the price of a pool relative to other domains. And so most Ethereum wallets today actually send their users transactions through what we call an order flow auction, which lets a whole market of bots compete to backrun you and capture that arbitrage, split the profits with you. And actually, a lot of solvers will also send their trades or their fills to an OFA to clean up extra backruns. Modern order flow auctions actually have hundreds of bots competing in them. They've helped retail traders recapture tens of millions of dollars to date. And auctions also aren't just used in trading. Other financial primitives in crypto also use auctions. So your favorite lending protocols like Aave and Morpho use auctions to keep the collateral ratio in balance. And this, instead of running their own liquidation engines, they will offer bribes or rewards to bots who monitor Oracle price feeds and submit their own liquidation transactions when they detect bad debt. And these bots, again, compete in an auction to capture the reward. There's actually another interesting problem here with lending. The more bots that compete to liquidate a loan, the less of a bonus that the winning bot actually keeps. And the rest ends up usually just getting lost in network fees. So lending protocols actually end up wasting a lot of money. And it turns out that, surprise, surprise, adding another auction can also help with this. So earlier this year, our friends at Chainlink actually built a product called SDR, which redirects their Oracle updates through an order flow auction that we operate at Flashbots called MEVShare. And MEVShare makes sure that any surplus from these bidding wars goes back to, the lending protocols and Chainlink. Since inception, pretty cool. SDR has recaptured over $3 million across 52 distinct bidders. I actually think the numbers are higher since I wrote the talk because there's a lot of liquidations a couple days ago. And I think this fits into a broad trend we're seeing in crypto where apps really want to better control the whole life cycle of how their users get executed. And this kind of starts with trading, but also in lending too. Using auctions really smartly is the key for kind of the next generation of crypto apps. I also want to emphasize this because it's different to how traditional markets operate. Many retail trades outside of crypto today are sold in these payment for order flow deals, where a few wholesalers like Citadel will buy large batches of trades from front ends like Robinhood. And PFOF deals can help give people better prices, but they aren't very competitive. And the SEC actually found, in 2022, many years ago now, that users are basically missing out on 1 basis point per trade or $1.5 billion a year because of the lack of competition in PFOF markets. And they actually proposed a new rule, Rule 615, which would require that trades are routed through an auction. Okay, but returning to crypto again, there is one final step in the life cycle of your trade, which is how it gets ordered relative to everybody else's trades. Ordering is hugely important in financial markets. As you probably know, whoever's trade lands first will probably usually get a better price and snipe the opportunity before somebody else gets a chance to. Ordering also, though, is really hard. There are tons of trades, tons of bots, all of whom are competing for these opportunities, which raises the question, how do you kind of order them in the most fair and efficient way? We have studied this problem a lot at Flashbots. And generally speaking, there are 3 approaches we've seen. You either order by latency, spam, or auctions. Traditional stock exchanges have historically done the former, so they order transactions continuously in a sort of first come, first serve fashion, give or take. And unfortunately, this basically just creates a bunch of latency wars where bots will compete on collocation and speed instead of on price. And that ends up being really expensive. And researchers have found it doesn't actually improve market efficiency that much. Michael Lewis, I'm pushing his book here as well, has a great book that kind of outlines the origins of high frequency trading in the 2010s and the consequences that latency wars and front running on stock exchanges had. And it's actually the namesake for Flashbots, fun fact. We have seen similar issues in crypto as well. Chains that originally launched with a first come, first serve ordering scheme like Arbitrum ended up retrofitting their sequencer with explicit batch auctions like Time Boost. And the second option after latency is to make your ordering just random or blind. But there's also a problem with this, which is if bots can't control what order they're going to land in, they all just spam you. So this year, the spam from trading bots accounted for half of all the gas used on top Ethereum rollups. Especially when fees are low, bots can afford to just completely hammer your sequencer with tons of speculative transactions and kind of hope that one of them succeeds. Unfortunately, this has a ton of negative externalities. It congests the network, your P2P layer, raises the price for normal people to transact. So the final solution, maybe you get where I'm going with this, is, again, an auction. You create an explicit auction for transaction ordering where bots can compete on price rather than on spam or on latency. And basically just whoever pays the most gets their trade landed first. This is the first product we launched at Flashbots, an explicit auction called MEVGeth, if you can see it, which resolved all of this competition between bots off-chain in an auction. And it dramatically reduced the spam on Ethereum L1. And over the years, we've kind of expanded this primitive to all sorts of different use cases with a lot of success. I'm glossing over the details, like every case is obviously different, but one thing we have just found to be universally true is if you have meaningful financial activity on your chain, you will inevitably need an off-chain auction to handle all of the competition for it. If you don't design for this from the start, you will be forced to design for it later. So, if you're here in the audience because you're thinking of launching a chain, hopefully I can just, spare you the pain a couple years ahead of time. And if you want to talk more about it, happy to chat after. But basically, TLDR is this is what crypto markets actually look like. Every transaction goes through a series of auctions, which maximize the quality of execution for users and also protect the underlying system from these negative externalities like spam. Crypto runs on auctions. If you want to understand crypto, you need to think in terms of auctions. By the way, even if you aren't in crypto, maybe you'll find auctions useful. The SEC seems to think so. Okay. Hopefully now I have at least convinced you, if not of all of these details, that auctions are important. And next, I want to talk about how to make them good. What does good mean? I think this is what good means. I think we basically want our financial markets to give people the best possible execution, good prices on their trades. That's the goal. But this is hard for a few reasons. The first reason is privacy. If somebody knows you're going to make a trade, they can just front run you to make a profit and give you a worse price. And famously, public blockchains are not private. So over the years, we've had to kind of develop a bunch of separate off-chain infrastructure, like these private mempools you may have heard of, to ensure that all of this pre-trade data stays confidential. But that kind of poses a second question, which is how do you make sure that all these off-chain actors are following the rules? If they aren't governed by smart contracts and the activity is fully private, how do you make sure these parties that you're outsourcing really key application logic to are actually doing what you think they're doing? One way to approach this is through economic incentives. So as an example, in CowSwap, the DEX, solvers have to stake something, I think it's still like $500,000 to participate in the auction. And if they do anything shady, they just get slashed. That's a decent starting point, but it's not enough because then, okay, only people with $500,000 can participate in your system. Also, economic incentives can't actually prevent bad behavior if the opportunity is worth more than the cost of slashing. Another option is a social contract. So in MevShare, the order flow auction I was talking about earlier that we run at Flashbots, we rely on these parties called block builders to actually choose the backruns that go after user trades. And to make sure that we behave, we kind of go around and we ask the block builders to publicly commit to a set of rules that I wrote up a few years ago in this GitHub repo. And, for example, they have to promise, yes, we'll include the background that pays the most to the user. This is kind of similar to how traditional markets work. They have rules intended to enforce that people get the best price, the NBBO, and if you don't, you get fined. In crypto, the analogy is that I go and I just yell at you on Telegram. So these are like a few actual screenshots from my Telegram DMs where block builders were not including the right refunds. But there's a pretty obvious problem, I think, with this, which is that this just doesn't scale. I mean, I can't be in Telegram DMs with this many people. And there's a problem with that because we really, really want to scale the competition in crypto markets in our auctions. One of the things that is so unique about crypto in the first place is how many different actors are there competing to kind of drive better execution for your trade. And in an ideal world, it would actually be fully permissionless for anyone to join. And we cannot do that if they all have to, pay $500,000 or come talk to me on Telegram. So TLDR, I think this is how we get best execution in crypto markets by running maximally competitive auctions over global economic activity. And in order to do that, I think our auctions need to have these properties. They need to be verifiable, so anyone can check that the rules are being followed without me policing it or someone like me. They also need to be private enough to protect sensitive data from falling into the wrong hands, stop people from getting front run, and they also need to be distributed across lots and lots of different participants. And I think this is interesting to emphasize because it's a different way, I think, of approaching best execution. Traditional markets tend to focus on regulating the outputs. So crypto markets give us this really interesting chance to focus instead on proving that the inputs, the technology, the mechanisms, the incentives we're using are actually optimally structured to generate the best outcomes for people. And in fact, I'd maybe suggest we have to do it differently if we really want crypto to scale to its potential. Traditional approaches to regulation maybe don't work. So to close, I just want to talk about how we get there. How do you create verifiable, confidential, distributed auctions that give people best execution in crypto? We have studied this problem for a long time at Flashbots, and we think the key kind of starts with better technology. This might feel like it's coming out of left field, but I just need to talk about hardware for 1 minute, so bear with me. Hardware, I think, is massively important, actually, in all sorts of industries. You just look at how GPUs accelerated large language models in AI as an example. And in on-chain finance, I think the equivalent is something called a TEE, Trusted Execution Environments. There's machines, think of them as fancy machines that manufacturers like Intel make. And I'm not going to explain how they work, but I do just want to explain the impact. TEEs have two really useful properties. First, they can prove to you what software they're running. So you don't need regulations, you don't need fines, you can just get a hardware level proof. And second of all, they can store data in a private enclave. So even the operator of the machine can't see what data is being operated on. And together, this basically lets you run verifiable, confidential auctions on untrusted machines. Unlike software cryptography, also, we figured out how to run these things at near native performance, which has led to just a huge wave of adoption over the last year. 40% or so of Ethereum L1 blocks are now built in TEEs using BuilderNet, which is a new distributed sequencing network that we launched last year at Flashbots. Entire rollups like Unichain are being sequenced in TEEs. Other chains like Solana are following suit with TEE-based block building products. Order flow auctions like Flashbots MevShare are integrating bots that run in TEEs. And actually, I think it was during the last big liquidation event, it was like a couple of weeks ago, our friends at Chainlink got some of the first backruns from a TEE bot, which is very cool. These are just some rapid fire highlights, but I think the TLDR here is that TEEs are kind of eating the world in crypto, in our auction infrastructure. And I think this is very exciting for a few reasons. First of all, we can actually scale our auctions now and distribute them across many, many parties. There are actually already 3 different teams who are operating nodes in BuilderNet today in TEEs, where the hardware, not me, my Telegram DMs, are actually verifying their behavior. Second, I think we can get the best of both worlds for users. So if everything runs in TEEs, we can actually safely share more information with untrusted parties. And this means that, first of all, bots don't have to blindly spam your auction because they know what they're searching on. And second of all, bots that previously were kind of unable or restricted to compete in certain auctions, maybe for economic reasons, maybe just had a whitelist, they actually can now participate, and that drives better prices. And pretty soon, the kind of future I want to paint for y'all is, I think it should be possible, and maybe we should just demand this, for every transaction in crypto to come with a proof, an execution receipt, which basically lets you verify things like, how was my trade priced? Were the parties, involved in pricing it compliant with specific policies? I think crypto is a pretty excellent sort of crucible to pioneer this technology, because we have been designing for these permissionless and adversarial markets from the start, where we have to verify instead of trust people. But if you remember from the beginning, I put this slide up, almost none of the things, none of this infrastructure actually is specific to blockchains. All the financial activity we've been talking about takes place off-chain, in auctions, not in smart contracts, which means you could use the same infrastructure we've been talking about here in other settings outside of crypto that need great auctions too. And I'm going to just leave the details there as an exercise to the reader. But if this interests you, please come join our collective of researchers and developers working on problems like this. We have a long way to go. And if you're thinking also of using or launching or regulating crypto products, our doors and also my DMs are open. So thanks.
We'll first start off by having everyone on stage introduce themselves. So maybe we'll start with Amelia.
Thank you, Ben.
My name is Emilio. I'm the product manager for payments at Aptos Labs, helping build and shape a lot of the strategy of where we want to position in the payment space. Before joining, I worked at Bitso, cryptocurrency exchange based in Latin America for a few years. So I've been working in the space and focusing a lot on what's coming next.
Hi, I'm Frances Edwards, COO at Ondo Finance. We are an investment manager and curator that's been building in DeFi since 2016. Given what happened on Monday, Tuesday, I've got a disclaimer to say we've got no exposure to XUSD, no exposure to any morpho markets that are linked to XUSD as collateral, no vaults linked to the other sort of contagion impacts from stream finance. But in general background I have is as an investment product structurer within TradFi for 18 years before being drawn into smart contracts 4 or 5 years ago. And I'm enjoying building in DeFi.
GM, I'm David DeFi, core contributor of LFJ DEX, the number one DEX on Avalanche and soon on Monad. We are the creator and inventors of Liquidity Book, the second most utilized concentrated liquidity primitive in the industry. And I'm very happy to be talking about DeFi Summer here because as a decentralized exchange, we have seen all projects happening over the years. I've been a DeFi trader myself during DeFi Summer, and the role of a DEX is to witness all the assets that get permissionlessly listed on the exchange, seeing how things go out. And we have basically figured out how cycles move very fast and more quickly through these cycles. And it's going to be interesting to talk about it.
Yeah, well, I think, David, you were there in the beginning of DeFi Summer. I think before we say what is DeFi Summer 2.0, just tell me, give me your best story to DeFi Summer. Was there something crazy that happened to you? Or is it something just like kind of or what were the vibes like?
I mean, DeFi Summer 1.0, which was the summer 2020, was particular because it was pure summer. I was actually at the beach trading from my cell phone. As every Italian, we go on summer holidays, and I was just a trader exploring all the...
So you're on the beach on your phone?
Yes.
Okay, that's purely crypto, right? Okay, so you're on the beach on your phone and you're just kind of trading away.
Yes, and I started to see all these assets. One was called Land, for example, then became Aave, and all this Uniswap and all these assets that started to showcase what a name was. And the thing about DeFi Summer for me and what we should try to bring back is the excitement of discovery. Basically, people see an asset and they wonder, what's this project doing? And then someone discovers, this is a decentralized protocol on a blockchain. What's this blockchain doing? What does it mean to be a protocol that works through smart contracts? And through this exploration, then you go on the website of these projects, see that they're doing something interesting, try to understand what's so revolutionary about this industry. And when it's the first time that a user gets to see these projects, what they do on chain, and the capability that gets unlocked through just the utilization of a wallet for themselves, and they start to explore this ecosystem and the entire chain ecosystem.
I'll interrupt you there. I'm curious, like Francis, like when you're coming from the world of TradFi, you're BlackRock veteran. Were you in crypto in 2020?
I was in, not at that point, but I cleaned it all up. Well, for one of the startups I was in, through all the risk events through 2022, 2023, and then, the final one culminating in Circle's DPEG, linked to Silicon Valley Bank, which again, you see at that point, excess leverage flush out of the DeFi system, but there's still a TradFi mismanagement of balance sheet assets at SVB that then brought contagion into DeFi. And by that point, I was quite tired, and I was a little bit annoyed with with TradFi giving me another risk event which wasn't on the risk map. We were even at that point not in Tether so much. We were USDC and still
This is you're at a start. This is what startup was this?
That was at Valor. So I was at an ETP issuance business, but we did have some loans out. So we had some loans in USDC, and then, but what you see then, and I find across this whole ecosystem, what is of value is the partnerships that you create through DeFi, it was just we had good relationships with loan counterparties, it was just through that whole Saturday morning through to Sunday. Repapered our loans from USDC to fiat, and then Circle, I think they managed that whole messaging very, very well, and sure enough, Monday morning Peg was reestablished, and everybody pulled through that weekend, but what brings you through is crisis manager at Circle. I think they did very well, and then also just partnerships within DeFi, everybody pulling together to ensure that both parties on the side of a loan come through.
Okay, so I mean, one thing I want to pick up on what Davide was saying was like DeFi summer was exciting. Amelia, are you excited by DeFi right now?
Yeah,
Or is it boring?
I don't think it's boring. I think it's very exciting. For me, the promise of DeFi is bringing a lot of the financial applications that can be done off-chain, on-chain, right? And when we first started hearing about like bringing trading on-chain and bringing loans off-chain and collateralized loans, it was very exciting to see. And I think right now we're very quickly seeing how other financial applications and other use cases are starting to pop up that maybe have a more institutional flavor or maybe have a more a mature approach to it. Feel very exciting to me.
So maybe I'm just, rather than like a frat party when we're like 18 years old, maybe this is like a nice kind of like dinner party we're going to answer.
Yeah, and I think it thinks, I'm maybe get excited for different things that some people do not. I get excited by payments.
For a dinner party? Excited?
Yes.
Okay. Go on. Sorry.
But yeah, I think like it gets me excited seeing what's being built, how institutions are sort of doubling down, putting a lot of bets, a lot of thought into building their teams. And the sort of conversation that you're able to have is much more different than the one you were able to have a few years ago.
But I think what you're getting at, though, is also a very interesting irony here. It's like DeFi was supposed to, challenge the banks, challenge the BlackRocks, challenge all these institutions. And now it's just like, I don't know, everyone's in suits now, except for Davide. So Davide is still, he's still holding out. But yeah, everyone's in suits now. This is a much more, I feel like Chainlink was probably, it's been around for a long time, but this is like a super professional conference. It has TradFi cannibalized DeFi in a way that is worrying to you? I don't know, Davide, do you have like you were there in DeFi summer, you were literally on the beach. Do you feel like it's gotten more? Francis, do you want to go?
Yeah. I mean, I think, the innovation is always coming from DeFi. DeFi, you can build and deploy and innovate and iterate in DeFi live. And you see, I think, when you get to some sort of conferences, you see that academia is there attending conferences to work out what is going on in real time. And is then informing, academia that then is informing, longer term planning of finance. And that is the exciting thing in DeFi, is that you can build and iterate in live, and you very much can't do that in TradFi. You are building, off, and then deploying, once something is final. And often you see markets have moved on before you can ship your product. So
are you saying, but I guess the point is that do you find there's a irony there between TradFi, wanting to tokenize money market funds and things like that on chain? Is that, do you feel like that's kind of like destroying the purpose of what this was all about?
Insofar as whether, DeFi ideals is, TradFi just being, pragmatic and observing the opportunity. And I think TradFi, comes in when they see a commercial opportunity. But at the same time, you can see that, DeFi is influencing, the evolution in that space. And it has a lot to be benefiting from that. As more and more capital moves on chain, DeFi can only go so far without, excess capital moving on chain from the players that have it. But at the same time, you then do see that, TradFi is influencing DeFi risks. And in a way, our perspective as a portfolio manager, believing in, portfolio management theory, we are here in the belief that the true value of DeFi is not in speculation, but in the intelligent curation of secure, auditable, transparent, and programmable finance, and that's what we are wanting to see develop in the ecosystem.
I'll punt the question again to you, Amelia, because when we were chatting before we got on stage, you were saying you've been in crypto for 8 years. That's like, I don't know, it's like 7 years per year. I don't know, it's in dog years. I feel like that's like you're 56 years old by crypto years. So. I mean, you were around for DeFi summer. Talk to me a little bit about that irony.
A lot of the big DeFi protocols that you see right now, and they've become really institutional in that we take a look and see the massive amount of volume they're doing and the huge amount of capital that they've been able to lock up. They were all born in that period of time, right? So, I think that it's not necessarily irony, but I think, as you mentioned, like if you believe in capital market theory, you believe that anything that makes markets more efficient is going to grab traction, right? And I think that DeFi sort of unlocks efficiency, and it unlocks new distribution, it unlocks new markets, it unlocks new areas of capital that can fully come on chain and become truly global. So that's like, I think, an opportunity for every institution in every country in every part of the world. Right?
I guess the kind of follow up there. So basically what you're saying is that, okay, DeFi summer was like, we had like an unruly teenager. Maybe I'm switching metaphors, mixing metaphors, but we had an unruly teenager, and now we have like maybe more of like a young adult who's like, going for their first job and shaking hands with, I don't know, people from banks and stuff like that. I think, Davide, for you, you were getting into it when you were actually giving your intro and then talking a bit about how you were on the beach, trading. What were you trading on the beach? Do you remember? What was your first trade?
It was the old version of Aave. I remember then also Chilitz, which was tokenizing a sports club.
So you bought a sports club token or something? Okay. Well, I'm probably not a good bet.
Mm-hmm.
But I guess like you were excited that time. You've still been in the space. Is seeing institutional adoption, is that exciting? I think you were saying what will make DeFi exciting again. Can you talk to me a little bit about whether you're excited now and what should change if you're not?
So I think that today we will never have a pure DeFi summer whereby reverse gravity, every asset goes up, and if everyone can say that they have been rewarded by being DeFi users, things definitely move on different rails. On one side, there is the institutional adoption that is pushing the blue chip of the space, that in order to grow to a wider audience, they are getting into partnerships with all the possible industries in the space that are from the traditional finance side. And then there is the side of builders that are still trying to innovate in very different verticals. If we think, for example, this winter, there was, I will call it like AI winter, where for 2 months, everyone was very exciting of every possible iteration of AI coins or AI launchpad and similar things. And that was kind of a mini DeFi summer, but winter edition. I think that moving forward, we are going to, but just for the sector. And I think that moving forward, we will see more vertical, isolated type of summers that will impact certain areas of DeFi that from being on the obscure side of building in the shadow, from not finding any adoption, there are going to be certain events that brings the spotlight in that specific vertical, and then all asset rises, but 90% of them, they didn't need to be on chain, most probably.
And so I think, I mean, talking of verticals, it reminds me that, Amelia, you do payments. And so I'm curious, like, and, you know, I don't know, we'll go away from DeFi summer now and more just kind of talk about like next kind of steps and applications for what people are actually seeing on chain. You do payments. Are you seeing things kind of really grow in momentum in terms of people actually coming on chain and transaction and doing payments on chain rather than just using like USDC for trading?
Absolutely. I think that every single institution is thinking about their on-chain strategy and how it,
which institutions, can you name them?
I mean, every payment service provider in the world is thinking like, how am I going to implement stablecoins into my flow of funds?
Okay.
Or how am I going to be disrupted by it? Right?
Any cheeky little names? Yeah, I'll stop. Okay, but you're saying every payment solution provider.
Yeah, they're all trying to understand how they're going to play a role in this on-chain economy. And I think a lot of those are also going to be complemented by DeFi, right? So if you talk about like a payment service provider, a payment facilitator, they all have the same needs off-chain that on-chain. They need to tap into liquidity. They need to get loans. And I think that DeFi just facilitates that for them. And it makes it easier and probably less costly for a lot of those companies to access capital in order to be able to do payouts and payments.
Is there like a specific actual, like, you know, okay, so DeFi in and of itself, you were saying is helpful for payments, but are there like specific protocols or specific new things that you're excited about that are actually like making payments use cases in terms of stablecoins and on-chain transactions, like actually meaningful for institutions? Like, are there some protocols that come to your mind or some like sector? Because it's like there's lending markets, et cetera. But, you know, it's always interesting to see like what are actual some places that people are getting excited about or that payments can be useful.
Yeah, I think obviously cross-border payments is a space where I've spent a lot of time thinking and like seeing how it's going to disrupt. That gets me extremely excited. Another area of opportunity, I think, is obviously in-person payments. That gets me extremely excited. And I have seen some things and innovations in the space, for example, minting receivables and using that. Whenever a payment company wants to do a payment, then they mint the receivables and they use that as collateral for being able to tap into additional liquidity, right? Okay. So they can do the payment without actually having the money and do the outflow.
So basically, they have an IOU note. So you, like Emilio sends Ben like $5, but like the $5 hasn't cleared yet. Correct. So then I get like an IOU note that says like Emilio is $5, and then I can use that to like, you know, get more capital.
Correct. Okay. And all of that is like there's gonna be opportunities for putting that in the DeFi, right? Okay. And I'm sure someone's gonna find a use for those assets on chain.
Francis, is this something like, you know, you're coming from more of the TradFi angle? Are you seeing use cases maybe are you seeing new things that are happening that are exciting you kind of within the DeFi space?
Well, I mean, yeah, we're a DeFi, you know, an on-chain asset manager. So for us, it's all about, you know, looking past the hype of new sort of protocol conversations, but it's about combining the various sort of layers of DeFi and bringing that to fruition for our clients. So, you know, we work, what's interesting for creators now is how DeFi tooling is emerging. It's enabling broader on-chain investment strategies to be built.
What does that mean?
So you see the emergence of discretionary, for instance, coming through. So you're sort of moving from just on-chain yield management to actually you know, we're running discretionary portfolios and then seeing how you are able to grow and scale those, leveraging sort of AI to improve, you know, risk management automation. And then, you know, we see how the emergence of different infrastructure that we're able to leverage. So we built some SMAs through Enzymonics, which is a vault tokenization layer. And then for us, it's also interesting and exciting to see what's coming out in the data layer. So, Chainlink CRE, that's going to bring to the ecosystem means that we're able to pick, all of this innovation and combine it into a composable sort of DeFi toolkit, and then use that to bring improved investment solutions to our clients.
One thing, talking about payments, more institutions going on chain. I feel like every time you do a DeFi panel, there's always like a hack like 3 days before.
So was?
Yeah. Well, no, there literally was. And so we have the balancer hack. You're talking about stream finance. Davide, are you talking to institutions?
So talking to institution is something that happens on different rails. So it depends what they're interested about.
But my question is, when you talk to institutions, obviously these are risks, right? Like I can't just like go into a Wells Fargo and say, give me $120 million. And then I'm going to set it to play. And then I'm going to you can't do that. But you can do that DeFi in a way that is very different. How are you convincing institutions that there's an appropriate kind of risk management to actually get more people to do investments on chain?
Yeah, we started talking to institutions since many years ago, actually. Ava Labs, for example, has always been in the RWA and institutional finance space, very strong into try to grow into the sector early on. So we have been multi-years conversations, and I think that the risk appetite of institutions into participating in DeFi actually even changes with regulations. Mostly, they want to do a lot of things. Their main questions in what's blocking them is, can we do this, or how can we limit what's possible? So there is now a framework.
So it's less about security and more about regulation. You feel like that are the risks that institutions are worried about when it comes to DeFi?
We are super high security first protocol, never have suffered any type of attack until now. Touch wood. And basically the trust in the protocol, once you are a builder for many years, it's kind of given for expected at that point. So the seniority of a project matters in that respect. But then they want to figure out how can we apply this specific requirement to what DeFi is doing. And often DeFi is much broader than the use case that they would like to experiment. So I think that what we are seeing in the past year is actually a relaxation of, okay, let's just try to do something, and them experimenting much more with their RWAs actually on chain without having to go into permission blockchains or similar.
Amelia, you're obviously probably talking with institutions that you shall not name. But I think this question of risk is always present with DeFi. What are they most concerned? Are you seeing similar things where they were much more concerned about regulation? Maybe that's kind of gone away a little bit in the past year, but are they now still concerned about security? And how are you kind of convincing them, or how do those conversations go?
I think regulation always plays a very important role in the mind of institutions. Like if you take a look at what Genius Act did for stablecoins in the US, it just advanced the conversation forward years, right? Like the conversations that you were expecting to have a few years ago in other countries, the US just accelerated very quickly. And the truth is, regulation for DeFi is not there yet, right? There's not the level of clarity that you sort of need for institutions to be able to sort of adopt it in the way you want to see it. One very small example is on-chain effects, right? If you want to see on-chain effects, the regulation for on-chain effects, it's not really clear exactly which countries are going to implement it, how they're going to implement it, which rules in terms of compliance apply, which don't. So I think once you see the clarity in one country, it's going to allow for institutions to.
So it's not just like there's no Gary Gensler banging his gavel on the proverbial court bench. I don't know. Again, they have mixed metaphors for me, but there's not necessarily the threat of litigation. And now that's hanging over. There's still their institutions see a lot of risk if there's not actually clear bespoke legislation.
Yeah, I think at least, for example, on the stablecoin side of things, that is very clear now. And I think our RWAs and on-chain finance is the next step.
Gotcha. Francis, I know you're London based, but obviously you're paying attention to US markets. We don't have too much time left, but I think probably the Clarity Act does get into some of these questions, but do you think there should be a bespoke DeFi Act?
No, I think, I think what we're trying to do as an actor in DeFi is ensuring our risk management is, that we understand the ecosystem in which we're operating. We understand how complex, smart contracts are getting. We understand the interconnectedness of DeFi and the risk that brings. We understand cross-chain interoperability. We're working with on and off-chain data sources now. So for us, it's about that's a USB is that we're in DeFi, we're operating in it. We understand its risks, and that's what we can bring to partners who are not yet in DeFi and maybe a little bit blind to some of the intricacies of the ecosystem.
So 10 seconds. Should there be a DeFi Act?
I believe that freedom allows for innovation. So leaving freedom in general, regardless of what the act will be, it's going to be key for new primitives to appear.
Cool. Okay. Well, that's a very philosophical way to end the conversation. But thank you guys so much for joining me up here. I think we're the last of the day. So appreciate everyone listening to us.
Thank you.
My name is Michael van der Poppen. I'm the host of New Era Finance podcast, but also the CIO and founder of MN Capital, a venture fund, and a liquid fund, MN Fund. I'm going to hand it over to you to provide a short introduction.
Thank you. I'm Omar Azar, VP Business Development at Matter Labs. Matter Labs is the core company behind zkSync. At zkSync, we are leading the development of zero-knowledge proof technology for building interoperable financial infrastructure with our Providium stack, essentially enabling banks to come on-chain, come onto Ethereum on their own terms.
Go on.
Oh, right on. Thanks. Mike DeMello. I represent RAC. I'm the head of DeFi there, and started in the industry in 1997 and discovered the Bitcoin white paper in 17. And I'm just happy here to talk about the institutionalization of DeFi. I think it's exciting and relevant topic.
All right.
Yeah. Hi, everyone. I'm Serena, and I lead RWA tokenization at Polygon Labs. So as you all know, we power consumer apps such as Polymarket, and we also house over 1.1 billion of RWAs on our blockchain. We proud to be the infrastructure for both TradFi and DeFi, and my role is to bring TradFi on chain in a scalable and compliant way.
Hi, everyone. I'm Luke. I work at Blueprint as our chief growth officer. We have two protocols. One is Concrete, one is Glow. One is on EVM, and then one is on Solana, and I'm oriented around driving TVL to those balls, managing reward strategies across a bunch of institutional parties.
Omar, I would like to start with you. We have seen that we've got a different governmental approach in the US when it comes to onboarding institutions with crypto in general. Since the beginning of 2025, what has changed, and what are institutions asking if they want to become on-chain?
Yeah, so I think one is definitely the regulatory environment. There's a lot of room for experimentation and actually executing and doing strategies from different types of products that people want to build. I think at the very core, to bring on institutions on chains, you have to actually prove business value. So for a lot of the assets tokenization that we've been seeing, first step is actually proving there's some level of demand for this stuff. And initially, the first wave was different types of foundations, on-chain treasuries that couldn't necessarily move off-chain and take advantage of money market fund or T-bills, for example. That was the first wave. And then the next set of wave that we were seeing is actually evolving the different types of demand. So backing stablecoins, for example, has become another big one. Starting to do repo, like what Aave Horizon is doing with lending, etc. So I'd say first step, demand. And then the second step, we see the evolution of that demand as the products become more mature. I would say the compliance aspect of it in terms of who actually owns it, what is the counterparty risk as well, what is different types of structures. The structures have gotten much more advanced as well. That enables funds to be more okay with holding these assets, etc. So yeah, I think demand first,
then the evolution of proving, okay, I've got this demand. How do I actually satisfy it? And that's going to lead to more and more demand as the products evolve and get more sophisticated and more interesting.
Fair enough. Serena, there's 1.1 billion within the protocol. What questions do you get from institutions if they say, instead of no a few years ago, they say yes, but in order to get us on chain, we need to have these sort of requirements?
Yeah, I think previously it was always like, why blockchain? Now it's how blockchain. That's a completely change of perspective. And now that, as you know, we have over 1 billion on Polygon, and also you need to focus on the diversity of assets. So there will be money market funds, there will be private credit, there will just also be some, say like tokenized like commodities. And so you will see more also about like precious metals. And for us is to enable the use case for them. So if it's the same use case for holding it off chain, maybe as Omar said, it's not that compelling. So with DeFi in place, with our ecosystem, we're able to give you more maybe levered yield strategy. And also it's also our job to educate banks, traditional financial institutions. This is not a scary space. Like at the end of the day, on-chain finance, off-chain finance, it would just be finance. So that's up to a lot of us here on stage to create that better narrative, be the education experts on that, and we'll see a new future ahead.
Well, I mean, all of you are building infrastructure in some way. Lucas, it's a new protocol, new project. What problem are you trying to solve that is required to onboard the next trillion?
I mean, I think for us, I spent a lot of time at BitGo before I came to Concrete, which was largely oriented around qualified custody and focusing on getting yield to users within the parameters of a specialized regulatory box. And I think a lot of times where the industry is actually evolving is identifying that 25, 35, 45% yield is like kind of bullshit in a lot of ways. Like you're actually not going to very, very regularly realize that with the amount of capital that we're putting to work. So the industry is improving in the way that we are looking for de-risking, deleveraging people's trades, and then focusing on getting assets that are nascent and stuck in custody to work. And I think really, if we're able to do that, I mean, like someone like a BitGo where I used to be has $140 billion of assets. And largely a lot of those are just sitting there idle. I think that getting those assets to work is what we spend a lot of our time focused on. And right now we have between $1.4 to $1.5 billion. And I think that that's largely oriented around people that don't have the highest yield requirements, but need things to work in a way that is good for their regulatory environment.
When I go to you, Mike, in terms of RWA, tokenization, interest from potential clients using the infrastructure, what are you getting out of your work fields or the interest that you get? What type of requirements do they need?
Yeah, like one of the things that I think is interesting is the real world asset narrative is really focused on U.S. treasuries. But we all know that real world assets definition could include like real estate, commodities, and those assets actually have different risk characteristics than what exists today in open finance. So it's littered with risk-based. So if you look at the whole market, you have like maybe, I don't know, based on this week's price action, but let's say 3.5 trillion, 300 billion is stables, the rest is risk. So you have like a 90-10 distribution. So you know, at RAC, we're trying to introduce stability. We're trying to bring in non-correlated assets into the ecosystem, into open finance, where you would have more stability, more diversification, allow, a more mature type of practices to have, because we know folks are doing activities in open finance, borrowing and lending and stuff, but they're doing it with risk-based assets. And I don't know if you saw early this week, you have like most of the whitelisted assets are Bitcoin or Ethereum. And I think Ethereum was down like 12% in like 12 hours. And so that makes that whole borrowing and lending tougher and really I guess more problematic than it needs to be. So it's more about bringing stability and uncorrelated assets into the ecosystem.
Omar, if I bring on this topic, but I think the previous panel was talking about the exploit, which have it on Balancer, and I think 100 million has been drained out of the protocol. Then on the other hand, we had Sergey saying we need to work towards a single source of trust. So essentially we trust the blockchain and then we can automatically execute everything within DeFi. But then we see the exploit, which then questions whether institutions should be actually joining on-chain. Mm-hmm. What type of safety measures do we need to prevent any exploits, or what type of safety measures do we need to have in order to prevent anything of the measures that we had on October 10th?
Okay, lot to unpack there. Let's start with smart contract risk, or the hacking risk that we've seen, but that also applies to bridges as well. But that's not just a problem for DeFi either, right? There's also hackings that get involved in the Web 2 world, like AWS or someone's credit card data set can also be hacked. And that's a pretty big problem too. And that happens quite a lot. So it's not just this is a risk that's purely just in the on-chain world. I think there's still a lot of advancements being done in terms from a product perspective, which means new types of smart contracts need to get built out. New types of primitives get built out. We are achieving fairly good maturity on the base level of the primitive, where you think of these like different building blocks. So I think we need to come to different types of smart contract standards for different types of functionality. I think that is, very important. Things that have been tested through time, continuous auditing. It's not so much that, okay, I built the protocol and I've done one audit or I've done one series of audits, I'm good to go. There should be continuous security measures, and that should be part of the operating model of any DeFi protocol, but then also the users. So if you're an institution, you probably want to constantly have and ensure that regular cadence of audits are done from a security standpoint, like you do with any business. Mm-hmm. It's not just because it's on chain, all of a sudden your security and InfoSec parameters get loosened. You're constantly doing audits of any sort of system that's in production. So I think that is something that needs to be raised. And I think that will lead to better results overall long term. Now on the 1010 events, I think that's a black box. I think there's a lot of rumors of what's happening. There's rumors of someone suing someone, etc. But that's because it happened in a centralized exchange. There's no way for anyone to know what happened. On the on-chain world, at least, you can have everyone see what happened, and there is reconciliation of, okay, these were the issues. This is how we solve it the next time. If it happens in a black box like a centralized exchange, we have no idea.
Well, I mean, in terms of, we know that what happens on chain and everybody can see what happens on chain. I think that's basically the biggest critical aspect onto Hyperliquid, which if you're a big institution, then you'd rather not want to be on Hyperliquid because the positions are out in the open and people are hunting those positions. Mm-hmm. Serena, in your case, if we look at that aspect and also the fact that we are going to integrate more of privacy into the protocols and the decentralized world where institutions can act in a private manner, is that a step forward or are we going backwards? What is your opinion on that?
I think privacy is needed for some cases. So I think when you ask me, is it going to be a public blockchain world? Is it going to be entirely private chains? I think both will coexist for a long time. For instance, network like Canton and ourselves, we have a completely different narrative. And I think going back to your question earlier in terms of what of these exploits keep happening, what's going to affect our ecosystem as a whole, is if you look into the talent pool in Web3 nowadays, it's everyone may be focused on tech, on sales, but there's not a lot of risk personnel. So, but when you look in TradFi, compliance is probably the biggest C-suite that everyone looks after. So I think that should be a shift. And also that will be the going trend going forward. And that also signals that we are, as an ecosystem, is more maturing in that sense. And that would practically be a step forward for us to be a safe space that people want to operate in, have stronger confidence, and be the really step forward that for the next generation of finance.
Lucas, in the capital markets, if someone wants to launch a tokenized money market fund, right now it takes a lot of time to actually start one. And there are a lot of chains and a lot of different aspects that are risk essentially. we are here at SmartCon. CRE is the solution, what is compliance and KYC, AML, all those things are getting taken care of. But how can we make sure that it's as secure as possible to launch a tokenized money market fund within your ecosystem or the ecosystem in general?
I mean, I think there's the constant trade-off is security versus liquidity, right? I think that if you look at something like Securitize, who's doing a lot around the space and doing with very legitimate parties, like those assets are non-transferable, right? Which makes it very difficult for people to actually interact in DeFi unless you're doing something in permission pools or something that's actually meaningful. In a way that like orients around KYC and AML and everything that's included in that. So I don't even know if it's necessarily a conversation of like, hey, I think we know what the parameters are for security, candidly. I think people have figured it out and I think people are now able to sell to funds. The question is if you have all this security implementation, like what kind of value are you getting from DeFi? And I think that's what's relatively opaque. Like you can borrow against assets in traditional finance that are in opaque markets and we can bring those things on chain and there are people that will be interested in that. But I think like the big thing that I orient around with the people that want to launch tokens with us and want to be able to like get those tokens to work is that liquidity is a really complicated thing. And a lot of people have no idea how to seed markets. They have no idea how to make the asset usable within lending or whether it's liquidity across Uniswap and some of these venues. And I think that orienting around that problem, if you want to be a DeFi native asset, is incredibly important. And if you want to be a security based asset that is really oriented around selling to a new type of user within DeFi, then like different problems. And I think there are really clear things that I think a lot of the people on this panel are already doing to make sure that that's as buttoned up as possible. The question is, what is the value that you're getting out of it in that way?
If you talk about liquidity and that it's one of the issues for DeFi in general, lately, we've seen DEXs being launched on a daily basis, which basically provides like more scattering around liquidity.
Yep.
Do we need all these DEXs, Lucas?
I think you don't need about 95% of what's launched in this ecosystem. Like candidly, I think that there's very few things that I was at Eigenlayer and led that sales team for a really long time. And we oriented around all these new products that were being launched. We're launching hundreds of different AVSs on the course of a year. And realistically, a lot of it is duplications from what we've seen or small changes and things that people don't really give a shit about. Like, I think that you need 10x improvements across the board to make something actually meaningful. And there are very few things that you could do to a DEX that have a 10x improvement, right? Like you have Uniswap. One that I was really interested in and like personally invested in was Sorella, which does a lot of stuff around MEV capture and like actually really improves the overall system for users. But without liquidity that's very deep there, it's meaningless for so many people. So it's like, there's a bootstrapping problem, but then the secondary component is like, you need to do something that's like meaningfully different. And if you're not, then you need to be a master at distribution because that's the only way that you're actually going to like make a mark in the space.
Mike, in your view, I mean, tokenizing RWA is a great vision, but a lot of RWA do not have enough liquidity to create a marketplace. In your view, what does it need to actually have an efficient market, and where are we going to get the liquidity from?
Yeah, no, I actually think I'm going to take the counter that we actually do need liquidity, and then that's actually why we're trying to bring in like these large markets like real estate and commodities, because you can use the collateral value to then create a stable token to then inject into open finance the liquidity that's needed. And the deeper you have the liquidity, the tighter the spreads. And in fact, the more players, I think, in the beginning is actually helpful because we're still growing.
But do you mean on the RWA side or do you mean on the, like, because I think saying like Uniswap having all of these different pairs for RWAs is, I totally agree. I think having hundreds of DEXs and then each RWA having their own individualized DEX where then they're all trying to attract the same cash on the other side of the trade is really difficult.
Yeah, no, I agree with you. Yeah. I'm not saying that. I'm mostly saying that by bringing in these types of RWA assets and the fact that they do yin and yang when risk markets move, and if you could use them to build up the liquidity, then I'm in the belief that you will be able to satisfy the demand that is out there, because liquidity is needed everywhere. If you look in traditional finance, it's needed there. It's needed in open finance. Private credit's the biggest growing market. Why? Well, because no one's lending money out. So, lending is tight. So you have this new burgeoning market, private credit, that is feeding the demand because people still want to borrow and lend, right?
I think, yeah. I mean, I would love to trade in the private markets or like trade all those assets, but like we have had the elections a week ago in the Netherlands, and I went onto Poly markets to bet on the outcome. And we are trading volatility ourselves, but if you look at the spread on prediction markets, it's insane. I'm almost going to like market make those assets because of the fact that there's such a high reward. So I think liquidity is definitely required, but it's super difficult when there's such a big market scattered everywhere that we have enough liquidity to actually make it work. And then if we talk about having all those DEXs, we are also seeing hundreds of stablecoins. What's your view of the role of stablecoins in DeFi going forward, Omar?
I think stablecoins are still going to be required. I think you're going to see thousands of more stablecoins. The same way every company has their own credit card. What's needed, though, is to actually make stablecoins fully composable, and there needs to be a clearinghouse that essentially deals with. So, like, you have 5 different stablecoins with 5 different issuers. Your wallet should just see it as $5, etc. And there is eventually going to be infrastructure that clears stablecoins the same way Visa or MasterCard are able to clear any, proprietary or custom credit card on their network. So I think, yes, right now it seems like a pretty big problem to have all these dozens of stablecoins, but I think there'll eventually be thousands. Every single closed ecosystem or every single company will have its own stablecoin. The same way, Walmart, Home Depot have their own credit cards. The key, though, is actually building the infrastructure so they're all just composable and they all just act like one, and they're all just fungible at the end of the day. Once you get to that point, then we won't really see all these stablecoins as a problem. It'll just be branded, closed ecosystem yield machines, money for anyone.
Fair enough. Serena, what's your opinion on this topic?
Yeah, I think like stablecoins obviously is a big focus of Polygon. We have housed around like 3 billion worth of supply, and we feel that as the cash lake, which is really important in the tokenization space. And what I mean is that, like, I also agree with Omar, like, we should just, any company could issue stablecoin and we should view it as the same thing. I remember I was at Cybos a few weeks back, and there was a gentleman, I think Tony McLaughlin, he was the founder of Ubix, and he mentioned stablecoins is pretty much, you could view it as like traveler's check, and like that has been invented before you and I were born. So why would you wouldn't ask who issued the traveler's check, because you would recognize it. So we should have like a clearinghouse to ensure that a dollar is a dollar. It shouldn't be too complicated, because when that is solved, when people have that confidence, then it will be much easier for like figure adoption, and we wouldn't like. Crypto and payments is the same thing. Stablecoins is just payments, and that's when we really see like mass adoption and also programmable money to make DeFi and TradFi more flourishing.
I was around when travel checks were created, and Amex is the one that was that they were the counterparty to that. They are the ones that would fulfill that commitment. So it was on Amex, American Express's balance sheet that was supporting that. So,
yeah. I mean, I think like ultimately we have Amex and a few other ones, but there are not like 500 different versions of credit cards, right? So ultimately we are seeing a case of, okay, we have new technology, we have 200 stable coins, and at some point in time, 5 will win and that's it. Or am I wrong on that?
Depends on the use case. Depends on what they're for. If it's like global payments, remittances, etc., maybe there might be 5 that just have enough deep liquidity in all the different banks and the end-to-end points that they could use that way. But I still think there'll be a ton of different types of stable coins in various different closed loop ecosystems.
Okay.
And if I could add to Omar's point is, you have different types of stable tokens. You have ones that could use for payment rails, which follows like the regulation, like the Genius Act. But then you have the ones that are used for, investing or yield bearing. And again, if you have a pool where like a Tether, because it's the biggest one, is there to facilitate the transaction of the other ones, then it does actually, feed and fulfill the liquidity demand that's there. Because again, I'm of the belief that stable tokens has a huge runway, right? Because the asymmetric difference in risk to stable is not like you just don't see it in traditional finance. It's usually equal. So you have this 90-10 disjoint. So I see the runway as pretty optimistic.
I mean, we haven't even talked about tokenized deposits or deposit tokens either.
There you go.
And so that's true. That's at the end of the day, these are just accounts and with numbers on a new type of ledger.
Mm-hmm.
And that's how it's going to more or less work.
I want to touch upon one more topic, Lucas. In terms of infrastructure, we are usually talking about the backend, which is like the technology that's being built in order to operate within an ecosystem. But then on the front end, the UX, what is required to actually onboard the next billion users within DeFi or maybe institutions?
I mean, I think institutions are relatively sophisticated. Like we have a UI. I would say a majority of our large institutions that are depositing $10 million plus are not just going to a UI and like clicking a button. Normally they're doing it through facilitated flows via smart contract, where then they're immediately able to withdraw the funds whenever they choose. And it's incredibly flexible for them. And they normally build that into their product to make sure that they don't have to deal with any UI bugs or anything that could happen on the front end. I think if you're talking about trillions of dollars, I think majority of that money will come through those kind of flows. I think if you're talking about millions of users, I think you just need to simplify decisions. I think like analysis paralysis, especially around like rewards-based strategies, is incredibly pertinent. Like if you are offering them 15 USDC reward strategies, it's really difficult for them to make a decision, especially if they have similar yield profiles. I was talking to the guys at Wildcat recently. They're incredibly talented. Like the overall flow of what they're doing, I think they're the most sophisticated uncollateralized lenders like in the space. But what I would say is my conversations with them is like they have 30 markets, all of which have similar yield profiles. How do you decide who to go to for that? And like if you have USDC on the retail side, where are you putting it, right? And I think those are the kind of things that are going to continue to proliferate. Why people go to MetaMask to trade and why people go to very simple UIs is because they don't really want to make the decision if they are just trying to get exposure to potentially like a governance token or something like that. They just want the simplest option that is recommended or provided to the user.
All right.
I think you meant to say Rabbi.
Yes. Yes. Great example.
Final question, and we are running out of time. So 20 to 30 seconds per person. We've had 2020, DeFi Summer 1.0. We are in 2025, institutional summer, I would say. Where are we in 2030? I'll start off with you and we finish with Lucas.
In 2030, man, this is the second time someone's asked me what's going on in 2030. I was like, okay.
So fun.
So the evolution of DeFi adoption, etc. I think by 2030, you will have fully on-chain identity, KYC, powered by ZK proof. So you're not actually sharing data. I think things will be a lot more seamless. You will probably have a lot of agents actually running your strategies. I can wake up in the morning and say, hey, you know what? I feel the market's probably not doing too well today. Can you just deleverage me a little bit? Or, hey, today I'm feeling really bullish. Hey, AI, Cortana, can you please like leverage me up a bit? It's just like 20% on something safe. I think that's going to be the future. You really just talk to an agent and they will scour through all the different types of options, etc., and make decisions for you. That's probably where we're going to be.
Okay. Mike?
Yeah, I actually think the security side of tokenization is going to grow. Education, I see that's a huge aspect that would help everybody. And by 2030, I'm optimistic that the education level is going to be lifted and help everybody. And to your point, I hope the UI UX is better than it is today in open finance.
Yeah.
Yeah, and I think by 2030, there will no longer be departments called like digital assets department. It will just be finance department. I think that will be a big change. And also like the same as Mike, I think like for security side, like there will be a lot of advances and following like AI agentic payments that will be big. So excited for what's ahead.
Final words, Lucas.
I think I just I believe that the people that sit in rooms like this are going to be senior people that are getting hired by traditional companies that want to actually move into the space, and they have no fucking idea how to. So I think that'll be an interesting thing to see in the next 4 or 5 years, or companies that have largely shied away from crypto and digital assets more broadly are going to start looking for people that have 6 years, 8 years of experience in the space, and looking to pay them a lot of money to like solve relatively simplistic problems that exist in their infrastructure.
So the takeaway for the audience is,
Yeah.
what type of
Still early.
you be in?
Okay.
All right, guys. Thank you very much for the panel, and everyone. Thanks for staying. Give a round of applause to the panel.